Good morning, ladies and gentlemen. Our next panel will start in an hour time. The panel will be about Uzbekistan capital markets at 6:30 BST. Good morning and welcome. It's my pleasure to welcome you to Bonds and Loans 24. My name is Feruz Zokirov. I'll be your host for the next few hours. We have an exciting day ahead of us. Before I invite our first speaker, I would like to take this opportunity to thank all our sponsors for coming along this journey with us. We have tried to push the boundaries with Bonds, Loans, and Scoop 24. Your support has provided us with the belief that we can do more for our global EM community. To all of our speakers from Asia, EMEA, and Americas, thank you. Your willingness to share your thought, leadership, experience, and expertise will shape opinions and help companies the world over steer through the current crisis and into recovery. And finally, of course, I would like to thank all of you, our audience, for being part of our community that has helped to create the world's first 24 virtual summit for borrowers, investors, and bankers. So without any delays, it's my honor to introduce our first speaker, the Deputy Finance Minister of Republic of Uzbekistan, Mr. Odilbek Isakov.
Hi, good morning or good afternoon, everyone, depending on where you are. I would like to thank the organizers for the opportunity to be able to present in this prestigious conference. I will have a very short presentation about the impact of coronavirus crisis on Uzbek economy. And I will also share some of the key reforms that the government is pursuing despite this pandemic. So I have a brief presentation, which I will share my screen. So from the very first days of the crisis, government took this very, very seriously. The first coronavirus case was in Uzbekistan on the 15th of March. After 4 days, we had a presidential decree on priority measures to mitigate the negative impact of coronavirus pandemic and global crisis on the economy. Immediately, with this decree, the government created a 10 trillion sum anti-crisis fund, which is about $1 billion, as well as the fund's main purpose is to provide social support, especially to low-income households, mitigate coronavirus infection. So that's about financing measures to combat the spread of the virus, building hospitals, as well as buying necessary equipment. And the rest is supporting entrepreneurship, employment, making sure infrastructure projects continues despite the crisis. This has helped Uzbekistan to overcome the most difficult period of the crisis. The second quarter, especially from early April, when we introduced strict lockdown restrictions, this has negatively impacted economic activity across the country. Then there were further 3 decrees. The second one was to support the population sectors of the economy. Given how crisis unfolded, given how the businesses suffered, we ensured that we take timely measures. And during the first, let's say, 2 months of the crisis, we were introducing a number of legislative acts to provide comfort to the businesses. Here are some of the summary of some of these measures. So whether it's tax deductions or tax deferrals, social protection, increasing number of recipients of social benefits, and making sure that creating a fund for infrastructure, creating a fund for local works so that people are employed during this time. We also have introduced revolving credit facilities through the banks, mostly state-owned banks, about $3.14 billion worth. Debt service deferrals, about $500 million, and several other measures. This has helped the businesses weather the crisis. This has also enabled more than 1,000 companies operating uninterrupted. Those are in agriculture, for instance, given its open space, it has economic activity never stopped in agriculture, are some of the most important industries like power sector, metals and mining, social sector, of course, activities haven't stopped. And now with the measures that I've just outlined, private sector, SMEs, public transport companies, catering companies, they've all weathered the crisis, and some of them are now back to business. Of course, all these measures have had its impact on state budget. We estimated around 8 trillion sums of revenue fall. So that's the expectation for entire year, 8 trillion sums. So that's about $800 million, which led us to optimize state budget expenditures over 5 trillion sums, or over $500 million. From the local budgets, So 500 million of 5.1 trillion sums are from the state budget. And then the local budget expenditures, another 980 billion sums, or just under $100 million, been optimized. And we've also started critically reviewing the business plans of some of the largest SOEs, so investment projects, to optimize the expenditures, in some cases defer the investments, and make sure that we are doing what's really necessary this year from the state budget. At the same time, obviously the economic activity, in order to make sure that we continue growing, investments such as from international financial institutions, some of the investment programs which are currently ongoing, some of the new ones which are essential for this, for the well functioning of the economy, and other investments are continuing to flow into the country. As mentioned, agriculture has never stopped, and we would expect around 4% growth in 2020. Industrial production, we'd expect 3.5% growth. And that's obviously benefited from rapid growth of industries such as food production, oil refining, or metallurgy. As you know, Uzbekistan is one of the largest producers of gold and exporters of gold globally. And gold price movements has helped us to some extent. So 2020 GDP growth is expected in the context of 1.5 to 2.5%. We were expecting to grow by 5.5%. So this means now it's about 3.5 to 4.5% lower, 3.5 to 4% lower than what we are initially expecting. But nevertheless, it's a growth, something that we are probably in a unique position, given that many countries in the region globally are not growing this year. If you look at the forecasts from international financial institutions, such as World Bank, IMF, Asian Development Bank, or the rating agencies, the forecasts differ from 1% growth to 2% growth. So our own forecast is not too far away from those agencies. And for 2021, our expectation is a strong rebound, 6.8% to be exact, mainly driven by construction sector, industry, and services sector. So this will be the drivers of growth next year. And again, compared to other forecasts such as World Bank, they would expect 6.5% next year. IMF is expecting 7% next year, and rating agencies also around 6.5% for next year. So we're expecting a strong rebound, provided that the COVID-19 situation is not going to hamper economic activity next year. So that's a big caveat, of course, and hopefully this will be the case. So very quickly on the banking sector reforms. Even during the pandemic, government is strongly committed to reforms, very across different sectors. And I'm going to give you an example of banking sector reforms. Presidential decree was issued on the 12th of May, which also approved the strategy, which we developed together with the World Bank. And it states KPIs for 2025. So we have a 5-year horizon during which we want to increase the share of private sector banking assets from currently 15% to 60%. increase share of non-bank credit institutions to 4%. Ratio of deposits to total liabilities to around 50-60%. Mainly through attracting strategic foreign investors, as well as where it's possible to IPO and privatize our banks. So banks under reforms, I've highlighted, all of the banks will be reformed, including those which will remain under state ownership. So National Bank of Uzbekistan, Agrobank and Microcredit Bank, they will stay as state-owned banks, acting like a development bank, depending on the sector, depending on the scale of the projects. We are privatizing Ipoteka Bank. You may have heard that yesterday they've signed agreement with IFC. IFC is providing $35 million of loan, which may later be converted into equity. And they've been working with the bank for several years to transform the bank from state-directed lending to more commercial lending and more profitable business. SQB is next. Obviously, IFC is also working with SQB. As you may know, they've issued Eurobonds last year, $300 million. And we would expect that similar deal will be signed in summer between IFC and SQB, a higher amount, of course, because SQB is a larger bank. We're also planning to sell Asaka Bank, Aloka Bank, Qishloq Qurilish Bank, and Turan Bank. So this will, next 5 years will be very interesting to see how the banks will transform, to see how we attract investors into the sector, including strategic foreign investors. That means that we are hoping to attract banks which will buy our banks wholly or some share and enter Uzbek market. Economic outlook I've already mentioned. Unfortunately, the 2020 growth is not, well, I mean, on a nominal basis, dollar to dollar basis, we're not growing this year. But hopefully we'll catch up growth from next year onwards. Just before I finish my presentation, I would also like to talk about debt management. Of course, some of you may be interested on debt management. You may know that Uzbekistan's external public and publicly guaranteed debt amounted $16.1 billion as of first quarter 2020, so 31st of March 2020. That's about 27.7% of GDP. We're currently working on a couple of important legislation. One is law on public debt, which will outline a number of things, update the existing law dated 1996 and combine a number of different acts in one piece. It will also introduce public debt limits. Uzbekistan intends to limit its borrowing to 50% of GDP. And we want to make sure that it's written in the law so that we continue our prudent policy. Also, to this effect, we started capping our external debt. A cap for 2020 was set at $4 billion end of 2019 in the budget law. Now, of course, coronavirus wasn't an issue then, which it is now, and obviously for the budget support and to support other industries, we are borrowing probably a bit more than what we are set to borrow, which means that this limit needs to be reviewed. I don't know by how much, but I'm hoping that we will not be increasing that significantly. And of course, we are focusing very much on developing our local capital markets. We have issued over 3.5 trillion sums, or close to $350 million of local currency bonds this year, which is 2.5 times higher than what it was last year. Of course, we still the market is still not liquid enough, and main buyers are commercial banks. But we're hoping to develop the market as such that foreign investors can buy our government securities, and we have plans to bridge our local clearing system to Euroclear or Clearstream, so that foreign investors can also access our government bond markets directly without the need to establish a presence in Uzbek market. So this is all I wanted to say in this presentation, and happy to take questions if there are any.
Many thanks, Odilbek. It has been a fantastic presentation from you. There is a question from the audience. I know you briefly touched on it, but I think it's quite interesting question, which was addressed by our audience. So I will read the question. How has the privatization pipeline changed by COVID-19? How will Uzbekistan be attracting necessary investment?
Yes, obviously, privatization is a process. It's a marathon. It's not a sprint, which means that the preparation work has not stopped during COVID-19. In fact, we went through there was a very thorough review of close to 3,000 companies under state ownership or majority state ownership. We went through this exercise in late last year, early this year. It was presented to the government. Of the 3,000, a majority of them we are privatizing, including large state-owned enterprises and state-owned banks. So now, State Asset Management Agency is working on a presidential decree and working on a strategy to elaborate how we're going to privatize these assets. So there are some of the very small assets in rural areas, and there are big assets costing, well, with potential valuations of billions of dollars. So I would say, although some of the assets we are privatizing one by one, like Coca-Cola Uzbekistan, you may have seen in the news, will be privatized through open auction. But some of the companies which are not yet ready, they don't have IFRS, they don't have necessary corporate governance structures. They need to be transformed from totally focused on state-owned or state-directed entity into a more commercially oriented, more profit-seeking type entities. And this will take time. And the strategy, which will hopefully come out in summer, will outline all of this, and it will also list which companies we will privatize, like we did for banks. So prep work is going on. We're expecting that once the strategy is out, we will start the privatization in full scale, especially starting from small assets. And to be honest, intention of privatizing assets is not to raise money. Of course, it will raise money and it will come to budget, which is a welcome news for us. But important for us is to reform these SOEs, is to make sure that they are competitive, they have necessary corporate governance standards, necessary international accounting standards, and profit-seeking companies. So these are all, and this will necessitate number of different changes which need to happen between now and then. So therefore, the fact that COVID-19 is there, the fact that valuations may have been down compared to what it was before, it's not a material fact for us, because even if COVID-19 wasn't the case, we would probably have not been able to sell some of the larger assets, given the lack of those internationally acceptable accounting or corporate governance or other uh, um, reporting requirements.
Many thanks, Odilbek. Many thanks for your presentation. Obviously, entire world is watching the developments that Uzbekistan has been doing for the past few years. Your time is much appreciated. For those of you who would like to ask Minister, Deputy Minister, questions, please feel free to go to People tab, type his name, and send a direct message. I'm sure Odilbek will be happy to answer your questions. Many thanks for your time, Odilbek.
Thank you very much. All the best.
Thank you.
Thanks.
Good morning once again, ladies and gentlemen. It's my pleasure to introduce our next speaker, Mr. Konstantin Vyshkovsky, Director, Department of Public Debt, Minister of Finance of Russian Federation.
Hello.
Good morning. Good morning, Konstantin.
Could you see me? Good morning.
Yes,
Okay.
good morning.
Okay. Shall I start?
Yes, please.
Okay. Good morning, everybody. Thank you for joining us at such an early hour. And I hope that you, your families are doing well and in a good health. And I would like to use this opportunity to focus on the issues of Russian government debt policy through latest COVID pandemic, financial strategies and approach to capital markets in 2020. As you may know, Russia has implemented a quite moderate counter-cyclical policy response to soften the economic impact of reduced external demand and local containment measures related to the COVID pandemic that included additional social and healthcare spending, transfers to local and regional governments, support for SME businesses and strategic companies as well, through permanent reduction in payroll taxes and tax deferrals, as well as measures to support specific sectors of Russian economy. And all the above mentioned measures led to the need for Russian budget to attract additional financial resources. And the political decision was taken to limit as much as possible the spending of National Wealth Fund resources and to try to finance a bulk of the counter-crisis measures via additional borrowings from domestic capital markets, first of all. Given that the rather big initial borrowing program for this year, with gross issuance at the level of 2.3 billion rubles or 1.7 billion rubles in net terms, may be increased this year and maybe increased substantially. I would note that this year is quite special for Russian Ministry of Finance as government debt manager. We are provided this year. We are provided by the law with quite unique, quite unprecedented flexibility in terms of our actions in the market. In terms of volumes of borrowings, we have the right to attract resources out of formal figures stipulated in budget law, in formal borrowing program. As of today, we are quite satisfied with the pace of performing of domestic borrowing program, despite some periodical spikes of market volatility. As of today, we have already borrowed 1.5 trillion rubles domestically. That is around 66% of initial borrowing program volume. We stick to our classic strategy with overwhelming amount of fixed coupon bonds placed and floating rate instruments placed in limited amounts to maintain liquidity and representative benchmarks in these kind of instruments. And we plan to follow this approach as long as the market allow us to do it, trying to place substantial amounts of fixed coupon bonds at reasonable prices. We see the reviving interest from non-residents to our instruments, to Russian debt, and believe that together with the strong demand from local financial institutions, it will help us to accommodate increased domestic borrowing this year. As of today, a non-resident share of Russian debt market retains at 30% level, and we expect continuing steady demand for our ruble-denominated securities from the foreigners. You may know that Bank of Russia has just introduced quite new a longer-term repo facility that could increase the demand for Russian debt instruments, sovereign debt instruments from local participants of the market. As far as international capital markets operations for this year, we understand that Russia cannot issue in US dollar at the current stage due to US sanctions, while we could still access euro market financing. It's crucial to note that we do not consider entering the international capital market at any price, at any cost. And in case of unfavorable market situation this year, we may refrain from external placements and replace the indicated volumes with domestic borrowings. Generally speaking, external market does not represent a main financial source for Russian budget. Traditionally, we focus on the demand of local financial institutions and continued participation of non-residents in domestic market. So, in general, we're quite optimistic to believe that Russian market conditions will help us to go through successfully latest pandemic crisis. Thank you very much for your attention. I wish you a productive conference. I will be happy to answer your questions if any. Thank you very much.
Thank you very much, Konstantin. It has been a really interesting presentation. For all people who would like to ask a question from Konstantin, please feel free to go to People tab. I'm sure Konstantin will be happy to answer your questions. Type his name and you can send a direct message to Konstantin. Many thanks, Konstantin, for your time.
Thank you much.
Our next panel will begin shortly. Good morning, once again, ladies and gentlemen. I would like to invite our next panel to join us on screen. This panel will be about economic backdrop versus investor demand in Russia, moderated by Pavel Isayev, Executive Vice President, Debt Capital Markets, Gazprom Bank. Pavel, over to you.
Thank you. Thank you, Feruz. Hi to everybody, and thank you very much for this opportunity to present and to share our views with you with regards to what's going on now in Russia. I'm more than happy to introduce our panelists. First, Ravil Yusipov, Deputy CEO of Transfin Group. Ravil, hi, can you hear us?
Yes, hi everyone.
Very good.
Yeah.
Very good.
Nice to meet you.
Same here. I hope the whole world is listening to us. Next one is Richard Siegel, Emerging Market Credit Analyst, Manulife UK.
Good morning.
Hi. Then I'm happy to introduce Alexey Tretyakov, Chief Executive Officer of Ari Capital Asset Management, Moscow, Russia.
Good morning to everybody.
Hi. Hi, Alexey. And finally, do we have Florian Böhringer, Senior Portfolio Manager from Vontobel Asset Management, Zurich, Switzerland. Florian, are you?
Oh, good morning, everyone.
Hi.
Hello.
Hi. So let's start. Everybody got together. So we're talking about economics and financial markets in Russia right now in this turbulent times. Our first question is, after all this volatility and turbulence, prices going up and down, when the dust settles, when we look around, does the Russian government provided enough support to the economy? Did the central bank did their job well? I mean, I will just kick off this discussion by saying what we observe, I mean, as far as statistics says, I mean, the overall package from the Russian government is of stimulus measures is around 2% of GDP. We compare to USA, it's minimum 7% of GDP. Not saying about absolute figures. European Union is preparing the package of 10% of GDP. When we look about the central bank, that's quite impressive that the key rate was lowered to 4.5%. But is it enough? May I pass the word to Ravil? How do you assess the actions of Russian government and central bank in this economic conditions?
Hi. In this crisis, we first time central bank actually cut rate. Before it acted vice versa, and actually not all local participants anticipated such move. I remember that time in March and in February. So and actually we reached a historic low in rates. And actually some rooms for further pinching policy left, as we saw from last press conference by central banks last week. And actually, we have to thank a few reasons. Actually, first one, deflation risks prevail over inflation risks, and because Russian inflation right now depends more on inner factor rather than external one. Second, Russian monetary policy took advantage of unprecedented aggressive Fed policy, Fed cut. And from one side, actually the Russian monetary policy was pinching very soft by cutting rate. But from other sides, it was hawkish because Russian central bank kept very high rate differential between Fed rate and Russian rate. So it was almost a perfect storm, a perfect conditions. So third reason, transmission mechanism. Rate cut useless if transmission mechanism doesn't work. And for last few years, central bank paid very big attention to this one. And as we see on other markets, for example, US, where transmission mechanism didn't work well for a while. In Russia, so my appraisal, we did not bad, not so bad. So, and finally, the final reason, like the quality of credit risk in Russia, public finance and corporate credit risk, it's in very good conditions, despite low oil prices and FX volatility. So average debt to EBITDA ratio in Russia about 2 for tier 1 and tier 2 companies, corps, compared to 4, 5 in US markets. So we don't have any problem with defaults or restructuring. That's why I think the main reasons why central bank actually could cut rates.
Okay, Ravil, thank you very much. So you are in general positive. May I pass the word to Richard? How do you estimate the actions of Russian government and central bank?
I would say that they have, on the whole, also done a very good job. There are quite a few similarities between the actions of the Russian central bank and other large Russian central banks. There still is a large interest differential relative to some developed market economies. However, if we look around the globe, in Russia, as well as in countries such as Brazil, in a crisis such as this, with commodity prices falling, we'd have expected inflation expectations to rise and the central bank to have to act accordingly. However, inflation expectations have become muted. Early concerns about supply shocks have turned into realized demand shocks. And with inflation staying low, with the early actions that proved necessary of just ensuring that the markets worked and that banks had the liquidity, the central banks were then able to cut rates to historic lows. So therefore, what I'd say that the Central Bank of Russia has done is just merely follow the economic data and also mirror the pattern of the other large central banks. Where there is a dissimilarity is with the fiscal action. And a few moments ago, we heard about the actions of the Fed, which the fiscal policy in the US, which amount to 7% of GDP, but they're actually somewhat larger if you take into account the Fed's unconventional policies of quantitative easing, where its loans to corporates and its acquisitions of other, or I should say other unconventional purchases of its have been guaranteed by the US Treasury. So to that regard, the actions in the US have actually been much larger. However, the Finance Ministry of Russia has been true to form, although the Russian government has a long stated aim of increasing per capita GDP by a long margin. At the end of the day, what it cares about is stability, and particularly fiscal stability. And even though it has upgraded its fiscal packages, they're still relatively small in comparison with most other economies. And here I would draw a parallel with Mexico, where the AMLO administration came into power last year, suggesting that Mexican GDP growth needs to be quadrupled from a trend rate of around 1% to 4 or 5%. But here in the crisis as well, their fiscal policy reaction has been extremely muted, and it continues to have the same policy bias. So on the one hand, I would suggest that the Russian policymakers have done exactly what they've needed to do to stanch the wounds, but I wouldn't say that they've done enough to help the economy recover when the conditions do start to dissipate.
Good. Thank you very much, Richard. So basically, you have very balanced estimate of the actions. Alexei, can you add something? What do you see from your point of view? What's going on in this area?
Well, I think that Russian response to this pandemic crisis was very professional and balanced. Despite stimulation from Russian government and despite Russian central bank cut the rate not more, just slightly less than 2%, I think that Russian policy is still quite conservative. For example, this year, federal budget deficit can be 2 or 3%. So it's exactly where US budget deficit was in the best years of the United States. So I think Russian policy being conservative should be conservative in any foreseeable time, because Russia has a lot of risks. We have oil risk and we have geopolitical risk. So I think that market reaction for Russian policy was quite optimistic. We see government bonds rose a lot in price this year, and the ruble appreciated a lot from March minimum. And currently we have year-to-date ruble devaluation only of 10%, much less, for example, when Brazil or Mexico have. But at the same time, we have this geopolitical and oil risk. So I think if somehow this risk will diminish in future, for example, let's dream of Russia resolves problems with Western countries, or maybe some oil shock, for example, war in Middle East. I think these events will be very beneficial for Russian assets, and Russian assets can continue their growth. At the same time, if Russian policy becomes less conservative, if there will be more populism in Russian authorities' decisions, I think Russia can suffer if we have next wave of crisis, if we have next oil price drop or next pandemic crisis development. So I think currently market is quite efficient, and we are exactly at that levels which are fair for Russian assets given policy response.
Good, Alexei, thank you. Florian, what do you have to add to this?
What I would add is maybe to just say that the more you can do monetary stimulus, the less you have to do fiscal stimulus. And I think this you see really nice now if you compare Russia to the so-called developed or European US countries, that they are in a liquidity, so the US or the Europe, we are in a liquidity trap. We have low interest rates, and so it's very difficult to stimulate. Whereas in Russia, where you came from 7.5% interest rates in 2019, you could cut by 3%. And I think this is really a massive stimulus. And I think this will surely have a strong impact on the economy. Because I think the transmission mechanism will still work there, because at 7.5% of last year interest rates, there are surely a lot of projects which couldn't have been realized with such high interest rates, which now can be realized. And so I think this will surely stimulate the economy. I think what surely will happen is that the lower interest rates, they will keep house prices rising. The house prices, I think they have been rising already by 10% over the last years. I think this will continue. I think construction will be supported by that move. And so I think the economy should recover quickly.
Very good. Thank you very much, Florian. Okay, so I mean, overall, let's say consensus is that investors appreciate and estimate positively the actions of Russian government. And as many participants mentioned already, that in reality, the markets performed very, very well, and it surprisingly returned to an even better shape than it was before the pandemic. What I observe on the primary market for Russian issuers, both locally and internationally, that we are hitting record low rates. We're talking about Gazprom issuing rubles for 5 years at 5.7% in April, and in May, sorry, and 5.9% for 7 years. The same time, we see Russian railways closing the perpetual bond at 6.55. I draw your attention, it's a perpetual bond. 6.55% is nothing. Alrosa printed a deal last week in dollars, 3.1 for 7 years. I mean, where are these all going? Can you explain to me and to the audience? Ravil, can you comment on that?
Yes. First peculiar issue about Russian markets is of the curve. The curve steepens. 10-2-year spreads right now more than 120 basic points. It's very high. I don't remember when we saw such angle. That's one interesting point, first one. The second, as you said, yes, coupon rates at historic low or almost historic low, but spreads over the curve, it's wider than beginning of this year, as on primary market and also on secondary markets. And for example, a tier 1 bank right now, yesterday we traded at 120 points, when 3 months ago it was like 100 basic points. So, and the names you mentioned before, actually they had more narrow spreads rather than now. So that's I think the same situation in Eurobond markets. So that's a new normal, low coupon rates, but wider spreads. At that level of my anticipation, spreads must be lower, because, for example, 100 basis points spreads over when we have coupon 8. It's one topic. Another topic when we have 5 or 6, and we have and we still have 100 basis points spreads. So spreads must be lower. That's it.
Okay, clear. Richard, what's your opinion about such low rates for Russian borrowers these days?
On that point, I would say that, or remind our audience that in January and in April, I was asked for internal purposes to prepare some scenario analysis for Russian corporates. And 3 months later, my best case scenario for January looked, frankly, like I'm sure most others were, quite embarrassing. On the other hand, the best case scenario I could think of in April now seems extremely conservative. There, though, I could say it's really just the fact that there's only so much by which credit spreads can widen and stay high when government bond yields of the major economies are at zero or below zero and are expected to stay there for a very long period of time, given central bank guidance. And the same, I think, can apply to the Russian internal market. Whereas if we look at the long end of the OFZ market as the cumulative summary of expectations over the medium to longer term, we would have to expect Russian central bank rates to rise by quite a large amount for positive yield curves to be discounted. And there in itself, I would expect that not only government bond yields, but also spreads can decline further. And there I would point to the rising saving ratios, because ultimately this equation has to work, that if you have consumers spending less, savings more, the funds being recycled back into the financial system, inflation staying low, and central banks remaining accommodative for a long time, then you can't but have falling government bond yields.
So you think the rates will stay low? If everything goes well, the rates will stay low for some time for Russian issuers. Alexei, do you think these low rates somehow allow new issuers to come to the market, both local capital markets and international?
Well, I fully agree with you, Pavel. The world is very strange right now, and maybe Russia is not the strangest place in the world. We see even more strange thing in other emerging markets. We see, for example, Brazil, which cut the rate to 3%, and for Brazil with high inflation and high devaluation, it's incredible thing. So I think that Russian market is fairly priced right now. So it could be stable if we don't see large crisis in emerging markets. Personally, I'm afraid of the crisis in the second part of the year, because I don't understand why there is no inflation in emerging markets after devaluations, and I don't understand why investors don't care about rising debt to GDP ratios in many emerging markets. But right now the party is going on, and many issuers can enter the market at very lucrative rates. As you said, Russian Railways just issued perpetual bonds at 6 and 5%. If for foreign investors with foreign currency risk hedge, it means dollar yield of less than 2%. It's just incredible. So I hope that many issuers, Russian and maybe foreign, can enter the market and use this unique opportunity to borrow money while market is wide open for everybody.
Thanks, Alexei. May I pass the word to Florian? What is, from your point of view, what Russian issuers would you like to issue in foreign currency or in ruble? What would be your thoughts on that?
Yes, I mean, I'm more looking into the US dollar, euro, and Swiss franc space. And what, I mean, it's clear that spreads are very low, and they have been very low for a long time. And this is, for example, due to the central banks. We have seen now with the crisis that as soon as the market freeze, the credit markets freeze and spreads go up, the central banks are really ready to jump in and to buy and to lower spreads again. And this has worked very quickly. I mean, when we look in Europe and US, I think it was just a month where spreads were very, very high, and now they are already back to normal. And if I now look at Russian issuers in that context, I mean, for example, in Switzerland, I find the Russian railways with a spread of 180 basis points, and this is attractive. It's a triple B, and this is really attractive within the triple B space in Swiss franc. So, and I personally, I would like to have to see much more issuance on the hard currency, or for example, also Swiss franc side. Yeah, because there's really only a small number of issuers, for example, in Switzerland, only Russian railways and some oil companies, but these are usually difficult to invest in an ESG context.
Clear, Florian. Thank you very much. Okay, can we, after this overview of government policies and activity of Russian issuers, touch the following topic? I mean, if you look in commodities markets, they stabilized. Together with commodities prices stabilized the emerging market currencies, including ruble. Ruble looks pretty stable. The rates are relatively low. And I see many sites looking more and more into ruble-denominated instruments issued on the international markets, so-called ruble-denominated Eurobonds. I see the countries around Russia, for example, CIS countries, thinking about it because their currencies are correlating with the ruble. I see some investors thinking about, why don't we invest into ruble? It is not depreciating and the nominal rates are still higher. I mean, do you see overall any potential in issue ruble-denominated Eurobonds by the issuers outside of Russia, CIS or maybe emerging markets, Brazil, South Africa, and so on? Traditionally, we'll start with Ravil. What do you think about it?
Well, generally, local investors, Russian local investors, experience concentration risks, of course, in terms of like risk of oil or country risk, sanctions risks. So even a hypothetical Russian metal issuer would suffer oil risk and Russian country risks. So other like issuers from different countries are basically welcome, but we have like a strange situation here in Russia. We get used to very good quality. If you look to tier 1 and tier 2 universities in Russia, and relatively high rates and yields. So it would be difficult to match this anticipation from by issuers from different countries, other countries. So, but actually, we suppose we're ready for extra credit risk, for extra credit charge. But for me, as an institutional investor, it's very important to look to the idea through sub-portfolio. And when you have only few issues, so it's very difficult to manage the credit risk on such sub-portfolio. So universe is very low and very narrow, but and it's quite difficult to prove in front of management board and investment committee the idea. Let's do a sub-portfolio from different countries in rubles. So that's the main question, and I don't have answer how to come over this issue actually.
Yeah.
So it's kind of circle.
Okay, Ravil, clear. Richard, what do you think? I mean, would you invest into ruble-denominated instrument of, I don't know, issued by South Africa or Brazil or, I don't know, India finally?
I think that's too much of a stretch, too many layers of credit and market risk. And even so, I think it's difficult to see this market reaching any kind of critical mass, even including Russian and Belarusian issuers. There have been some in the past several years. Russian Rail proved somewhat popular, although it's quasi-government, but otherwise there was X5, Rushydro, and more recently Vion. But the international interests in those are very low, so therefore I'd say it would mostly be up to Russian offshore investors to buy them. But aside from that, we might more normally historically see international agencies such as the IFC borrow in rubles, both to help develop the market, but also to fund local investments. But due to sanctions, they can't. So therefore, I don't really see much of a trigger for this market to develop in any big way.
Clear. Alexei, anything to add? Ruble-denominated Eurobonds, is it appealing to you?
Yes, as Russian asset management, we can invest both in local ruble bonds and in ruble-denominated euro bonds, and we are happy to exploit any market inefficiency and promote market efficiency. So personally, I think that high-quality investment-grade foreign corporate issuers, multinational organizations are welcome by Russian investors if they issue more ruble euro bonds. It's good for diversification and probably maybe can help asset managers to improve total return for their clients.
Good, thank you very much. So from this, as Richard said, relatively small market of ruble-denominated euro bonds, can we consider and come over to the much bigger market, Russian government ruble-denominated bonds, so-called OFZ? In recent times, let's say shortly before the pandemic, we hit levels like 30% or over 30% of the OFZ were held by international investors. I mean, then we see some decrease in these holdings. Now it's building up again. Ravil, what would be your forecast? How what part of OFZ will be held by international investors by the year end?
Well, if you compare yields to other EM markets, I think OFZ is quite pricey. Like if you compare the straight numbers, but if you adjust to credit risks, the picture is not so like obvious. Despite low oil prices, Russian like public finance and debt ratio very attractive, and in terms of credit risk, they're much better than other EM markets. So risk of default is quite low right now, right? Surprisingly, and I wouldn't write OFZ off the monitors. But and another idea after COVID pandemic, standard approach to FX reserves, I think might be reviewed by many countries, and new FX and trade unions may appear. So it might give EM currencies and as well as ruble, including ruble, a very good backup. So another positive factor that would affect of the markets, if Fed shows that ready for nominal negative nominal rates, I think we're gonna see a new wave of carry trades on EM markets. So right now, under current conditions, I think we of the markets needs a break after a huge rally, and I wouldn't rule out a correction. Like volatility is normal for the markets, so I would shorten duration right now for a while. just to see what will happen in the future. But generally, I'm quite positive on OFZ.
Good. Richard, what's your opinion? This is a bigger market than ruble-denominated euro bonds. I mean, OFZ is a big market. What do you think about the dynamics there? And
There, I'd say
international
foreign
investors?
participation is likely to stay relatively constant as the various factors balance each other out, namely expectations of Bank of Russia policy, global risk appetite, flows into local currency funds, relative value with other government bond markets, and also sanctions. So therefore, I don't see too much change between now and the end of the year. But in closing on the last question, I would say that if an investor did want exposures such as South African rand government bonds denominated in rubles, he could always create that synthetically. So I wouldn't rule that out, just not in the conventional form.
Yeah. On this OFZ market, the Minfin of Russia is using the variety of instruments. It's not only fixed coupon, but it's also variable coupon. And there are some even some instruments linked to the inflation, so-called CPI linkers. Alexei, do you think it's a very attractive instrument to invest?
Yes, Pavel, I think that if we say about Russian government bond market, probably the most value we can find now is in inflation-linked bonds. This segment of Russian market is relatively young, and I think there is arbitrage between nominal yields and real yields in inflation bonds. For example, the yield for 3-year nominal government bonds is 4 and 6% right now, and the yield for linker is 2%. So if you detract 2% from 4 and 6%, it translates into inflation forecast of 2 and 6% for next 3 years, which I think is just unrealistic. And to diminish this arbitrage, I think that real yields should drop below 1% for Russian inflation-linked bonds. That's why I think that generally OFZ market is fairly priced, and now maybe it's time to switch into inflation-linked bonds for local investors.
Clear. Yeah, thank you very much, Alexei. Florian,
Well,
what
in
do
my
you think?
portfolio, sorry.
Yeah, go ahead. Ravil, go ahead. What do you want to add?
Actually, in my portfolio, I have inflation linker OFZ, but the liquidity is very low, and participants who actively trade this basically one issue. Also, the number of these participants very, very low. And as we see on primary placements for last month, we had like 2 billion in US dollars placements in fixed coupon, and only 300 million, 10 billion rubles approximately for OFZ linkers. So liquidity is low. This is, as Alexei said, very young markets and only one issue. So as a niche idea, it's a good one, but for as a mainstream idea for portfolio, I would doubt it. Well, depends on your assets, are you? But for me, its liquidity is very low.
Okay, Ravi, thank you very much. I want to pass the word to Florian. Florian, what do you think about still the nominal yields of OFZ market and inflation and everything? Do you think it still has value for a portfolio investor to invest into OFZ?
Yes, I think it has value. I mean, when I judge about emerging market debt and also especially about OFZ, I always look at about local emerging market. I always look at the real yield, and with a real yield of 2 to 3%, I think this is still attractive in Russia, especially if you compare it to our European world where real yields are just at zero. So I think there's still a strong case for emerging market local exposure. Then when I compare Russia against other emerging markets, I think Russia is also attractive, but more in the middle. I mean, when you look at the real yields, for example, in Turkey and Mexico, they are higher, but there also, I think you have in certain parts more risk. I think because the Russian risk or inflation risk is quite low because of the very conservative monetary policy over the last decade. I mean, you always had this current account surplus, you have net foreign assets, you have low debt levels. I think all these are very, very positive compared to other emerging markets. That's why I think OFZ are attractive.
I don't know. Probably my connection is not perfect. Apes.
No, we can see you. We can hear you.
Okay, very good. Yeah, okay, very good. So sorry, the connection was not perfect. Last topic, our time is running out, but still there is one topic which we cannot skip and we cannot avoid, is all the popular ESG topic. I remember when in March we were talking about the falling markets and a lot of uncertainty, a lot of volatility. Some people say, okay, we started the year with ESG being a top agenda. Now we're in the middle of crisis. Should we care about ESG at all at this moment, or should we care about economy as such? But when you look now in May, we see ESG issuance is picking up and getting the hot spot in the global debt capital markets. How is it developing in your life? I mean, I would pass the word first to Florian. He mentioned ESG during our discussion. Let him comment first on the ESG. Florian, please.
Yeah, I mean, for us, ESG is very important. We are managing pension funds, and I would say about 80% of our capital is managed according to ESG criteria. And I think also it makes a lot of sense because when you think about pensions, you think about the long term, and then you really have to think about also the environment or maybe the long-term effects our economy has on the environment. And it's clear that some things here need to be regulated. And so we are strong proponents of ESG. Now, I think when you look at what's happening, the reality is really that it has also an impact from investor side. For example, I heard of roadshows being cancelled, tobacco roadshows being cancelled in France because there was no interest of investors anymore. And yeah, I think Russia has maybe a bit of a difficult position here because a lot of companies are in the material space, which always has a lot of environmental impact. And maybe that's even a bit unfair because, I mean, how do you solve this extraction of materials? And but I think if you try to, or if they try to optimize here and to find good processes like green bonds, this might be very helpful.
Yeah, Pavel?
Just one sec, sorry. So can I pass the word to Richard? What the ESG topic means in your portfolio management life?
From a global perspective, it's still as important, but it shifted very quickly from being probably 5% social to now the majority social. It's difficult to quantify because the global economies are so much more in flux, but I would say that a lot more of the issuance as we move forward is going to be socially oriented rather than environmentally, or say loans being linked to governance indicators. In Russia, though, as we heard a moment ago, it's still quite difficult because most of the, at least on the Eurobond corporate side, are commodity producers, and they are naturally scoring low in the environmental ranks. They're subject to many accidents out of their control or were in or out of their control that hurt their rankings in the fuel oil spill, and Norilsk being just one of the recent examples.
Yeah, clear. Yeah, it's not an easy thing. Still, this ESG topic is relatively new to Russian markets, although some regulators already did some work in the last year. But may I ask to Ravil, how active is ESG principles are used in your investment?
Not actually,
Frankly.
frankly, because we don't have special regulation for pension funds in terms of ESG principles. But actually, we have to think. Well, Milton Friedman said once upon a time that only social responsibility.
Unfortunately, we have run out of time. Thank you for the excellent discussion. For those of you
we did our
watching,
best.
Thank you. It's a really interesting discussion. Unfortunately, you know, other panelists are waiting to join. For those of you watching who would like to follow up with any of the speakers, please contact them directly by going to the People tab on your main menu and searching for them. I'm sure they will be pleased to answer any follow-up questions you might have and to meet you by video call. I would like to invite our next panel to join us on screen. The panel will be about how are Russian companies adapting to the new reality and responding to COVID-19, moderated by Alex Griffiths, Managing Director, Head of Corporate Ratings, EMEA, Fitch Ratings. Alex, over to you.
Good morning, good afternoon, good evening. I've lost track of what time it is. Hello, everyone. Welcome to this panel. This is a truly fascinating time for global corporates. I was in Russia. I think it was the last live bonds and loans event before the COVID crisis, and yeah, things were looking pretty solid, pretty good. But now things have changed, and I've got three very distinguished speakers to talk us through some of those changes. Mikhail Sytchev, Head of Debt Finance from Gazprom Neft. I've got Rostislav Rozbitsky, Head of Corporate Finance from Evraz, and Ruslan Kamani, Head of Corporate Finance and Treasury at Eurochem. We will spend the next 45 minutes talking about the impact both on companies' businesses, but also on their access to funding. So I guess the first place to start is a very simple question: how's it going? You know, we look at companies across the globe. At Fitch, we have seen a huge spike in rating activity. I got the statistic through just a few moments ago that we've taken as many rating actions in the first 6 months of this year as we took in the whole of 2019. The direction of those actions was somewhat different, but huge amount of activity. But now it feels like we and the markets are in a place where we understand really what's happening. But if I look at those actions and those companies, there have been some really dire situations. You know, the airlines where you take away revenues for 3 months, then it doesn't really come back for the full year. And then I look at Russian companies. I sit on Russian committees, including those of some of the companies here. And it all looks very calm. You know, I sat through the oil crisis a few years ago as head of natural resources and the commodity crisis as well. And it was amazing how well Russian companies coped with what for the rest of the world was a truly dire circumstance. So I suppose my first question is, how have you seen stresses from the coronavirus affecting your businesses? Particularly on the demand side. So maybe Rostislav, if you could kick us off. You know, we've seen Russian steel makers through the years having the advantage of low costs and good geographical positioning. How have you seen demand and pricing changing?
Yes, hello everyone, good morning. As a steel producer of mostly infrastructural steel, Evraz has not been as affected as the industries and companies that are more into consumer markets. We don't have that immediate effect. So all our steel making assets are running basically at full capacity. And it's just the structure of the product mix that's changing in response to the crisis. And that's, there's nothing new in it. It's always been like in previous crises. However, there's of course some influence flowing over to our business from the eventually the consumer economy, and that affects us through the change in the demand for steel products. And our current forecast for 2020 assumes an overall decline in the world finished steel consumption by 5%. But this decline will be distributed very unevenly across different geographies and product groups. And the most significant decline of 18% is expected in the US, which is also one of the key markets and place of presence for Evraz. While Russia's and China's steel consumption will decline by 4 to 5%. And again, in absolute numbers, 5% of China's steel consumption, it should be understood, is 10 times as big as Russia's 5%. In the Russian market, we have seen a reduction in the sales of construction steel, which is caused by the lockdown of construction sites across the country, but it is now coming back rather quickly. The geographical location of our steel plants in Russia and the low production costs allow for quick switching from domestic market to exports, and thus allows to maintain the utilization of our steel making capacities at near 100%. So as I said, it's just a question of the product mix. But this means that Evraz will be able to maintain its share in the key markets of its presence and still remain profitable to some extent. Though of course the EBITDA margin will be under pressure due to lower prices in the world and high share of less value-added products in the overall product mix. And well, as far as recovery and is concerned, we're seeing already certain signs of it in Russia and in China in particular. It's difficult to say how long it will take to recover to the pre-COVID levels and whether or not there will be a second wave of pandemic, etc. So it's really difficult to make any reasonable forecasts at this moment. But we believe that Evraz's market and financial position is robust enough to go even through a bad case scenario.
Well, we have you on a stable outlook, so I guess we agree with that last statement. Ruslan, I suppose a simple view of the world would say, no matter whether we're at home or we're outside, we still have to eat. Therefore, fertilizers will be important, and therefore a company like Eurochem should be doing fairly well. So how is the crisis playing out for you?
Alex, thanks for having me. Let me start with some pre-COVID context for fertilizer market. Fertilizer market was quite tough for the last 2.5 years, which means that farmers enjoyed lower prices. And what is tough market good for? I think it's a very good time for strategic reassessment. So you can use these tough market conditions as a crucible for your strategic decisions. And that was exactly the point until pre-COVID.
Ruslan, sorry, I'm sorry. Your sound quality isn't very good. Is there anything you can do? We can hear you, but it's really rough.
Hello?
That's much better.
That's much better. Okay, shall I start again or continue?
Please start again.
Okay. Let me introduce you into fertilizer market context first. So the market was quite tough for fertilizer producers, which was favorable for farmers. And usually, you in a market like this, you use this tough time for strategic reassessment. So a company has opted for taking a pole position for next
several years. And COVID actually didn't change a lot of fertilizer market. It just brought some more uncertainty. So after COVID crisis started, management of Eurochem had almost daily meetings where we shared our opinions and where we monitored all our markets globally. What we observed so far, there is no demand destruction, it's just demand delay. We finished the first quarter quite more or less on plan. Second quarter has yet to be finished. The biggest problem so far is lack of visibility for next 12 months. But at the moment, we wouldn't say that the fertilizer market was had such a heavy blow. There are some things that are positive, like for example, Indian government and Chinese government has decided to support fertilizer purchases. This is good for the market. On the other hand, the price for biofuel has dropped significantly because it's correlated to gasoline price, which means that some crop producers are in a big stress now, and which means that they're not going to be quite active in purchases.
Okay, very, very interesting. Biofuel brings us nicely onto fuel and oil. So, I mean, the oil market has been one of the first casualties of this. In the US, we saw prices go negative, which is we got nowhere near that in the oil crisis of 2015, 2016. So it's really unprecedented times for the oil market. How is Gazpromneft seeing the outlook for the market and its business?
Good morning, everyone. Well, first of all, I would mention that Gazpromneft faced this crisis situation in very good shape. At the beginning of 2020, we had more than 200 billion ruble equivalent of cash on our balance sheet and quite conservative debt repayment schedule with major refinancings taking place in 2022 plus. Well, yes, March and April situation was drastic. We've never seen this before. I agree with you. And we actually see this in the results of the first quarter that we have recently reported. Yes, the figures declined, but still positive free cash flow generated by the company. While what followed next is the combination of two factors that brought us to a much better situation nowadays. First, timely actions of OPEC Plus with unprecedented cuts of oil output globally. Second, expectations and actual expectations of the rebound of the economy, and actually economy starting to operate again in a normal way. You can see it from your window. The planes starting to fly. The cars are, the cars are around the street, so the demand is considerably higher than it used to be in April. So, yeah. So what we see is, yes, we obviously anticipate some optimization of OPEX and CAPEX, but still the company actually paid the highest ever dividends in the amount of 50% of net profit, as was promised to the investors.
Great. I mean, the oil price is a fascinating one to try and comment on, and I appreciate you don't want to do it. I guess we're in the position where we have to speculate. So our speculation is we've got a price tag of 35 for this year and 45 for next year. But we see demand coming back. Just to echo what Mikhail was saying, almost to where it was by the end of this year, which is a quick recovery compared to lots of other markets. But we do also see those OPEC Plus cuts, because what we've seen is a huge rise in inventories, which need to come down, and we don't think that'll happen if the OPEC plus cuts don't stay in place. So huge amounts to look for in the oil market. I'd also make the point that it's not just Rostislav who's on a stable outlook. All three of these companies are on stable outlooks as well, which tells you a lot you need to know about Russian companies and where they're placed. But it's not an easy ride maintaining that stable outlook. So particularly Rostislav and Ruslan, you will have had to have made tough decisions within your businesses to keep your profitability where you wanted it to be. So can you take us through how OPEX has changed, input prices, that sort of thing? Rostislav, do you want to maybe go first?
Yeah, in terms of OPEX, I think the important thing to mention is that Evraz has an ongoing cost-cutting program, which is achieved through a large number of measures, organizational, managerial, and technological nature. And it has been in place for many years. And for example, in 2019, the EBITDA effect from cost-cutting initiatives totaled $284 million. And that's the ballpark number that we report like every year for the last several years at least. And that is, crisis or no crisis, this will continue in 2020 and future years. That just because the key to success for Evraz is maintaining its place in the first quartile of the lowest cost producers of steel in the world. So there is no real impact. I mean, of course, a weakening ruble helps a little, but you cannot rely on such things. You cannot factor in them in any longer term models or budgets because they are unpredictable. And the weakening of the ruble has a short-lived effect. It does help in the short term, but then if the weakening, the ruble weakens too much, and that continues for too long, that affects the local market. And the Russian market, the Russian steel market, is our largest market for our products. So we really don't rely on that. But of course, yeah, in the short term, that has helped as well.
Okay, and Ruslan, maybe I can ask you the same question. How has your business had to respond?
Yeah, sure. Let me remind that Eurochem's business model allows for quite good flexibility. So when we make our plans, budget plans for the year, we try to optimize our production so that we can use our low cost. Let me remind that almost all production of Eurochem is concentrated in Russia, which means low production costs and proximity to cheap Russian gas. When you plan a mine to end user from plant to end user trip, you try to optimize logistics costs, and you can optimize overall costs as well. So when at the year beginning, we were prepared for a market cycle change. So our operational expenditures program was quite significant. And we tried to keep this flexibility, which means that we tried on one hand to use this new opportunity to reposition ourselves on a new market. On the other hand, we didn't want to aggravate any covenants or to reduce any debt capacity or flexibility if market goes even tougher. After all, our OPEX program has been reduced, but not dramatically.
One of the things that we see when we look across the globe is different government responses to these crises. So, when you look at the Russian government's response, what has been the most impactful thing that you think has happened, Ruslan?
Yeah, I think for the first time, at least in my memory, Russian central bank has decided differently in time of stress. So usually by trying to protect foreign investors and by trying to reduce volatility, Russian central bank raised interest rate during crisis time. This time we saw it different, and it was very well welcomed by the market. And so far, I don't think we see any significant risk of inflation or market investors' concerns or anything like that. So I think it was a right decision, and I think it will help a lot for Russian economy to grow. Yeah, and there are some other government programs like programs for boosting corporate efficiency, or some helps for companies that suffered from COVID crisis. Not all of these programs are relevant for Eurochem, but we are constantly monitoring them, and I think it's very helpful and very useful for the market and for industry, and especially for Russian exporters.
Are we seeing? Would anybody else like to comment on policy? I think that was the main one that we raised in our pre-discussion. So unless you wave at me, I'll move on to the next question. Ruslan and Rostislav, in your businesses, and maybe we start with Rostislav first. What are you seeing in terms of capex? One of the things that we've seen from a lot of companies is announcements of capex cuts. Even the likes of Aramco in the Gulf is talking about cutting capex. So, how have your plans changed as a result of the crisis?
Right. Well, our capex is, as everyone's, is broken down into broad categories, which is maintenance and new investment. And maintenance is something that we are keen to keep at usual levels. It's quite stable across many years, as long as we maintain the same set of assets. There is a certain amount that needs to be spent on maintaining those assets in good shape, and we are very committed to that. And there is no question about reducing, trying to save on that. So while that will remain largely unchanged, Evraz has significant flexibility in timing its new investment capex. And luckily, we have entered this start of the COVID crisis, which was quite unexpected for everyone. We've entered it at the phase where we have announced a number of large-scale capex projects, but we had not had the time to spend a lot on those projects. Most of those, all of those larger projects were at the stage of engineering and all kind of preparatory work, which does not require a lot of financing. And we have not yet committed to any significant spending. So, and as the crisis started, of course, as I'm sure everyone else in the market is doing, we are reviewing every project one by one and making decisions as to moving those projects to the right on the time scale. There is no question about canceling the projects. All the preparatory work is going on, but the actual capital expenditure will, of course, move to the right, and we will not see the large overall capex levels that we announced or forecast in the 2020 and 21 for sure. And then we'll see what will happen by 22.
Great. And Ruslan?
Yeah, it's well known that Eurochem is committed long-term investor. So the company has invested a lot. For example, we have built our potash assets from scratch, and so investments, it's one of our components. It's a very important component of our long-term strategy. But on the other hand, one must be quite cautious in such a volatile time like this. So to be brief, I would say long-term projects are still on the table. Investment process in the company has not been disrupted. It's still going on. We are considering new opportunities, and we do not want to miss the best of them.
And maybe just flipping back to Rostislav, because obviously you're a spender of capex, but also your business depends quite extensively on other people spending on capex. So what are your thoughts about capex more broadly across your different markets? How long do you see the pause happening?
Well, again, as I said in the beginning, the industries that are closer to the end consumer, like construction, I mean the industries that are key customers, and we are the producer of infrastructural steel for all kinds of construction, residential, commercial construction, road construction, and for railway products, both in Russia and North America. And in North America, we're also a large producer of large diameter pipe and oil country tubular goods. And all those markets are very different from each other. In the construction sector in Russia has declined significantly due to COVID lockdown measures, but it's also recovering quickly after the measures are lifted. The consumers that are more into large infrastructure projects or Russian railways that are more a large corporate with a huge new investment and current maintenance, we obviously don't change their budgets and plans so quickly. So the rail market remains robust in both Russia and North America, and the same goes for large diameter pipe.
Okay, that's very interesting. So I guess that is half of the puzzle, if you like. So how are the businesses doing on a very simple, straightforward basis? Will the business survive and thrive in the current environment? The other question is, will it have the money to allow it to do that? So maybe we can turn to the markets, and maybe if we go to you first, Mikhail. Obviously, Gazprom Neft is still suffering under US sanctions, which limits your financing needs to really domestic markets. Could you give us an overview of how those markets and availability in those markets is evolving?
Well, first, I'd like to mention that the global trend of lowering interest rates we can see it also in Russia. I would echo Ruslan with the words of gratitude towards the Central Bank of Russia for its timely and efficient steps taken during this spring when they lowered Q rate to the record level. I see that I could give you the example of how what is the result of these actions. In 2013, Gazprom Neft placed its last 10 years Euro bonds in the amount of I guess $1.5 billion. And the interest and the coupon rate was 6%. And the Russian market nowadays is in such a state that it's possible to issue the same tenor local bonds with approximately the same coupon rate. Well, it was difficult to imagine this 6 years ago. I can see that also that the local market is developing. Last year, we placed 5-year local bond issuance with the call option embedded into it. And in spite of certain, fears that such an instrument wouldn't be interesting for the market, we accumulated more than 40 billion ruble demand for such an instrument. And we saw similar issuances during the first half of this year. In terms of banks, well, we see that the banks have liquidity. We saw oversubscription. We faced oversubscription during our recent tenders for bank financing as well as DCM, as on the DCM market. We also see that the rates are getting lower, and well, it becomes more and more. It may become even interesting option for the companies that historically borrowed in euro or dollars. Well, so yeah, I think. Well, I also would like to mention that our Russian state debt, OFZ, is very popular among foreign investors. The share of foreign investors on the local market again exceeded 30%. And due to the fact that many foreign investors prefer longer tenors, we see that the tenors on the local DCM markets are now available for the borrowers. It's possible for the local issuers to extend it. I already mentioned that it's possible to issue 10 years local bonds. I think it's even possible to try to extend it more. Actually, when we tried 10 years issuance in the end of last year, we also accumulated more than 40 billion of market demand for our papers. So yeah, I think these are the main trends on the local market.
I suppose, I mean, Gazpromneft is a huge, important name in the market. I would expect, in most situations, markets to remain open for you. Do you have a sense of how the local markets are operating more broadly? Are they as open to smaller companies as they used to be, or have you seen less issuance on those markets?
Our joint venture with Rosneft, Slavneft, actually made its first issuances of debt on the local market last year, and they continued this practice in this year. I saw many even non-rated companies which enter this market. I think that the liquidity is here. We have the buyers ready to purchase the papers. So many companies decide to enter the market. And yes, not only Gazpromneft, but also smaller companies which never tried this before.
Right. And Ruslan, maybe if you'd like to comment, what's your thought on the local market?
I think local market at the moment is in a quite good, active, healthy mode. I should tell you that we were going to tap a Eurobond market by end of February, and you know why we had to postpone this decision. So, and we were one of the first company who opened Russian bonds market in post-COVID era. In late April and early May, we placed 35 billion rubles of local 5-year bonds, and from Eurobonds market 1 month earlier in pre-COVID era. So I think the market is in a robust mode. it turned out to be very supportive and a very good substitute when when markets were closed for
the local market before we turn to international.
Yeah, well, I concur with the colleagues that central bank and the Moscow Exchange have done a great job, and the local bond market is really good and helping the economy. Although we as Evraz are not that much present in it, but that's because we are present more on the Eurobond market, and we are traditionally a dollar borrower because all the steel making business is dollar based. But still, it's good for the economy, and it's good for some of our customers in Russia, and therefore it's good for us.
So maybe if we turn to the international markets and to the bond markets first of all, we saw Alrosa this week issue a record low coupon for a Russian corporate. I think 3.1 was the price being talked. It's not unusual to see companies across the globe issuing at record coupons, but that is a very impressive number. Do you see the international markets open? What is your view on them for Russian issuers and you more generally? Rostislav.
Yeah, I think for the top tier borrowers from Russia, the international markets are open as they are. There's been the Eurobond placements already in this year. The interest rates are their historical lows ever. So it's good for everyone who has the requirement for financing and the ability to enter those markets. Well, Evraz is a traditional Eurobond issuer with a long history, but as such we do not have a requirement, and that is led. So there's this situation that when cheap financing is available and abundant, there is less need for it because of lower capex levels and general uncertainty about key product markets. But still, I mean, the markets are available, and low rates are better than high rates for us as borrowers.
Yeah. What about you, Ruslan?
Yeah, I think we will monitor situation, and our next window for Eurobond opens in early August, but taking into account usual market timing, probably we will look at the market starting from September. There is no necessity for money right now, so it's not a must exercise for us. And personally, I'm sure the coupon we observed for Alrosa is not the lowest one for Russian borrowers, and just let's wait and see. For sure, we can go to the market right now under EGS ruling, but we do not want to do that because American investors are very important for us, and we are not in a rush, and we'd rather wait for next 144A window. So we decided for ourselves, we keep doing business as usual. We manage our positions, look for opportunities, and enjoy.
We've got a question from the audience. It's quite spooky not actually being able to see an audience, but it's good to know that somebody's there. What feedback are you getting from international banks? Maybe Ruslan, since you're talking, we can stick with you. What sort of discussions are you having? How are international banks viewing Russian corporates at this point?
We didn't see any significant drop of interest from international banks. During tough months like end of March, beginning of April, when we discussed some potential cooperation, there were some vows from international banks that probably interest rate margin should be increased, but we didn't think so, and time has proved that we were right. So I still can say that there are some international lenders that are underinvested on Russian credit, and on Eurochem credit especially. And I think it's a great time for us, to purchase our strategic opportunities.
Rostislav?
Yeah, we've seen a great increase. We saw a great increase in the interest of international banks towards Russian market in the second half of 2019, and we used that opportunity to cut a very good deal. We signed a $750 million syndicated loan with a number of international banks on very good terms, and we were lucky to close that deal on the 18th of March. So all the credit decisions were taken before the outbreak of the COVID crisis, and if they weren't, there might have been a delay or a high interest margin. Of course, I think the interest is still there anyway, but we were lucky and we did well to close it before the outbreak of the crisis.
Yeah, it's pretty impressive timing. Yeah, right in the eye of the storm. Okay, we've got no more questions from the audience, so I'll just finish on one quick one, which is really it's what's next. We've got through the worst part of the crisis. Hopefully, there might be a second wave. We don't know. What do you think is going to be the biggest challenge for your business in the next 6 months as we recover? Maybe Rostislav, start with you.
It's always the same. I think for Evraz, it's keeping the lowest cost producer position in the ever challenging market environment. Crisis or no crisis, that's the key to success for Russian steel producers, Evraz included.
And Ruslan?
Yeah, I think every company should have a well-articulated mission for itself. And we understand our mission as follows. So we help people across the globe to get access to healthy and cheaper food. Yeah. And in the pre-COVID era, our business was quite boring one, comforting, boring long-term investment because markets they haven't been dislocated for a long time, etc., etc. And at the moment, I think our biggest challenge is to be vaguely right about speed of recovery of the world economy, so that we can fit in and we can keep on doing our mission.
Great. With that, thank you very much, gentlemen. Mikhail, Ruslan, Rostislav, it's been brilliant speaking to you. Really interesting, and thank you to the audience for the participation.
Thank you.
Thank you.
Thank you.
Good morning, ladies and gentlemen. Once again, I would like to invite our next speaker to join us on screen from Republic of Belarus, the Deputy Finance Minister, Andrei Belkovets, to talk about how does the Belarus government plan to navigate its way back towards its economic vision. Andrei, over to you.
Thank you. Thank you. Dear participants of the virtual summit, Bonds and Laws, it's a pleasure to be part of this global event. Maybe we'll start with the small presentation. Right now, I will turn to the screen. Okay. I want to begin by wishing to everyone, for you and your families, health and safety during these difficult times. Today, we're confronted with the challenge like no other. Like everyone else around the world, we have been deeply concerned by the evolving situation. However, we have no doubt that we will overcome this challenge. So let's look at where we stand. There is no question that 2020 will be exceptionally difficult. However, I would like to mention the fact that through the past 3 years, Belarus have built buffers and sound macroeconomic policies, and we have been weathering the crisis much better. In the past 3 years, the Republic of Belarus has seen steady economic growth. Price stability was maintained and debt stability was ensured. Balance of payments stability, debt relief, and the growth in foreign exchange reserves indicate the stability of the external sector. Thus, macroeconomic and financial stability was ensured, and this helped us to cope with the current challenges. So let's talk precisely on the economic side of the situation where are facing now. In the first quarter of 2020, the GDP growth contracted by 0.3%. Both the direct and indirect effects generated by the spread pandemic form a negative impact on the Belarusian economy. Anyway, macroeconomic stability is still in place. Regarding the key sectors driving economic growth, it is worth to mention that the IT sector of the country, construction, agriculture, made a positive contribution to the economic growth. Unfortunately, the main key industries made a negative contribution to GDP, in particular industry, wholesale and retail trade, transport activity. The main reason for the slowdown is the sharp decrease in demand on foreign products market due to the pandemic in the world, as well as disruption in the supply of raw materials, including drop on oil products production. In such an environment, export of goods and services in the first quarter of 2020 decreased by the 11.3%. The reason for the slowdown in export growth lies in the sphere of foreign trade in commodities, oil products, potash fertilizers, ferrous metals. However, despite the decline of export, in the first quarter 2020, foreign trade was balanced. A surplus of about $500 million was formed, which is even better than in the first quarter of previous year. Here, I'd like to mention several positive factors. The growth of export, excluding export of commodities, was positive and increased by the 3.6%. In particular, export of the foodstuffs has increased rapidly. Export of services remained positive. Trade balance of services accounted for $1 billion. More than half of this amount is formed by the trade of IT services. High-Tech Park continues to perform good results. Export of High-Tech Park residents grew by the 66.1% in comparison with the first quarter 2019. We anticipate HTP will further support growth of GDP. The situation with FDIs remains stable. There is no outflows of investments. At the beginning of 2020, inflation in annual terms to 5.4% in April, exceeding the target for 2020, no more than 5%. But in May, this indicator improved to 4.7%. That corresponds to our target, 5% by the end of the year. As of the 1st April 2020, the volume of gold and foreign exchange reserves amounted to 7.8 billion, a decrease of 1.6 billion compared to the 1st January 2020, which corresponds to 2.3 months of import of goods and services. The decrease in the first quarter of 2020 was due to the planned repayment by the government and the National Bank of the Republic of Belarus of external and internal liabilities in foreign currency. As well, the sale of the foreign currency by the National Bank at the auction of the Belarusian currency and stock exchange. Meantime, at the end of the year, we expect that foreign exchange reserves will amount 7.8 billion. Before outbreak of COVID-19, the real GDP growth was planned on the level 1.9% for the 2020. However, such forecasts are unlikely to be realized due to the slowdown in the economic activity seen in Belarus and elsewhere. For the government's expectation or government outlook on economic performance in 2020, it is worth to mention that it is expected that in Belarus, the recession in the second quarter of 2020, primarily in the most vulnerable sectors of the economy, in particular services, transport, trade, tourism, and hospitality. In such circumstances, everything depends on the policy action we take now. In this regards, we see three priorities. First, we would like to continue with essential containment measures and support for the health system. Belarus has not introduced its full-scale nationwide quarantine measures. However, since March 2020, social distancing has been actively promoted throughout the country, including through partial prohibition of public events, adjustment in the schedule of the public transport, and promotion of remote working arrangements. We understand that defeating the virus and defending people's health are necessary for the economic recovery. So we prioritize health spending for testing and medical equipment. A special presidential decision was adopted to financially support medical staff for fighting against pandemic. Moreover, we have already signed loan agreement with the World Bank in amount of 90 million euros to support health sector. We anticipate EIB, it's European Investment Bank, financing in amount of additional 100 million euros to further strengthening the healthcare system. Secondly, we would like to shield affected people and firms with timely, targeted fiscal and financial sector measures. Lifelines for household and businesses are absolutely a must. We need to prevent liquidity pressures and avoid the scaring of the economy that would make the recovery so much more difficult. In regard, a number of special presidential decisions were adopted to support the most vulnerable sectors of the economy, ensure sustainable business activity, and maintain social protection of the population. Thirdly, we want to reduce stress to the financial system and avoid contagion. Monetary stimulus and liquidity facilities play here an indispensable role, and importantly, it would also lift confidence. We are exploring ways to provide additional liquidity support, including the FIS credits line to Belarusian banks. We negotiating credit lines to support the real sector with World Bank, EIB, EBRD, Asian Investment Infrastructure Bank. The 2020 budget is planned with a deficit 0.% to GDP. Due to the measures taken to combat COVID-19, budget deficit, by our expectation, will increase to 2% of GDP. But this additional deficit, we're not going to cover by the new debt issue, but we're going to use our reserves that we have. We realized in the last years, and we will use it for cover our additional budget deficit. The core strategic goal with respect to the public debt is to maintain its manageable ratio to GDP. On the legislative level, this ratio is kept by 45% of GDP. At the same time, Belarus boasts its public debt to GDP ratio significantly below peer countries thanks to a prudent approach to debt management, robust state finance, and flexible choice of tools. In 2019, public debt to GDP decreased to 33.7. As of the 1st of May 2020, public debt to GDP was 33.1. With adequate domestic and foreign borrowings in 2019, all public debt amounts were repaid in full in time. In 2020, for the purpose of the public debt refinancing, the government has plans to raise $1.9 billion of general purpose borrowing funds, of which 0.6 is to be raised via local sovereign bond offerings, and 1.3 via Eurobond, and by the placing bond on the Russian financial market. As of today, we have issued Eurobonds to total amount $1.25 billion. bond on the Russian domestic market. It's $135 million. Bonds on domestic market, $0.2 billion. So we have fulfilled 82% debt refinancing plan for this year. While the economic cost of COVID-19 is difficult to predict, despite the pandemic, the government expects public debt will grow, but will not exceed 68% to GDP at the end of 2020. The stability of the Belarusian economy is also supported by independent assessments. World rating agencies confirm this. The last rating action from S&P was on April 2020. An agency affirmed rating B, outlook stable. In May 2020, Fitch affirmed rating B, outlook stable too. Both agencies noted improved macroeconomic policy in the recent years, prudent fiscal policy, and sufficient level of foreign exchange reserves. That's all for Belarus macro review of me. I don't know yet how our economies and way of life will change, but we do know we will come out of this crisis more resilient. Thank you very much for your attention. I am ready to answer your question.
Thank you very much, Andrei. It's a really interesting presentation. Also, we received a number of questions from the audience. I'll go one by one on each question, but I guess the first question, quite interesting. What's the future for Belarusian borrowers and issuers in Russian ruble market?
We still have the registered program, an amount of 30 billion Russian rubles. We issued 20 billion Russian rubles on Russian market. Is still have a possibility, and maybe I will return to the Russian market in the fourth quarter of this year. And if we talk about our corporates, we know that Eurotorg is the biggest retail of Belarus. Was also looking for the new issue on the Russian local markets. And some of our banks, it's one of the biggest banks of Belarus today, studied the possibility to issue bond. But there are some small problem. That's if our retail issue bonds through the SPV in the Russian markets, our banks want to issue directly, and there is some not like a problem, but there is no experience how to do this, how our banks could issue directly. And that's why today we're working closer with the Russian National Bank and Russian Ministry of Finance, how to manage this legislative gap that we have. But in any case, somehow corporates looking for the Russian market like the priority, because it's more simple for us to issue on the Russian market than issuing in the Eurobond. It's more small amount, and it's the very clear legislation. It's the Russian language. It's all this support to our corporates if they are going to issue. And in any case, the Russian markets clearly understand the economy in Belarus because it's very close, and they more informed than did for example, the Western investors about what's the situation in our economy.
Excellent. Many thanks for that. And also another question that perfectly links with the one you touched based on it on Eurotorg, who has been quite active in DCM market. But are there a lot of inquiries from possible debut issuers and borrowers to come to the market, both locally and internationally?
We're not expected. We don't expect that we could see a lot of new issues, but in any case, we try to push some of them, because we want that our corporates will be more active and not go to the budget or not go to the local banks, but to be active and start to create great history on the external markets. And how we see on the example of the Euroturk, it gives the very good support, especially in this time. There's no depending from the local market only, but it gives the very big possibility to raise the funds on the external market. And especially this time, it's time of pandemic, and when we saw when the external markets was closed, but it was only 2 months. And right now, our last deal that we had the last week show us that right now there are very strong demand for our last Eurobond issues. We have the books that's first time more than we're going to borrow. It's it shows that our corporates also have the possibility to raise the funds and cheaper than on the internal markets, like usual.
Excellent. I guess Euroturks is a good example for most of the issuers in Belarus.
Yes.
So when you give Euroturk as an example to the local banks or local corporates in Belarus, what's their view? How attractive the transactions that Euroturk did, and is there a lot of lessons to be learned from Euroturk's transactions for Belarusian borrowers and issuers?
Example, because first of all, they did the Eurobond issue in 2017. It was the first time when the Belarusian corporate issued Eurobond, because previously it was like a LPN, but it was 28. But after that, there is no any borrower on the market. And after that, they realized on the issue in the Russian market. It's also a good example. And it shows that you no need any support from the government. There is no any limitation about the legislation, because the Euroturk is fully private company. It's 100% private, and there is no any limitation in case of our legislation. It's only how the team of the DCM team of the company will work. And I think it shows that everyone who has the good economy, have the good balance, could also try to be on the market. It's sure that's, and from the side of the government, we are ready to support any borrower. As I by myself, I participated in the issuing of the Euroturk bonds on the Russian local markets. We understood that it's our our national leaders in different spheres, but we're ready to support. Doesn't depend. It's private or it's state-owned. It doesn't depend, because all this give the additional profit for our economy itself. So that's all.
Thank you for that. And the next question, also very interesting. What's the local liquidity situation in Belarus? How well placed Belarusian banks to support the local borrowers and issuers and the economy?
Thank you for the question. It's a very good question. Okay, first of all, we divide this question by two: liquidity in Belarusian rubles and liquidity in FX. Liquidity in Belarusian rubles supported by the National Bank. They made some decision, and by our information that we received from the National Bank, our Belarusian banks has no problem with the liquidity in Belarusian rubles. In FX, the situation is a little bit worse. Because the main problem of our banks is they highly depend on the Russian markets and the cooperation with the Russian banks. And all the situation of pandemic, this lockdown in the Russian Federation have a negative impact because the limits on the Belarusian banks closed or decreased significantly, and it's decreased the possibility of Belarusian banks to raise the funds, because the Russian markets, Russian banks, is the main lenders. Yes, some of the banks have cooperation with the European Bank. It's usual. The European Bank prefer to support our banks through the export credit, not by provide the funds for the common purpose of the banks. That's why the situation of the Russian Federation has a negative impact for our banks. This situation is not critical. Today, our banks is fully paid by the debts. There's no problem. But what's the negative for the budget? For this year, we have to repay the local bonds on amount of $900 million. We're going to raise on the local markets 0.6 billion, 600 million. We issued only 200, and we saw that the Belarusian banks prefer to not refinance this debt, not buy the new our bonds, because they have a lack of liquidity. And that's why there's no problem. We provide this liquidity through the redemption of our local debt that's mostly nominated in the FX. And that's why it supported the Belarusian banks. And also we have a negotiation with the Belarusian bank who have the mother company in Russia. Because 5 or 6 of Belarusian biggest bank, like subsidiaries of the Russian banks. The mother banks provide some liquidity and have success with this negotiation. And that's why the situation is stable, but we couldn't increase our borrowing on the local market. We understood that right now liquidity is not enough to refinance all our local debts that we have. That's no problem. We're ready to wait, and not critical for us, because I have mentioned more than 80% of our plan we realize as of the current day.
Okay, excellent, thanks. And the last question finally. What is the appetite from the international investors and banks towards Belarusian market? You spoke about the Russian banks and the Russian investors' appetite, but how about the international banks' appetite and investors?
17th of the June, we issued the Eurobond. We're going to issue 2 tranches. It's 5-year tranches and 10-year tranches, in total amount of $1 billion. But the result it will be better than we expect. Was better than we expect. We have on the book more than 5 billion bids from international investors and banks, and that's why we decided to increase the level of the borrowing from the 1 billion to 1.25, because we decrease the rate during our book building for the 50 basis point. It's a very good result in the current market, and the book it's first time oversubscribed. I think it's like a very good sign that the international investors are very confident about the Belarusian risk. They like the Belarusian debt, and like example, in the 10 years bonds, more than 60% it's American investors. It comes from the United States. In the 5-year, there's around 45, if I'm not mistaken. But in any case, we see the very strong demand from the side of the U.S. account, from the side of the United Kingdom and the Germany, the main investors, and 5 times oversubscribed. It's like it's show this confident more than my words. It's the figures.
Yeah, absolutely. Has been a fantastic discussion and then presentation, Andrei. It's a pleasure to have you as always.
Thank you.
Many thanks for your time. For our attendees who would like to speak to Andrei, please search for his name in People's tab and then message him directly and then arrange a video call with him. I'm sure Andrei will be happy to answer your queries directly and have a video meeting with you. We will start with our next session in 5 minutes. It will be about the supply and demand dynamics in the Russian loan market. For now, we're going to pause, but we'll be back in 5 minutes. Thank you.
Thank you. Thank you. Yeah, bye.
Good morning once again, ladies and gentlemen. I'm pleased to welcome to our next panel about the supply and demand in the Russian loan market, which is moderated by Evgeny Gaevsky from ING Bank in London. Evgeny, over to you.
Good morning, everyone. First of all, thanks a lot for JFC for the organizing this event. I think that's extremely
helpful for the people all over the European and Asian and Latin markets to get together and to listen the latest news and what's going on in each part of the world. And let me introduce our panelist. It's Anton Kukoba, head of syndicated lending and structuring at Raiffeisen Bank in Moscow. Sergei Voronenko, director, lead analyst for the financial institutions and Standard & Poor's global ratings, and Ivan Dun, managing director, head of loan syndications and international finance in Gazprom Bank.
Good morning.
Good morning, everyone. Thanks for joining the panel. So let's start. I think it's probably fair to say that 2020 is likely to claim to be the most turbulent year over the past decades. And with all the events like Brexit happening, the oil price and battle, trade wars, and finally the pandemic, which we are all facing across the continents. And that's obviously had an impact on the economy of the Russian Federation and the relevant financial markets. And let's see what's happened over the last 3 months and how the banks behaving, how the borrowers behaving in Russia. Yeah, the impact was not unnoticed, and obviously the industrial production in Russian Federation dropped as a single-digit number over the last few months. However, we've seen a slightly worse effect in most of the European countries and the US, where the drop was pretty much as double-digit numbers in most of the countries. But what's happened with the syndicated loan markets? That's a hot topic for us for many years. And basically, if you look at the numbers provided by Dealogic, surprisingly, the Russian market grew by about 50% over the nearly 6 months of 2020, while the European market at least stay relatively flat. So what's happened? Is Russia doing better, or is Russia doing worse, or it's a plenty of the state support? So let's ask the first question to the panelists. Do they see a lot of support provided by the banks during the COVID-19, the sort of called COVID facilities that we've seen a lot of them in Europe? Do we see the bank's behavior on the challenging markets? Anton, do you want to kick in?
Yes. Hi, everyone, once again. In wide brush, I would answer your question about Russia, that Russia is doing all right, as always. There is a joke in Russia, you all know this one. When it comes for the word crisis, the usual answer is crisis. Which crisis? We never heard of. This is a joke, but partially unhappily a reality. So I would say that my personal observation of current standing of things on the market is the following. You know that banks are always rumored, and Russian banks are not an exception, and foreign banks in Russia are not an exception, are always rumored to be turning their backs to the borrowers in times of a crisis. I think that this is not the case during this crisis for sure, and I'm confident that this opinion will be supported further by figures. Sergei will be presenting about stats of CBR about lending activity in Russia. And yes, and here today we're talking not about SMEs, we're talking about large corporates, right? Because most of us here are syndicators, and we're talking about syndicated loan market for large corporates only. So it's not turning back at all. Lending is still there. And I think that the case was during 3-4 months for the banks, turning not 180 degrees, but turning 360 degrees, so turning around, which took some time, meaning that we all had to do our home task and exercise, which is a usual one. when such dramatic things happen on the market, with the worldwide very low activity in general, immediately, right, hitting everyone. We have to do our stress tests. We have to reconsider some approaches. We during this time we had to adapt to a new reality, which is being not office, and it led to some not hurdles, but some things, some new things we had to face. As for syndicated loans, I think that comparing this period year to year, we'll see that syndicated lending volume even grew slightly, which is an evidence of what I've said, that activity is still there. And again, with syndicated loans, it's a bit there is a specific, right, that we have to pre-cook deal and then cook it to the end. I mean, syndicated loan with 3 months, like on average, compared to a regular bilateral loan, which a bank can give within 2 weeks. So those deals, number of deals pre-cooked in the end of the last year and maybe early this year, before COVID broke out severely, those deals lasted, and as a result, you know, like a locomotive, like a big heavy train, you can stop it. You can't stop it, but it will keep going. I think this was the case for those huge jumbo deals of Russian borrowers this year. But again, we now see that there is a pipeline of deals. Banks are lining up to lend, and I would say that there is definitely oversupply on the market with ample liquidity. But this is another question. I think we'll touch base on this one a bit later.
Ivan, turning back to you, do you see a lot of you as a sort of quasi-state-owned bank? Do you provide a lot of support to the Russian blue chip names? Do you feel the state backing up you in this initiative as well?
I think throughout that period of the past 3-4 months, all banks in Russia, including government-owned banks, were passing through certain stages. So the first one was then everybody was a bit in the shock, assessing what's going on, doing stress analysis, as Anton mentioned, and also revising its capital and balance sheet position, because there was a movement in foreign currency exchange rate, which affects equity of Russian banks, CB regulated banks, if you have foreign assets. So that has certain effect on available risk-weighted assets to be allocated to clients, and also there was an effect on the pricing, both on ruble side and USD and euro side. It was an upward moving at a certain point in time for all Russian banks. So after that period, banks moved on to a stage where everybody got more comfortable with the situation and got more active in providing loans to current clients and also some new clients. I'm talking large corporates only here. And in terms of government support, there were a few programs enacted immediately, and those programs were aimed at helping industries and companies affected by COVID-19 consequences. And these mainly are, the way it's done, Ministry of Finance and other ministries, relevant ministries, allocate certain chunks of support in form of subsidized interest rate. So it's not liquidity, because I don't think we need liquidity as such. It's more state subsidies of interest rates for the relevant industries and clients. And in some instances, they might cover off part of the credit risk for the loan by VEB. But this is a much more difficult part. And I think we have seen an injunction of a few billions, in that a few billions US equivalent in this form for the last few months. And I think the banks are now trying. So there are certain limits imposed on the certain. There is a limitation in period to implement and to take out those loans for the borrowers, and to banks for banks to extend them. So all banks now are working hard on this task. That's I think in a nutshell.
Okay, good. Thanks, Ivan. Sergey, how you can commend the measures of the Russian state support vis-a-vis probably some other European countries? Do you see a big difference in sort of direct support or indirect support?
Yeah, basically this year, the resilience of banks' asset quality largely depends on the success of the governments and regulatory policy responses. And these measures are still at early stage for us to estimate the effect. So far, if we compare announced support measures in Russia, I mean the fiscal stimulus and contingent liabilities in terms of the guarantees, as was mentioned earlier, it is around 2 to 2.5% of GDP. Most countries announced varying degree of support. For instance, in India, it is pretty much the same, like 2.5%. In Brazil, it is almost 6%. In Czech Republic, the fiscal package is about 5% of GDP. In France, fiscal support is 5% and bank loan guarantee is around 14% support. So it differs because the shock is different from one country to another. Russia's large state banks, Sberbank and VTB, which together represent almost 1/2 of domestic credit to the private sector, will greatly influence the direction of the banking industry and the ultimate level of system-wide problem essence, and as a result, the potential need of a state support. The regulatory response has not so far included using the banking sector to cushion the economic effect of the pandemic. However, given that about 65% of Russian system-wide banking assets are controlled by the government, I would anticipate that the largest state-owned banks, because of their closer ties to the government and because of their size, because they have capital, they will likely have to provide the most relief to the entities, to the most important sectors of the economy and the hardest hit by the containing the pandemic. And another form of the state support to the banks specifically is regulatory forbearance. And easing in regulation and provisioning could help to stabilize the borrower's credit worthiness in the viewing of the banks and ultimately prevent some default cases as well. However, this kind of support would likely become more difficult to justify in a longer run. So we all assume that our economy, the world economy, will start to rebound starting next year. And the banks, of course, can live in a parallel reality as they lived in 2015 with a fixed rate regime for calculation of regulatory ratios. But how long? And I would here be mindful that forbearance measures could ultimately result in a difference between the provisioning levels and the economic reality, distorting the true picture if the situation could worsen or the recovery could be delayed.
Okay, great. So it's a different types of measures, but ultimately we may end up in the same situation as other parts of the world. Can we look at the bank's behavior? Basically, over the past crises, we've seen the different behaviors of different banks. The banks are withdrawing from the international finance and focus on the local markets, and etc., etc. So, Anton, Ivan, Sergey, do you see the difference in the bank's behavior? As banks stop lending, they lending more, they taking a different approach. If we have representative of 3 different sort of lenders types and the bank's analyst. So, Ivan, do you want to kick in?
I think I have seen that the banks, for the time being, a lot of Russian banks tried to stay away from actively lending at some point in time, and everybody, when there was a collapse in the public debt markets and equity markets, everybody was looking after it and watching closely. And at least a lot of Russian second-tier banks at that point in time preferred, for instance, to build up their HTM positions with Russian names rather than extending loans. So I think that there was that point in time, and of course the banks have been revising what they're doing, as I mentioned earlier, doing stress analysis. We're busy doing stress analysis and also assessing how much provisions they would need to create this year on top of what has been planned before the crisis evolved. So that's what we have seen until recently. What I can see now is that many banks, looking at their financial results, perhaps management gets unhappy, and if the bank has no RWA constraints and capital constraints, they are being pushed to get out in the market and lend as much as possible. And what I think we need to differentiate now between is the local currency lending market and foreign currency lending market. So these are pretty much different. And if we see the interest rates going down in the ruble market, in the foreign market, they're quite flat. And despite the LIBOR going down, I can see that the cost of funds for Russian banks has not gone down in absolute, in fixed terms, at least so far. Russian ruble rate, this is also an interesting point. We do not see 100% correlation. So the correlation is less and less with the CB rate going down lower. So basically, in my view, the real cost of funds of Russian banks is linked less and less to the CB rate, at least on the longer term funding end. And this is actually quite well evidenced by the Russian ruble bond deals that we can see in the market. So if corporates manage to get deals at very low rates, I don't think you will see a lot of volumes at competitive rates coming out from Russian banks in the ruble bond market, which of course affects the cost of funds for many Russian banks.
I can add here just like view of foreign bank being having quite strong positions in corporate lending and other things in Russia. I would say that, like, again, in wide brush. And yes, firstly, I agree with Ivan that market is really fragmented. And when talking about lending for Russian corporates, we should distinguish local ruble lending, which is competing with, first of all, state bank lending via bilaterals and ruble bond market, which is now heated up for sure with low rates. And we have, let's call it foreign currency market, which is again DCM part Euro bonds, quite active these days, and I think that shock there has passed already. Yes, lending via syndicated loans, those jumbo deals, 1 billion, 2 billion USD coming from foreign banks, from headquarters mainly under English law. I think that, again, driven by this ample liquidity, we bankers, we have to find balance between being brave enough to lend, to place that ample liquidity, right, and facing the reality that recovery is something which is a must for everyone, not to mention the yield. I think that this balance on the current market can be found, not easily, but this is something which we can do. And talking about foreign banks are still brave enough to keep lending in Russia. There is a certain trend. Ivan mentioned that some Russian banks slowed down lending per se a bit, buying ruble bonds in their investment portfolios, which is like not a lending, but placing liquidity in same names with more or less same ruble yield, but having it not as a loan portfolio, but as a bond portfolio investment one. I think that with all this said, I think that there is going to be really stiff competition on the market between foreign banks, Russian state-owned banks, and for sure we're going to compete with DCM market, which is a good place for any borrower to be, seeing banks pushing elbows with each other and trying to win in this situation.
Yeah, thank you, Anton. Yeah, I think from my end, I would like to add that, yeah, indeed, we, unlike in the previous crisis, we see quite a really few departures of international banks from the Russian markets. Most of the banks are still, international banks still continue to lend. Yeah, there is some impact on the pricing, maybe on the preference in the ticket size and the volumes, but we don't really see sort of the massive exodus of the international banks from the Russian markets. And some of them, as I said, slightly more cautious, but general. Post sort of COVID in Russia, we closed at least 2 proper syndicated facilities, which were not COVID related at all. The appetite for both transactions was sort of in line more or less with an initial, even pre-COVID expectations, which shows again the sort of resilience of the Russian market, at least for the top names, for the blue chips. Turning back, there was a question from the audience already about the Russian project factory, which is run by VAB. That's probably the extension of the comment which Anton made at the very beginning, because the generally syndicated loan market is quite inert. It will take few months for the banks to put together a transaction. I think when we talk about the project finance, this period is even longer. So from my point of view, even we are not sort of a party to this project, the life cycle of the transaction is about probably 12 months. So I don't think we will see the impact as of now, but we may see it in a very sort of longer period. But I would like Ivan or Anton to make a comment here, and if possible, as a banks who are physically based in Russia and participated. Some of them have participated in a projects factory.
Yeah, I don't think actually COVID would affect project finance factory and project finance as a segment of the lending market, save for natural effects related to revision of some of the macro and economic assumptions on the specific projects. But I think that fundamentally it would not affect the decision, go or no go decision. It will just can delay some projects. But again, I suspect that those delays would not be for years. These would be rather for months if the projects are in a good to go stage. If not, then I don't think those that were planned for execution in 2 years would be put in place in 2 or 3 years, but they will not be abandoned at all, because fundamentally, I don't think the projects that they are now in the pipeline, they would be affected to the extent to be stopped.
Yeah. Thank you, Ivan. So we talk about
I think that the factory. Sorry, one thing here. I think that this is a perception of, again, of a foreign bank of the factory here in Russia. I think that factory is a must instrument nowadays, and I think the whole market has waited for such infrastructure, let's call it this way, of such to be dealing with the project finance as a complex solution, meaning that we can have VEB's expertise, equity participation, AC, etc., and long-term funding in the first place, while there could be a structure with a certain tranche with a shorter tenor, which is for purpose made for commercial banks to participate in. Because we all understand that project finance structure, tenor, yield from VB's and state bank perspective is far away from something which is a usual structure for a foreign bank or from commercial or for a commercial bank. And under this VEB project finance factory umbrella, I think that we can have a good output of a good flow of project finance deals in Russia.
Evgeny, can I have a quick question to you? So I think there was a question from the audience about the level of international banks lending in the Russian market. I think you responded to the volumes thing, but maybe there was also a question about the pricing. So can you comment on the deals closed post-COVID, at which level they were closed? Because I think I have seen some increase in the all-in rate.
I think if we talk about the pricing, there is definitely a change in environment compared to what we've seen in end of 2019, and I think the market was too hot, and the COVID was an ease, and not only the it give it another push for the banks and for the borrowers to reset this thing, as we say. But indeed, there is a price uptick on the market. I think there is a difference for the different currencies. I mean, I would leave the comments on a Russian ruble situation. But if you talk about euros and dollar, there is definitely price uptick in euros. Even sort of it's relatively moderate in my view. There is a higher uptick for US dollar financing, and as we've seen on the recent deals, indeed the banks are forced to increase the pricing, and the borrowers are forced to accept the increase in pricing. And there are different reasons for that. I mean, for dollars, as we've seen in many crises before, the European banks are normally don't have a natural dollar. They need to borrow dollars from the US. And in every crisis, there is a premium for US dollar funding for the European banks. And whether we like it or not, but European banks provide the majority of the liquidity for the Russian blue chip names. I think it's year to year, it's always more than 50%, with the remaining 50% being the Chinese, Japanese, and US banks. I'm not talking only about the syndicated loan financing. So from that point of view, yeah, definitely the Russian borrowers feel this price uptick. But on the other hand, if we look at the base rates, yeah, at the end of 19, the US dollar base rate was about 2%. Now it's dropped, not to zero, but definitely below 0.5%. So Russian borrowers had a benefit of about 1.5% drop in base rate, while the increase in the margin is probably not as high as a drop in the base rate. So there is definitely change in the pricing. But if you look at the all-in situation, I don't think there is a massive difference to what we've seen before. So the credit spread are wider, but by base rates are lower. Yeah, while we're talking about the funding, how liquid, I mean, we've talked about the different banks, the Russian foreign, Russian private, Russian state-owned, the Russian ruble market, Russian ruble bond market. So the question, and we heard earlier from Sergey that there is not a lot of direct liquidity support to the Russian banks. So my question would be, how liquid are the Russian banks, and where are they sourcing the liquidity? Sergey, do you want to start on this one?
Yeah, probably. I think that it was already mentioned that Russian banks, especially large Russian banks, started this year with a stronger balance sheet that they had in the previous decades, which had been strengthened by their capital and liquidity ratios. And in addition, in Russia, during the past few years, the troubled institutions have been bailed out. It is also good for the healthiness of the banking sector. Also, access to the external funding remains quite limited because of still persisting economic sanctions against Russian several large banks and corporates. But the funding stability in Russian banking sector has recently improved substantially, supported by the stable and growing domestic deposits. But funding is also the question of the demand for the credit resources. In the current conditions, the banks don't have effective instruments to deploy, especially their FX liquidity, and in many cases, even ruble liquidity. And that's why, despite severe volatility on the markets, we observe continuing decrease in the bank's funding costs. And in 2019, corporate loan book of Russian banks grew by about 9% and 5% in real terms. For this year, we expect that Russian banks' new lending will slow to close about 0% in corporate segments, which is net of FX revaluation and inflation. This is the question that after 2014, large Russian corporates transferred their solid cash balances from international banks to the largest domestic players. And in this sense of the sluggish demand for credit activity and economic contraction, and we project economic contraction in Russia to be around 4.8% this year, the banks are fine with their liquidity buffers. And in the longer run, this was caught in the question of the capacity of the largest banks to finance economic activity as soon as it starts again. And local funding sources might not be sufficient to support Russian banks' business growth because they still remain quite limited, underdeveloped, short-term, and volatile. And this is the historical weakness we should live in and we should accept it.
Thanks, gentlemen. Unfortunately, we have run out of time. Thank you for the excellent discussion. For those of you watching who would like to follow up with any of our speakers, please contact them directly by going to People's tab and searching for their name. I'm sure our speakers will be happy to answer your queries and arrange a video call with you. Many thanks, gentlemen.
Thank you.
Thank you. Thank you.
Bye.
I would like to invite our next speaker to join on our screen from Republic of Estonia, Martin Roos, Deputy Secretary General for Financial Policy and External Relations. Martin, it's a pleasure to have you here today.
Thank you. Thank you. Welcome to all listeners. Am I heard? Very
Yes.
good. Very good. I will spend next 25, 28 minutes then trying to explain what are the thoughts on Estonian economy, its COVID response, and what are the potential outcomes for the financing needs. I will share also with you some slides. And just to start with, I would show the picture of Tallinn. What might be a good illustration also how we balance now in this strange new COVID, post-COVID world. But anyway, four questions I'd like to answer in this session is first, what has been the impact of COVID crisis to Estonian economy, but not only COVID crisis itself, but its linked economic shocks to Estonian economy that is maybe more permanent and more interesting. Then secondly, of course, this is linked to the question how we have responded from policy side, then on how the forecasts have been forming for next year's, and then also a few words on our capital market approach. Well, to start with, I'm not sure whether it's that well known to all of you. Therefore, I will kick off the presentation with a couple of the basics on Estonia. We are a small, we call it Nordic Baltic country. But in the COVID context, there are two aspects that are maybe important. One is that we are smaller by population than by territorial size. And in the COVID context, this relatively low population density has turned out to be maybe even a positive factor. So you could say that in the age of expectations of some physical distancing, the space is good. And indeed, that's what here is. Another aspect from the basics and what is very important in the COVID context, I think, is that we are already, you could say, soon several decades members of the European Union and the, more importantly, free movement of labor and goods and services area, including Schengen. And this has been in the context of COVID, of course, one of the biggest hurdles, or how to say, the biggest shock than the outright problems with the with the manufacturing sites, etc. The bigger question mark is how these free movement of labor and free movement of goods continues to work in this post-COVID world in the future. It has been maybe quite a big problem to see how the connections have slowed down or even squeezed, particularly in terms of people moving. But we of course expect this to return to normality soon. It has already been liberalized, on that few words, soon. We entered the COVID crisis with very solid background. We had very boring years behind, where our macroeconomic experts became more and more worried that they couldn't really sound enough alarm to the bosses and to the outside world about the imbalances, because the economy was quite well balanced. The financial system was quite well balanced, and the not maybe surprisingly, but also the government finances were quite well balanced. We have had a long tradition of balanced budget approach, not always as punctual as some think, but still the result is that we have entered the crisis with less than 10% government debt from GDP. Similarly, the capital buffers of the financial sector were one of the highest in Europe. Importantly, we had been seeing for a couple of years reverse migration flows. We had our own fair share of immigration problems in post-financial crisis period, but over the last few years, you could say that the flows balanced so that you could say that no extra burden was coming from the labor market. And all in all, with relatively well-diversified economy for the smaller size as we are, indeed no single sector or no single institution having a critical effect on economy, we with these migration balances, with no extra bigger immigration flows expected, we had a kind of relatively balanced outlook with, this is always tricky, but about 2.5–3% medium-term potential growth assumptions. Well, with some pictures to explain it, on the left graph, there is a growth history of last decade. We had the same cycle as Europe in general, but rather solid last years before the crisis. And also, importantly, I would stress on the right-hand side that economy generated fair share of investment as well. Not excessive, roughly quarter of economy was fixed capital formation, but still enough to say that we see ongoing growth potential, productivity improvement potential evolving. Importantly, I would still say that maybe it's even good that we didn't have too big share of fixed investment in economy, as it might actually reflect the quite important share what both public but also private investments have put on, namely the aspect of non-fixed capital formation. So human development was quite important from schooling, training point of view, but to some extent also from the research and development. One aspect was so when we entered the crisis, important to mention here is the external viewpoint. We had the relatively well-balanced economy also from external point of view. Some would of course say that as on the right-hand panel there is this thick line is describing our rather persistent, not peak, but rather persistent current account surplus over last year. Some claim that this is not only good news because it might show that there is even bigger possibilities to have investment, because we are still converging economy, we think. But still, in this context of COVID type crisis, of course, it was good to have a relatively balanced external position, so that you don't at least have to worry about refinancing of your economy from that angle. And from the left side, you could also point out that importantly, we have had also fair share of economy dealing with the, let's say, non-goods investment, IT related investment, IT software development, supporting schemes, etc., that have gained quite a big share of already of economy. And one could assume that in the world of COVID-like economy, or post-COVID or COVID time economy, one area that is less hurt is potentially the ICT services. So in that sense, maybe structurally, we were also fairly well placed when we entered the crisis. Now, what was the policy reaction? What policy reaction? We have tried to be humble in that sense that, of course, we were in lucky position in that sense that we were not hurt first in Europe by the disease, and we could have at least few weeks to learn how to react from some other countries, fellow countries that maybe suffered more and had to learn more by doing. Therefore, we actually, when the virus reached our soil, we were ready to act fairly fast, moving pretty soon to relatively solid physical distancing regime. Firstly, of course, moving towards closing museum theaters, cinemas, spas, swimming pools, these kinds of aspects. But also important element in the strategy was moving schools and universities to distant working or distant learning regime. This is important because one should recall that schools are important not only as an interaction of the pupils, but also it's linked to how the families behave and how free, for instance, families are to move to distant working. So in this combination, we had relatively fast switch, both in kids level, but also in the adult level, towards widespread distant working and learning regime. Border controls were introduced, etc., but of course not closing the goods transport. And all in all, with these steps, you could say that we had a fairly fast and solid closure of economy, but not excessive. We managed to keep most of the manufacturing open. We managed to keep much of the schools working. We managed to keep much of the, let's say, non-physical work ongoing, because the society switched rather fast to these kinds of new ways of handling business. And therefore also the disease was contained relatively fast. and the government could manage to start reopening as planned initially, roughly 2 months after the first steps taken. We still have some limitations on, but within weeks, most of these limitations will be removed. Also, not all the public gatherings, etc., but generally. And still, we have to say that fortunately, the COVID itself has behaved rather well over last weeks. So rather rapid and solid reaction was behind this success. What was the economic response in short term? Of course, there was April was having very big declines, 15 to 20% in industrial production year to year. Maybe less so in electricity consumption as an indicator. Of course, hotels, spas, these were pretty much closed fully, and roughly a quarter of employment was on leave or on temporary unemployment benefit schemes. However, this is not necessarily worse than we expecting during the start of the lockdown, rather to the contrary in the beginning. But now I think the trickier phase actually starts regarding the forecasts, how this rebound works out over next quarters. In this context, it's important to also note that we had a fairly forceful budgetary reaction in April, introducing roughly 10% of GDP tools into economy. Of course, rolling out of all these big sums is not exactly going as fast as maybe some expect, partly because the demand is smaller than we expected. But in some elements, for instance, the unemployment insurance scheme support elements and some of the support schemes to the most hurt economies, the rollout has been as expected and has supported also economy quite well. Now, from this, if you ask what's next, we ourselves, from the ministry side, we penciled in a growth forecast in April with 8% decline this year and roughly 8% growth next year. So relatively strong rebound, but not full reversal to the trend. The graph shows nominal growth, so that's why the next year rebound in numbers is a bit bigger, but it's not the real growth, just for diversity, showing some other aspects. And another assumption in this context is that, roughly speaking, medium-term growth potential is assessed not to be hurt as well. So after this rebound, productivity improvements will continue as assessed before, and we'll see return to this kind of fairly reasonable growth assumption that that the economy like us could see. But indeed, I would say that this is unclear whether it's assumption or is it assessment, because indeed it's the interesting experiment now to see how the productivity improvements behave over next years. On one hand, of course, you could assume that the productivity should be hurt in economy. All the airplane issues or how the hotels will be fulfilled, etc., etc. On the other hand, of course, you could ask whether this shock actually increased productivity faster in some elements like e-commerce, or why not even the same schools. There was a lot of discussion about moving more to e-training in the school system before the crisis. Now, basically, pretty much overnight, it happened. And we'll see. It might be that in some elements, there actually will be even productivity enhancements. And anyways, of course, about the forecasting, then the big question is the more regional context. We are a small open economy. Central bank, for instance, revised a bit the growth forecast to -10 for this year, but not from internal aspects, but primarily from the assessment what is the external environment. And therefore, our forecast is half our own forecast and half it's the global or at least regional forecast. So any guesses how to make the credible regional economic forecasts are very welcome. But we are assumed return to, let's say, pre-crisis growth rate, probably in the lower trend. And now, in this context, how we are dealing with our financing capital market approach, then of course I will return now to the situation what we had before the crisis. We have had such a good fiscal prudence before the crisis that due to low debt levels, there is not much short-term refinancing needs for economy and the government particularly. So we are relatively free to choose how to plan our next steps. On the other hand, of course, we entered the crisis with a rather forceful fiscal move, and therefore we have financing requirements this year and next year. Including other aspects, we have not really cut the expenditure expectations, including investment. So we had already fairly high general government investment rate, actually one of the highest in Europe before the crisis, and we expect it to be kept, including via front-loading some of the more medium-term investment projects. And in numbers, it shows up this way that we expect this and next year's combined financing requirement to be roughly about 5 billion euros, about 3.5 this year and the rest for the next year. And from this year's funding, we firstly covered 1/3 with the institutional borrowing from so-called IFIs and from local market. And then recently, a few weeks back, we entered also the Eurobond market, first time in almost 2 decades. That was very successful. We actually increased the offer so that we have clearly achieved 2/3 of our financing this year, maybe even more. So we are pretty free to choose now the next steps to approach. We are in the diversified strategy mood, looking around and trying to combine both external and domestic market approaches next year's. I think I'll stop here. Thank you very much, and maybe move to questions if there are.
Many thanks for your time. You know, it has been a really interesting presentation. Unfortunately, we have run out of time. Thank you for the excellent presentation. For those of you watching who would like to follow up, please contact Martin directly by going to People tab on your main menu and searching for his name. I'm sure he will be pleased to answer any follow-up questions you might have and to meet with you by video conference. Martin, it's a pleasure to have you here today. Thank you. Now I'd like to invite our next speaker to join on screen from Ministry of Finance of Republic of Slovenia, Marjan Divjak Director General, Treasury Directorate. Hi, Marjan. Hi, Marjan. It's a pleasure to have you today.
Thank you very much. It's my pleasure to be here. So thank you for inviting me to speak on this virtual conference.
Thank you.
Sunt blizu, Martin. Huh? Is what real? Spravi, jaz si bom nekako mogel to prezentacijo rolati, ne? Smo že živo? Že. Okay. Začnem? Mislim, če bi. Bomo videli, da smo živo povedal.
Marjan, you can start when you're ready.
Dobrze. Zdaj se premikam dol tukaj, ne? Hello, it is very nice to be here and to actually have opportunity to actually deliver Republic of Slovenia presentation. It is adapted to the time which we have available. So greetings from Ljubljana. So Slovenia is a very small open economy. It is situated in the very heart of Europe. It is member of EU, NATO, Eurozone, OECD, and is member of the Schengen area. Obviously, during these times, it is appropriate to start how we are dealing with the COVID situation in Slovenia. Need to say that the picture comparing to the severity of the problem around the globe is rather favorable in Slovenia. Slovenia was one of the first countries which declared an end to the epidemic and actually returned to rather normal life. During this period of 1.5 months after the Republic of Slovenia government started to reopen the life in Slovenia, if I put this way, situation is stable, where we observe new cases. Newly infected inhabitants of Slovenia. Where the picture is very good. So I believe it is right that I start with the picture pre-COVID-19. This is end of 2019. Slovenia went through, I would say, very thorough reform process, and macroeconomic picture in Slovenia significantly improved. Slovenia was one of the fastest countries in the Eurozone, reducing the debt as a percentage of GDP. Slovenia had 3 years in a row, 2017, 18, and 19 budget surplus. So the debt went down to 66.1% of GDP. So the general surplus was 0.5% of GDP in 2019. So the picture was good. The foreign or external position of Slovenia is very strong. Current account balance or current account surplus at around at 6.6% end of last year. So, but then the COVID-19 happened, and everything changed completely. So Slovenia entered the COVID situation in fairly good shape, but the government, which took office in March, beginning of March, immediately actually took very serious steps. First, to stop or contain the epidemics. In this context, Slovenia was one of the most successful countries really doing that, and then actually proceeded with measures to contain the economic or impact of COVID for Slovenia economy. So the first was to manage the healthcare of Slovenia population and to preserve growth potential of Slovenia through actually preserving jobs, to actually stabilize the revenues of the population. So in this context, Slovenia government adopted three packages to deal with COVID consequences for Slovenia economy. So the first was actually to deal with labor market. Actually, it extended compensations for temporary work layouts, where the Republic is paying 80% of the salary, but not less than the amount of minimum wage in Slovenia. Also pays the government pays the social contributions to the amount of minimum wage in Slovenia, and actually provided basic income for self-employed people in Slovenia. It also actually extended one-off solidarity payments to pensioners, students, and other vulnerable groups in Slovenia. So the second package followed, and the most important feature really of the second package is the guarantee scheme for working capital of Slovenian economy extended by Slovenian government. In this context, the Republic is to guarantee up to 2 billion of loans banks are to extend to the economy, where 80% of the principal is guaranteed for large companies and 70% for small and medium companies in Slovenia. So the third package was actually dealing with the shortcomings of the first and second one, where certain measures were extended and actually moved from let's say more static measures to measures incentivizing actually companies and employees to restart activities. So one of the most important, I would say, or very important features of this third package are so-called touristic vouchers. So adult inhabitants of Slovenia will be able to actually spend 200 euros in Slovenia touristic destinations, while inhabitants younger than that 50 euros. This should help Slovenia tourism industry, which represents at around 10% of Slovenia economy. Maybe information on Slovenia rating. Slovenia is having AA- rating with S&P, with stable outlook, A rating with Fitch, with stable outlook, and Baa1 rating with positive outlook with Moody's. The rating is rather split, and is coming from the period when Slovenia was in fairly difficult situation, and different rating agencies were assessing Slovenia credit differently. So recently, rating agency S&P approved Slovenia AA- rating with stable outlook. So S&P actually is forecasting Slovenia economy to contract for 7.8% of 7.8% this year. This is at similar level as our governmental institute is estimating what the contraction of Slovenia economy supposed to be this year. S&P is very much in line also regarding the deficit and the debt level. Need also to say that these are rather conservative estimates for Slovenia. There are other forecasts how Slovenia economy and Slovenia budget will be doing this year and next year, and are favorable, more favorable than these ones. So the most favorable actually estimate is of OECD, which is forecasting 5.5% of contraction, GDP contraction for this year, and 5% increase next year. So again, this is something about fiscal track record of Slovenia after the period of, I would say, large fiscal deficits. Slovenia was able to consolidate public finances and to reduce general government debt significantly to 66.1% of GDP last year. This year, general government debt of Slovenia is forecasted at 82.4% of GDP. So what is important for Slovenia at this moment, that the banking sector is robust, structure of assets is good, the credit quality of assets of Slovenian banking sector is good, loan to deposit ratio is 72%. Banks are also highly capitalized and highly liquid, so a very good position to actually support the economy during these times. It very much depends, of course, on business policies of banks, how they are to actually extend credit in this crisis situation in Slovenia. Need also to point out that Slovenia Development Bank, SID, is in a very good position to act counter-cyclically, to actually deliver credit in those, let's say, most important segments of market. Balance sheet reduced significantly of SID Banka, plus that bank is highly capitalized. So economic performance in Slovenia during last years. We also have figures for the first quarter of this year. The GDP contracted 2.3% in the first quarter of this year. Seasonally adjusted, this is minus 3.4% or 3.4% of contraction, where if this is compared to European Union, this is slightly above if measured seasonally adjusted, where European Union economy in the first quarter contracted for 2.6%. So export actually in the first quarter declined 1.6% compared to the first quarter of last year, while imports reduced for 2.5% compared to first quarter of last year. So external position of Slovenia because of this positively contributed to GDP in the first quarter. So of course domestic expenditure reduced for 3.1%, where final consumption actually reduced for 3.1%. Gross capital formation reduced for 3.3%, where government spending increased in the first quarter of this year for 5.8%. So what you can see on this slide is the external position of Slovenia. Slovenia is forecasted to have wide current account surplus in the next years. You can also see that Slovenia export is highly correlated to EU economic activity, where if we compare to previous situations, Slovenia export reduced less than this would be actually assumed from the EU GDP drop for the first quarter of this year. So as I said, Slovenia is very small and very open economy. Exports of goods and services were almost were 84.4% of GDP last year, while import was 75.3% of GDP, and this is where this rather wide current account surplus is coming from. So main export partners are Germany, Austria, Italy, Croatia, and France. On the slide, you can see what is the composition of Slovenia export of goods per sectors, per geography, and so on. So there are other very important things to say about Slovenia economy. So the labor force is well educated in Slovenia and productive. You can see where we are regarding the real labor productivity per person employed on the graph above. So we are below Slovakia and Czech Republic, but well above Italy. Unemployment rate in Slovenia is rather low. It went down to 4.6% end of last year. We expect that the unemployment will remain contained this year and to reduce again in 2021. It's also very important that employment, as you see on the graph, increased in Slovenia significantly. In the industry production index in Slovenia is also favorable. It reduced in the first quarter of this year less than in countries like Germany, Italy, and France. Need to say that industrial growth is driven by high and medium technology intensive industries. This segment of manufacturing is increasing in Slovenia year by year. Also, foreign direct investments in this sector are on the increasing side, where manufacturing represents close to a quarter of gross value added of the Slovene economy. So the recovery and actually economic activity is actually going without inflationary pressures. So inflation is similarly low as in other European countries or Eurozone, better to say, countries. So what you can see next is indebtedness of Slovenia. Slovenia stands in the middle of the Eurozone countries as per last year. Very important is to say that private sector debt is lowest among Eurozone countries, and that gross household debt to income ratio is at 45%. Indeed, end of 2018, but it didn't increase at all. So actually, if I briefly describe what we wanted to say with this slide, is that in the Treasury Directorate we were actually pursuing two strategic objectives. One was to reduce the interest government is paying to service the debt, and to improve the risk matrix of Slovenia debt. You can see this actually on these graphs, how we were able to reduce the interest expenditures both in nominal terms and as a percentage of GDP. You see figures for 2019. So it also how Slovenia reduced the general government debt even better than what Eurozone required. According to the so-called debt rules Slovenia need to comply with. And you can also see that Slovenia indebtedness is significantly below the Euro area average. So on the graph below, you can see that Slovenia was able in the same time to improve the risk metrics and implicit interest of Slovenia debt. So some risk metric figures. So you can see that 96% of the debt is euro denominated, and that the structure is fixed of Slovenia debt. Also to point out that 31% of the existing budget debt is having maturity longer than 10 years. Need also to show you how Slovenia is doing regarding a resident to non-resident ratio. This is if measured, or better to say, taking general government debt into the account, 60 to 40% in favor of non-resident investors. You can also see what is the Bank of Slovenia share of Slovenia central budget debt. This is actually this part of the graph. So what you can see here is composition of Slovenia investors on the primary market from 2007 until today, by investor type and by geographical distribution. So you can see that asset and wealth managers are the larger actually group of investors, and that German and Austria investors are also the largest actually investor group in Slovenia debt. So what you can see here are Slovenia benchmark bonds outstanding on the euro market, and still remaining US dollar bonds, out of which only one maturing in 2024 is of benchmark issue size of $1.25 billion. Slovenia bonds are included in over 400 major indices. So this graph, if you ask me, is very, very important and telling, where you can observe that actually from 2000, actually end of 2016, Slovenia 10-year yield started to move actually very close to Eurozone GDP weighted average 10-year yield, and that the COVID crisis caused the Slovenia yield to increase. So Slovenia spreads to widen compared to Eurozone GDP weighted spreads. Now the situation is going back to normal. I mean, Slovenia during this period executed most of the funding. So we are covering, I would say, even all the expenditures for this year. The government is actually extending to the economy, and we are covering all the revenue shortfalls for this year. So Slovenia is fully funded. The question remains to what extent pre-finance redemptions next year. So this is Slovenia yield curve. You can see mid-swap curve, Slovenia yield curve, and IZ spreads curves, and also asset swap spreads as a dots. We are showing this as a dots. So I mean, you can see that that the curve is very steep, and because of this, we were actually focusing. Executing funding in this part of the curve and significantly less on the longer end of the curve. Slovenia redemption profile. Slovenia redemption profile is very smooth and very well balanced. And this is Slovenia contribution to European stability mechanism. So 3.2% of GDP of Slovenia is Slovenia contribution to European stability mechanisms. This is financing program for this year. So this is still according to the pre-COVID budget, which was adopted in 2019. So according to this budget, we are allowed to execute 1.6 billion euros to meet funding needs for this year, or we were allowed to execute funding to meet pre-COVID funding needs, basic funding needs for this year. But we were also allowed to execute funding to finance for the redemptions due next year. And we are also allowed to finance 2.2 billion of funding needs coming from the COVID crisis situation. What we expect is that government will adopt supplementary budget in the fall, where all these figures will change. So at that time, we will know exactly what the deficit for this year will be. Nevertheless, we believe that we executed most, if not all, the funding for this year. So this is how we executed funding this year. So a lot of work. So we started with the 10-year, with the new 10-year maturing in March 2023, in first days of January. So the yield was then, or coupon is 0.275%, where we actually immediately responded to COVID situation, and in March actually issued new three-year bond. We actually very well exploited the empty space in the redemption profile of the Republic of Slovenia. I need to say, didn't expect we will need to use it, but it was instrumental for the funding, COVID funding execution. And we also later in April issued a new 10-year bond maturing in July 2030, where the coupon was 0.875, so significantly increased compared to January funding. So the yields, as you saw, went significantly down after that. And in addition to that, we executed a series of taps across the curve. So we were adding exposure across the curve. Also as a response to reverse inquiries, where we executed fundings at significantly better terms than during public transactions. So we responded to reverse inquiries of investors with the mid side of the market. So I would like to conclude the presentation. Hope didn't exceed the time allowed, and would be very happy to answer any of the questions you might have.
Hi, Marian. There is a question from the audience about the. I'll read the question. What's the pipeline for other issuances from corporate and FI borrowers in Slovenia? This is the question from the audience.
So the question is in the context of corporate bonds issuance, I believe.
Yes, both FI and corporate. Yeah.
Yeah. So actually, I have some privileged information which I can't share really. This is what I cannot do. But apart from that, I don't have any public information on the corporate bond issuance in Slovenia. Need also, I mean, just one brief sentence or comment on this. The banking sector in Slovenia is extremely liquid, and banks will be actually in a very good position to lend to viable Slovenia companies. I mean, I'm talking about those companies which would be also in a position to appear on the public bond market. So
right.
Banks would be very happy to extend loans to these kind of companies, and on top of that, so there is a government guarantee scheme in place. So I don't think that large companies with this kind of market access would be willing to go on significantly more expensive market for them.
Right. Okay. And then the second question: since the COVID, has the perception of the international banks and investors changed towards Slovenian credit? What's their current view?
So, need to say that it didn't. Slovenia is enjoying very strong position on the capital markets. So why does the spreads of Slovenia in March and in April widened so excessively? It's a mystery to me. It is, I believe, a consequence of very high uncertainty during this period. So there was no clarity at all. So I mean, I had quite a number of calls with investors, and they are all very positive on Slovenia. Also, rating agencies. So rating agencies are also positive on Slovenia.
Right. Okay. And unfortunately, we have run out of time. Thank you for the excellent presentation. For those of you watching who would like to follow up with please contact Marian directly by going to People tab on your main menu and search for his name. I'm sure Marian will be pleased to answer any follow-up questions you might have and to meet you by video conference. Marian, it's a pleasure to have you here today. Thank you very much. I hope to see you soon. Our next panel will start in 30 minutes. For now, you can visit the stream A. Many thanks. See you soon.
Hello, and welcome back. I would like to thank our sponsors for coming along this journey with us. We've tried to push the boundaries with bonds, loans, and Sukuk 24, and your support has provided us with a belief that we can do more for our global EM community. To all of our speakers from across Asia, EMEA, and Americas, thank you. Your willingness to share your thought leadership, experiences, and expertise will shape opinions and help companies the world over to steer through the current crisis and into recovery. Finally, of course, I would like to thank all of you, our audience, for being part of a community that has helped to create the world's first 24-hour virtual summit for borrowers, investors, and bankers. I would like now to invite our speaker to join us on screen. Sheila Eminjiwe, Deputy Governor at the Central Bank of Kenya. Sheila, hello. Are you there?
I am very much here.
Thank you for being here. The floor is now yours.
Thank you very much, Cedric, for your introduction. And thank you to everybody. I'm delighted to be here to be able to speak about Kenya at this Bonds, Loans and Sukuk conference. Now, I understand we'll be on for about 20 minutes. So what I'd like to do is to talk specifically to the Kenyan issues and perhaps not spend so much time on protocols that have existed around the world and are likely to be the same. So I'll focus on what's more important and not on, and more on Kenya. Sorry, we're just trying to get ourselves organized on the screen. So I want to look briefly at Kenya before COVID, Kenya during COVID, and policy responses and the impact, and really then a conclusion. Before COVID, Kenya was actually in a fairly strong position. I remember thinking that 2020 would be one of our very good years. We had closed the year 2019 with 5.5% growth, and you can see on the screen between 2015 and 2019, we had 5.6% average, and we were projecting 6.2% growth for 2020. We also had stable inflation and a stable exchange rate. The exchange rate in Kenya has always been supported by a narrow current account deficit or narrowing balanced flows and strong forex reserves. The banking sector was also stable. We had capital adequacy and liquidity ratios well above the statutory limits. And private sector credit had started to grow. We were at 12%. If you recall, at one stage, Kenya had I'm not sure which one it is it this one? Yeah. Had an interest rate cap. So it was, it had created a slowdown in our credit growth, in our private sector credit growth. Now, on the 13th of March, 2020, that was the first confirmed case in Kenya of a COVID patient, COVID positive patient. And up until now, June 19th of June 2020, the numbers are that we have conducted 130,000 cases tests, which is not considerable. But the total cases are here. We have a number of 4,400, but in fact, I think as of today, it's more like 4,800. And we have fatalities at that date of 119. I think today these are around 123. But what is noticeable is that it hasn't been very severe. And I think that's the status that we find ourselves in Kenya today. So what then? Well, COVID hit us, as I said, at the end of March or middle of March. And so the first quarter of 2020, actually we're estimating growth at about 5.5%, which was really a continuation of our projections for 2020 as we entered this year. But then we were of the view that in quarter two, this growth will sharply decline because we realized COVID has now come, and as we entered April, we saw some of this decline. And of course, our main concern was primarily the service sector, which was put into a lockdown. And so we looked at growth of 5.5%, going down to 2.3% projected for 2020. These numbers now are starting to surprise us a little bit because we now have numbers for May, and it seems like the numbers for May are not as bad as our original forecast, but we're still waiting to see the outcome of those. And obviously it would be nice also to see the numbers for June. But if I gave you just a feel, on remittances, in May, we've had the highest remittances since we started recording them. And so that is unexpected. They're much better than 2018 and much better than 2019. We also have had a much better tea, horticulture and tea exports than we had expected. So we're seeing some of the downside is not going to be as severe as we had thought. But as I say, we still wait for the June numbers to come through. What has been happening in Kenya? What are the protocols that we've been put in place? And these I'll rush through a bit quickly because they tend to be very much what other countries have been doing. Kenya established 5 COVID-19 committees even before the first COVID case was announced in the country. And obviously these were health, security, safety nets, critical trades, and post-COVID recovery committees. We also set up a response fund immediately that COVID was discovered. And this was really to move the necessary essential medical supplies, coordinate logistics and other things during this period. Tax measures were also put in place very quickly. For the low income, there was 100% tax relief. For income tax and corporation tax, there was a 5% reduction on the tax rate. VAT, there was a 2% reduction on the tax rate. And turnover tax for our MSMEs, the small businesses, was reduced from 3 to 1%. Additional money was set aside for vulnerable groups. And also there was a push to clear all government pending payments due to private institutions. Administrative measures, Kenya, we've been quite strict. Mandatory wearing of face masks, closure of public schools, of public places, which was enforced immediately, and social distancing. We also had a dusk to dawn curfew countrywide, and more money was set aside for the recruitment of medical personnel. Employers were encouraged to retain staff instead of laying people off. And in many institutions like the central bank that were critical institutions, shift working and ensuring the social distancing was the order of the day. Monetary policy, what we did at the Monetary Policy Committee of the Central Bank. In January, we had already reduced, well, in March, we reduced the CBR from 8.25 to 7.25 as COVID hit. And in April, we have reduced that further to 7%. So an accommodative monetary policy stance was immediately introduced. The cash reserve ratio also was reduced from 5.25 to 4.25, which released about $340 million into the economy. And we're very happy to see that that has actually now, in the period from March, has now been fully utilized by the economy. And we can see it also in the private sector credit growth. So what we're seeing is that the banks have responded and really provided additional funding to the businesses who are trying to cope through this difficult time. We have enhanced liquidity management options that we gave to the banks, and we hold a monthly monetary policy. Our law requires us to hold a monetary policy meeting every 2 months, but at this stage, we've decided that it's necessary to hold it monthly. Finally, we had a demonetization of the Kenyan currency, the 1,000 shillings last year, and it yielded about a $70 million surplus. This we released to our national treasury to help fight the pandemic. From the banking sector, the response was also quite quick and also very important. So there was an encouragement for banks to provide loan repayment relief during this COVID-19 period. Our view very much is that banks at the end of the COVID period need also to have customers. There's no point in getting past that end stage and then finding that the bank exists and it has capital, but it has no customers to carry. So there is a need for a balance, and this is not the time to be looking particularly at profitability, but more looking at the health and structure of your balance sheet and taking that across the line. And as I said, this has been quite successful because the banks have utilized the CRR, the cash reserve ratio, quite well. And we've seen a growth in the private sector lending, which is also a piece of positive news. So we talked about extending loan repayment periods. We talked about considering moratoriums. We talked about restructuring loans, and I believe that is ongoing. Also, with the credit reference bureaus, we then stopped suspension of listing for credit reference bureaus for 6 months from the 1st of April. But we also encourage banks to consider the requirement and relax the provisioning conditionalities for those loans that had been strong at the 2nd of March. So what we're assuming is that if your loan starts to deteriorate from the 2nd of March, it's really been driven by a COVID reason. We reduced waivers. We reduced and waived charges on the mobile money. What we said is we wanted people very much to use mobile money because obviously there were concerns about the COVID issues of touching physical cash. So no charges for mobile money transactions at the lower level, that's up to $9. Transactions limits on mobile money were extended. So whereas we had about the daily limit, we had about $700, that's gone to $1,500. We had a wallet limit of $1,400, that's gone to $2,800, and no monthly limit. We used to have a monthly limit before. Obviously, as a central bank, we continue to monitor this quite carefully because there's other concerns that we would have around more money being used in a digital form. Our capital markets also went into action, and we had a remote and online AGMs. The need for listed companies to publish their results on websites and not revert to the physical newspapers, and also to be able to pay dividends and appoint auditors, which will be ratified by AGMs at a later date. The insurance sector also asked for grace periods of 3 months for people to pay premiums, and promptly pay the brokers and agents their fees and bonuses, and finally to take resilience tests around continuity issues on COVID-19. This is what I'd spoken about a little bit earlier. What we found, or what we're finding now, the results that are starting to trickle in, is that some of the export side and some of the things that are critical to Kenya are actually performing a little better than we had hoped for. If we take, for example, tea production, which is the biggest export in the Kenyan economy, what we had is a 22% increase in tea volumes, export volumes in this period, which of course was not expected. Also, our flour exports have done pretty well as well. And this is despite the fact that initially there was the cargo flights. As I say, April was not a good month, but we can see in May, this quick return to the pre-COVID levels seems to be revealing itself. I want to be careful as I say that, because we all know that we don't know where COVID is going. So I don't want to say that, you know, what did they say? One swallow doesn't make summer. Is that the right way of saying it? So we're seeing a good May. Let's see the June results come out before we become too happy about that. We've got a big benefit coming in from the decline in the oil prices, and you can see there that will have a $1 billion reduction in our oil bill, which is also a very good thing for Kenya. I think what we're looking at now, if we sit back and reflect from a Kenyan perspective, is that the pandemic has devastated all of us. It's devastated the global economy. Kenya's resilience is really founded on a diverse economy, so that's been a benefit, and less dependency on some of the natural resource exports that where the pricing has dropped off quite considerably. And the decline in the oil prices has also helped us. But really, like other countries, we're very unclear which direction this pandemic is taking. We're very unclear which direction this pandemic is taking. And I think that's what keeps us all very anxious and alert, because you can't take for granted where we're going. I think it's also evident that the weaker 20% of firms will come out of this significantly bruised. And really, as a government and as a regulator, these should be our concerns, because it's that group that will have to continually to be supported as we enter the post-COVID period. And really, their position will be very clearly revealed in the post-COVID period. These are the small supermarkets, the small restaurants, the segments that support the tourist industry. So there's still a lot of understanding, there's a lot of work that needs to be done. Based on our current assessment, we would say that COVID has had a significant shock to the African continent and to Kenya. But the impact can be mitigated by careful, attentive monitoring, quick, intelligent responses, and a belief in a better future. So I think as Kenya goes forward, that's really our belief, really to be very attentive and to be very intelligent on how you respond. From an African perspective as a whole, obviously the health crisis has had a huge impact on the health system in the continent. It may in the future give us some improvement in our health sector because of the interventions. The slower growth prospects is a real problem because of our relatively youthful population and the employment implications that this has. We potentially have security challenges with protracted restrictions and movements without interventions to support people's food and shelter. These are concerns, these are real concerns. We have large rural populations with limited access to healthcare. And we have to, as regulators, as government, ensure that this health crisis does not evolve into an economic or financial crisis or even social crisis. The good that might have come out of COVID, which seems strange to say, but in Kenya, there's been a real thrust into the digital age. I think the number of people who have now stopped using physical currency is very considerable. We're 83% financial inclusion and included, but most of that financial inclusion comes through our digital currency platform. And so that is something that everybody's using now. We're seeing it in the movement of physical currency. And so this was a good thing. This was a good thing. I think we're all concerned. We're all concerned.
So, yeah.
We're all concerned about human considerations. I think we need to rethink our buffers and priorities. And finally, rethink globalization. I know that you're aware that Kenya was elected to the UN Security Council. What does that mean post-COVID? Is it going to be the same as it was pre-COVID? Will financial institutions hear the voice of Africa in a much more attentive fashion? So as we close, I would say COVID crisis calls for extreme vigilance and concern. Decisions made right now, right or wrong, will have long-term implications. Thank you very much for listening to me. Sorry, I want to get rid of this. Thank you, Cedric.
Sheila, thank you very much. I have a few questions for you. The first one is, what is your outlook on the inflation for the rest of the year?
I think for Kenya, like most countries, the outlook is fairly stable. I don't think inflationary pressure is really there. Firstly, the demand pressure is not there. And then secondly, for Kenya, inflation is often pushed by food issues, and we've had good rains. So the harvests look quite good.
Okay. Also, another interesting question. What steps are is the central bank or government taking to support the SMEs or the informal sector?
Yeah, I think you heard me talk about that a little bit in the presentation. It is of extreme concern to us. It is of extreme concern to us. We have, as I say, worked with the banking sector, and you saw that we have managed to distribute 35 billion shillings, which is $350 million already to the private sector. And to a large portion, that has been to the lower end of the market. In addition, what we're doing now is looking to see, it came out in our budget that was passed, I think it's a week and a half ago. We're looking to see how to give further funds directly now to what I would call the MSMEs, the micro and small enterprises. And this is using our digital currency platforms, which can reach them fairly easy. They don't have to go to any physical building. As long as they sign up on their phones, then they can access these funds. And that is actually something that we are completely committed to. We realize that the Kenyan economy is very reliant on these MSMEs, and we intend to carry them through the COVID period and across the line.
Okay. Well, Sheila, thank you very much indeed for your insight and excellent presentation. We will start the next panel in about 10 minutes time, if I'm not wrong. So I'll see you then. Thank you.
Thank you very much.
Thank you very much, Sheila. Bye.
How do I leave? I thought I had left.
Hi again. Welcome back. I would like now to invite our next speakers to join us on screen. The next panel will be moderated by Kobi Bensi-Enchol, Executive Director and Head of Debt Capital Markets at Stanbic IBTC. Kobi, good to see you. You're muted now.
Hi, Cedric.
Hi, Kobi. How are you?
Very good, thank you.
So the floor is now yours. I will let you introduce all of the other panelists. And I'll speak to you very shortly. Thank you.
All right, thank you, Cedric. And good afternoon, everyone, or good morning, depending on where you are at this point in time. This panel is going to look at how African governments are securing financing for their COVID-19 response. Now, to join me in this conversation, we have, first of all, Greg Smith. Greg is the Emerging Markets Strategist at M&J Investments. We also have with us Siyabonga Shange, who is Director of Debt Issuance and Management for the Republic of South Africa. Welcome, Siyabonga. And we also have Patience Oniha. Patience is the Director General for the Debt Management Office for the Federal Republic of Nigeria. Welcome to you all, Greg, Siyabonga, and Patience. My name is Kobi Bensi-Enchol. I'm with Stanbic IBTC Capital, a member of the Standard Bank Group based in Lagos. The COVID-19 pandemic ushered in a new reality for the world of global finance, challenging many long-held assumptions about the resilience of the global economy and strengths of the major economic powers. These were all shaken at their very core, as we saw a number of governments and central banks implementing emergency measures to save their economies. Africa was not left unscathed. And we are here today to discuss and look at the responses from African governments in shoring up our economies in response to COVID-19. We will start the conversation by inviting Patience to tell us about what Nigeria did. In the wake of COVID-19 pandemic, a number of sovereign states across the world have initiated various fiscal and monetary responses targeted at addressing the economic fallout of the pandemic. Patience, I guess the question is, what specifically did Nigeria do? And we'll go to Siyabonga. We want to know what South Africa
your phone affected it?
Patience, are you with us? Patience, can you hear me? Okay, we seem to have lost her momentarily. The screen is, Patience, can you hear me?
You can't hear
Okay. Patience?
Okay, so she respond. No?
Yes, I can hear you. Can you hear me?
I'm supposed to speak. Okay, I just click this. What do I click now for it to go? I said no.
No.
Can you hear Kobi? I've written something, so send that message back.
Patience, I can hear you. Can you hear me? Okay, maybe whilst we wait for Patience to come on board, let's get Siyabonga to comment on this question. What specifically did South Africa do to address this challenge? And what's been your assessment of the measures taken so far? Were they timely and are they actually working? Siyabonga?
Right. Thank you very much, Kobi. As introduced, my name is Siyabonga. I look after the debt issuance program of South Africa. So maybe before I just delve in straight into the questions of the measures, there was a slight interesting caveat that actually came into.
So go ahead, Siyabonga.
All right. There was a slight caveat that came with the, the recent pullback of international investors as we went into lockdown, which was actually a ratings downgrade, which saw us fall off the WIGBI index, which essentially just simply means it just extremely complicated my job overnight because you're losing some of those passive, investors. So in terms of what the president has announced as a stimulus package, you saw there was an announcement of a 500 billion rand into the economy to help basically with the health expenditure and social welfare. So I think from a debt perspective, in terms of that basically starts to say my expenditure is increasing quite drastically while the financial market was being extremely displaced because of the outflow. So I had to contend with a few things. So I would view them more as 4 segments. So from an operational perspective, what we had to look at was the ensuring the continuity of the payments, which was actually a challenge because what you would have seen was we had disaster recovery centers that were there in the event of a disaster, but we can no longer access those. So essentially, then you are faced with a problem where you might have a technical glitch, and in the market, it might come out as a liquidity concern in terms of your funding program. So that had to be managed. And specifically on the funding, so we've had to drastically adjust our funding program in terms of the instruments we issue and the way in which we fund. What you would have seen is we had drastically reduced duration in our funding program, funding significantly more on the shorter dated stock because we had seen quite a significant jump in the longer dated yields. So that the shorter dated stock, you would have seen them rally quite a bit as a response from the central bank, which has come on board to ensure proper market functioning and kind of also help respond to the crisis, which was reducing the rates. We've seen a reduction of over 290 basis points in the policy rate. We've seen the central bank coming and playing a very active role in the secondary market as far as buying South African government bonds in the secondary market to just ensure that proper market functioning. So I think from that perspective, obviously those things coming together, the coordination between ourselves and the central bank, and also keeping the buy side, which is the asset managers and the banks, to be part of the solution would be basically the approach that we went with in terms of trying to respond in the short term, at least, to this crisis, because we're not really sure how long is it going to last. Thank you.
Thank you very much, Siyabonga. That seems very comprehensive. Okay, so let's try to go back again to Patience. If you can hear me this time. Bringing the question back to you, which is, what has Nigeria done in terms of a response, and how do you assess the measures taken so far? Were they timely, and have they been effective?
Okay, thank you very much. Sorry, we couldn't hear you the other time. So I'll just try and speak a bit quickly. I'll just say that as we are today, we have about 21,000 cases of persons infected with COVID. But speaking straight to your question, did the government start early? I would say we did when we had the first case. So the government has done maybe about 4 actions from different directions. The first was to set up a presidential task force on COVID to handle all the medical issues. That included the Ministry of Health, and it is chaired by the Secretary to the Government of the Federation to show you what importance it is. But it is purely a case of managing the COVID itself, contact tracing, interventions that are required in various hospitals and all of that with isolation centers. What is good is that this is a national program and all the subnational governments, the state governments have keyed into it. So we're working as one entity health-wise in terms of managing COVID. So I should say also it is from that committee that issues around lockdown, restrictions on movements, and all of that contact tracing has taken place. And I believe they have, as a country, we have achieved a lot by having that task force, at least to guide us in terms of the health issues. The other thing the government did, I'm talking the high-level political interventions now, was to set up an economic sustainability committee chaired by the vice president. Reason being that while the lockdown will slow down the economy, we still need to have a plan for recovery and growth because COVID won't last forever and we don't want our economy to slip into recession. So that committee essentially includes private sector operators. The purpose was to see the sectors that have been severely affected and introduce or recommend policies and actions that can be taken to ensure that those industries or companies recover so we can retain jobs and sustain economic growth. So that's far as high-level political goes. When we come to the fiscal and the monetary, I think those are where we have the bigger issues. You all know that we're very dependent on oil for revenue. So once the price of crude oil crashed and demand became really soft, we had to redo the budget and the medium-term expenditure framework. So in terms of the budget, the 2020 budget, it's waiting for the approval of the president. The National Assembly has concluded, they amended what the executive submitted. So we're waiting for a final approval. But what it is that the budget size was retained. The exchange rate was changed from an original 305 Naira to the dollar to 360 to the dollar. So that tells you we've devalued a bit. We've recognized that the Naira may not hold because reserves were also affected. And in total, the size of the budget is about the same thing. In Naira terms, it is still about 10.7 trillion Naira, within that range. But what happened was a reallocation of expenditure to health-related issues. So we had to go back and look at our hospitals, institutions, and equip them, in addition to budgets to fund isolation centers and all of that. So the budget was reworked, as it were. Revenues, we used the benchmark price for oil of 25 compared to 57. So what that did, also non-oil revenues were revised downwards as well. So if you remember that we kept the size the same thing because we now needed to spend extra on health issues and COVID issues as well. It meant funding had to come from somewhere, and that happens to be borrowing. So in the original budget, we had about 1.6 trillion Naira of new borrowing. In the revised one, which is in process, that has more than doubled to about 4.2 trillion Naira. Okay, and whereas we had planned to access funds before from the international capital markets, we realized there's no access at this time. That's no secret. So all of the borrowing, to fund this budget, we are going to raise $5.4 billion from the IMF, the World Bank, the African Development Bank, Afrexim, and the Islamic Development Bank. So summary is revenues were revised downwards, expenditures were reallocated, and then borrowing is now going to come from multilateral, but the domestic is also going to increase. We originally had only about 750 billion, but it is now 2.3 trillion Naira. So included in the budget is actually a COVID fund for 500 billion Naira. That's apart from all the interventions in physical infrastructure and all of that. The idea is that the government needs to spend in each small segment of the country, and I will call them local governments. I don't know what you call them in your own countries, so that there can still be jobs to undertake public works, so that the level of unemployment that may occur, recession, would be moderated. And let me quickly add, while we're talking about the budget, that without the interventions from the budget and what the fiscal is doing, the government projected a decline in growth rate of about 8%. But with these interventions, we think that will reduce to 4%. So on the part of still the fiscal, I mean, the government had to give import waivers for medical and pharmaceutical supplies. We also had to sort of provide for some deferrals of tax payment because of the lockdown. So the taxes will still be paid. They're not current year's taxes, but just give companies some time and within which to pay. Largely, that's what we did on the fiscal. For the monetary, the central bank created 2 intervention funds, one for the pharmaceutical industry for 100 billion, and then the other one for SMEs, because SMEs have been severely affected. These are small businesses, and many of the people survive on the basis of those. So that is 50 billion. What is good about the intervention is that it is targeted, and then the rates are concessional at 5%. Okay, the other thing the government also did, the central bank, the monetary policy rate was reduced from 13.5% to 12.5%, hopefully to encourage lending and encourage the real sector to develop. I think largely that's what we have done as a country. The number of COVID cases, is still increasing, but at least the measures that have been put in place with the presidential task force has helped to moderate that. Thank you.
Thank you very much, Patience. And that's also absolutely comprehensive, very comprehensive. Thanks for taking time to share all of that. We'll go on then to Greg. I mean, you're looking at all of this, from where you sit, comparing that to, what all the other global powers are doing. We've seen a response taken by the Bank of England, the US government as well, European governments. You know, how do you, when you look at that and you contrast it with what's going on in Africa, what is your own assessment of Africa's homegrown solutions? In particular, if you look at currency performance, inflation, debt management strategies, and let's talk about Nigeria and South Africa. You know, what are your thoughts, and which countries do you think might be under pressure and why?
Okay, thanks. So in terms of South Africa, it's been a very, very interesting few months. From the conversations in February around the budget were a fiscal deficit of around 6% and reforms to Eskom and how the economy could grow. But obviously COVID's completely changed this, and we're talking about a 14% of GDP fiscal deficit for this year, which is perhaps 10% once you strip out the debt service costs. So it's this massive 500 billion Rand stimulus. So that's the first innovation, so that we have seen a huge fiscal stimulus in South Africa. And then what's very interesting is normally in an EM type crisis, a sudden stop like we had in March, EMs are forced, emerging markets are forced to increase their interest rates. But what we saw from central banks all over Africa and in many EMs is that they actually cut rates. And in South Africa, that was the case. So instead of sort of making the crisis worse, monetary policy was able to cushion the crisis, which is very important. So, and that's testimony to the way that the SARB have controlled inflation over the last few years, although growth has been sluggish. And then the next part is quite amazing, as you pointed out. The SARB is in the markets, 0.2% of GDP it's bought. And this is about market liquidity at the moment, but I've seen and read this might go to 2% of GDP. And so we're seeing quantitative easing across emerging markets, including in Africa, which is quite remarkable this year. And I think one point to make is this is very easy to start and hard to stop. And that's one thing we've learned in Europe and the United States. So it'll be very interesting to watch this over the coming months and perhaps into next year. And while we had that sudden stop back in March, we've seen net inflows to South African paper by foreigners over the last month, or although the last week was a bit weaker. And I'd say the third innovation was for South Africa, for me, was saying no to the IMF emergency financing. Countries all over the world have been taking up this emergency financing without conditionality. I think Nigeria for the first time in its history, but South Africa have so far said no to this money, although they did take $1 billion on Saturday from the New Development Bank based in Shanghai, which is an interesting statement. And then lastly, for South Africa, for us, looking at investors, it's about getting through the pandemic, certainly at the moment, and then we look for recovery. And we go back to some of the problems. And I think Ramaphosa's speech earlier today about investment is massively crucial, because to us, South Africa has a massive problem with unemployment, massive problem with its state-owned enterprise that have been pretty much destroyed by corruption over the last 10 years. And they really need to start fixing those so South Africa can have reliable electricity. So eyes will quickly turn back to the reforms of Eskom. And with this fiscal deficit, where do we end up? Where does debt stabilize? 80% of GDP, 90% of GDP? Quickly on to Nigeria. So the innovations there have been quite incredible. I remember 2017 when we had Sukuks, green bonds, longer dated Eurobonds, quite an impressive amount of innovation, plus really good communication. I see these articles in the Nigerian press about how China's lending so much. And then quite quickly, we see a statement from the debt office saying, actually, it's only 4%. So coming forward with the facts and the communication has been excellent. And I think for Nigeria, that the innovation's really been of the last 2 years, which is the OMOs. Not many central banks sell their OMOs just to foreigners. And this has been quite fascinating. And I think I do credit Nigeria for developing its local bond markets. But what I think needs to happen is we need to push investors away from the short-term debt and into longer dated bonds. So this is more sustainable. Because I see the OMO as a trade, not as an investment, something investors jump into and jump out of. And we've seen that in this crisis. And the big problem is the exchange rate backlogs, parallel rate 455, while the IME at 388. So you'd be nervous. And when I look to Egypt, who have allowed exits during the crisis and who are working to make their debt euro clearable, they're working to get into the indices. You've really got to make those steps. So the innovation just needs to continue. And lastly, under pressure, the third part of the question. We've seen an incredible rally over the last month for African Eurobonds. Everything has improved. And what we're left with is only 2 countries with spreads above 1,000 basis points, and that's Angola and Zambia, who have also had an incredible last 5 days. The prices have been increasing. Partly that's because oil's back at 40, and partly because the markets have just rallied with this massive amount of Fed liquidity that's been injected into global financial markets. So I don't think we're through it, but we're in a much better place for Africa. And I think most African countries could probably come to the market in the next few weeks, particularly as Honduras and Egypt have over the last months. That's all from me.
Thank you very much, Greg, and that absolutely was brilliant. Patience, we're coming back to you now. And to a point that Greg made about communication, I think the DMO has been very proactive in responding to all manner of questions, from the press, etc., about debt levels in Nigeria, and particularly there seems to be concern around the revenue, revenue to debt service ratio, and the extent to which Nigeria can afford to borrow. Yes, debt to GDP is low, but if the revenue is not strong, it's not coming through strongly, then how are we going to sort of service these debts? So it'll be good to hear your thoughts on that. And whilst you address that point, I think Greg also made the point about how the Eurobond markets are currently thriving, and we've seen a number of sovereigns sort of coming to market. Rates are low, but we note that Nigeria has made the choice at this point in time not to go to the ICM, but then to rely on perhaps cheaper borrowing from the multilaterals, etc., which you also alluded to. So maybe you can just respond to that. And then just finally in your response, there is one question from our virtual audience that seeks clarity in terms of how does Nigeria plan to finance the budget deficit this year with respect to CBN financing, non-CBN domestic financing, and then external financing? So maybe you can tie that all together and giving us some insights. Thank you.
Okay, thank you very much. It was useful to hear, Gregory speak. So let me speak to the issue around debt. I think debt in Nigeria has become a favorite political discourse. It's become a political issue. So no matter how much, you sensitize the public, and when I say sensitize, I'm talking at the level of the DMO, at the level of the minister. There are all kinds of write-ups and press conferences, but you would still see what is reported is not correct. And I think sometimes too, because it is political, sometimes they mix up the figures, not for ignorance, but political. So, but let me speak like a professional here. Debt to GDP is low, still below 20%. But I recall that from 2017, at least when I became DG, and then we already saw the pressure on revenues with what happened with oil prices way back in 2015, and production as well. We don't speak too much to debt to GDP as a measure of debt sustainability, but because it is an international statistics for debt management, we talk about it. So our focus really has been more on debt service. So we talk about it being low, but we are not comfortable with it being low, okay? We are rather more focused, and that's where we should be, on debt service to revenue ratio. Okay, so if you look at the historical budgets, the debt service
Hello, Patience, can you hear me? We seem to have lost you again momentarily. Okay, we'll come back to you, Patience. If you can just hold the thought right there, whilst maybe your connection is restored. Siyabonga, maybe I can just then sort of come to you briefly. In the case of South Africa, it's not about revenue to debt service. The South African sort of tax authorities are actually sort of legendary. They're credited for being legendary in terms of tax collection. But the one thing, the theme that seems to be trending there is about the.
Okay, sorry, I can continue now.
Okay, okay, please, please
okay,
go ahead.
So what I was saying, the target then is how to increase revenues. So our tax to GDP is 66%, which I mean we shouldn't be proud of. What's the history behind that? Because we relied on crude oil revenues. Okay, so the focus has to shift to revenue generation. As I like to say, we've incurred the debts already. They have a lifespan, so we have to service them. They were not grants, so you have to provide for them in your budget. So those will count as part of your debt service. So the focus should be on revenues. How should we increase?
Okay, sorry, I think we've lost patience again. Apologies for that, but I'm sure we'll have it back before we conclude. So Siyabonga, state-owned enterprises and their debt obligations, and how that is impacting the government balance sheet.
Thank you, Kobe. So in terms of state-owned entities, I think there would be somewhat of a wrong approach when one takes just a blanket approach and look at COVID. We have entities that were in trouble even before COVID. So that is taking, okay.
Sorry, go ahead, Siyabonga, and then Patience will come back and then round up.
Right. Sorry. So we have entities which were in trouble before COVID. The likes of our energy producer, the likes of our airline, which is the SAA, and most recently the Land Bank. So look, in terms of the quantification of what has been the impact of COVID, I don't think that has come through quite in much detail. What you would see is tomorrow, the sovereign is actually presenting a new, adjustment budget to kind of give numbers of what the impact of COVID has been. But I think in terms of some of the entities, you would see that there has been quite a very clear communication and standard to say, look, I think we all realize as a country we are in trouble. We are at a point where we need to be very realistic about issues and keep what we need to keep, which is for strategic purposes. And some of the things that really do not make much sense, we should really be, having very hard conversation on their existence. So in terms of state-owned entities, essentially, obviously you look at your energy producer, which produces more than 90% of the electricity in the country. There is not really much you can do about that. But I mean, as a plan, there has been communication in terms of a view to diversify the energy generation going forward into the country. That is again trying to go away from this concentration. But I think as the months go through, that is when now you're going to see the full impact of the other state-owned entities come through. And I think even before the COVID crisis hit, there had been a very clear realization that tough decisions need to be taken, specifically when it comes to state-owned entities, whether they are becoming departments or they're continuing to become businesses or they get closed. So that has been quite a very clear message that has come through, and I think it's going to be coming through also in the budget tomorrow.
Thank you, Siyabonga. Patience, if we can try to get back to you. You were addressing the issue about revenue and debt sustainability for Nigeria. You're on mute. You are on mute at the moment.
Okay, we are very conscious of debt sustainability as it relates to debt service to revenue. So quite clearly, debt to GDP is on the other side. But again, I made the point that in the short term, until all of the policies and strategies begin to generate significant revenues, we'll still be dependent on crude oil for revenues. Okay, so debt service may still be a bit high in the short term. Responding to, again, that question, part of what borrowing from multilateral sources to fund this year's budget, so we're not looking at the ICM. First, we saw there was no access. We didn't want to be the guinea pigs and put in all that effort and come up. Our Eurobonds were at some point trading at almost 12%. So clearly we're not going to be planning around accessing that market. So we're getting 5.414 billion of external borrowings. These are coming from the multilaterals and they are all concessional. So one of the things that has achieved for us in this revised budget is that whereas the new borrowing has increased, the rate of increase has not been, that high because they are concessional rates. Okay, so we'll still plan in the annual budget to service the budget. It is a first line charge, like I said, technically in the way it operates. So there's no reason to be afraid that Nigeria will not service its debt. Regarding the question on the amount that we're going to borrow this year, I think that is expressly listed, even the breakdown in terms of sources. Okay, so since we have limited time, I won't run through that, but the IMF is clearly the largest there at 3.4 billion. And it goes all the way to the Islamic Development Bank at 113 billion. So those are concessional. The balance of about 2.3 trillion in Naira terms is coming from the domestic market. As we speak, we have raised about 1.4 billion of that, 1.45 billion.
1.4 trillion, you mean?
Yes, trillion, I'm sorry, yes, you know the figures. In the domestic market through FGN bonds and then through Sukuk as well. So we're on course to deliver on that one. I think the other question was on domestic borrowings from the central bank, if I may.
Correct, yes.
The question was put. Okay, so it will look like, I don't want to say traditionally or historically, but either of those could be right. The government has tended, and I think a number of central banks do that, lent to the CBN, to the government. The central bank has lent to the government through ways and means advances. Okay, so maybe that has grown, consistently over the years. And I want to say very clearly that if we go through with the process we have, the plan is to, take all of that and put it into a structure. And we have already made a proposal to the central bank, make it put it properly and then disclose it in a transparent manner and work within the limit that is approved, because there is a limit in the laws of how much we can raise from the central bank. Nothing says your central bank cannot lend to you, but there is a limit. So in terms of what we have, we're trying to structure it properly instead of just leaving it the way it is. I think we've moved forward significantly with the central bank on that, and there's processing going on. So if you ask me, the budget as we have it, are we planning, did we include any financing from the Central Bank of Nigeria, new financing? The answer is no. Thank you.
Thank you very much, Patience. Again, very comprehensive. And then maybe to come back to you, Greg, to help us wrap it up. Would you say the international investor community is bullish or bearish on Africa in the wake of COVID-19, and why?
Okay, we've got 55 countries in Africa, so we've got an enormous amount of diversity. And for the 20 African countries with Eurobonds, again, so many different cases, some dependent on oil, some dependent on tourism, some are growing in 2020, some are in deep recession. So we've just got a huge amount of diversity and a huge amount of uncertainty. So what's really helped bring the spreads down and bring yields down and the cost of borrowing down has been this amount of money the Fed's put in. So that's been really important. That's pushed money to EM, investment grade, and then finally to the frontier. But that's fragile, so we watch that carefully. So those technicals are very important. And while we're sort of positive about the way things have gone, we have to be careful about future cases of accelerating, and that has to be on people's minds. And we also need to recognize we've used a lot of the dry powder, the fiscal stimulus, the FX reserves, the stabilization funds, the emergency financing. So if we do have a second wave, if we do have a climate shock or another shock in the next few years, then it's going to be much harder to respond. So what we've got to do as investors, look at each country in turn and try and work out whether this is a liquidity problem or are we going into a solvency problem. And for some cases, I think it's clearly a solvency problem, and for some cases, liquidity. And then there's a number of countries in the middle, which is grey area. And then just lastly, one thing we're keeping an eye on is the debt service suspension initiative that's being sort of pushed by the G20. And of the 13 countries in Africa with market access that are eligible that we look at, 5 have said no and 8 have said yes. And it will be interesting to see how that plays out. So we've got countries, Nigeria, Ghana, Kenya, for example, saying we're not going to be involved, according to the World Bank's data, but Senegal and Ivory Coast. And what implications does that have for their credit rating? What implications does that have for their future market access? Because in 2-3 years, we've got a lot of Eurobond debt maturing. And that was the saving grace this year, that very few African countries had amortization. They just had coupons to pay. But if we have a crisis in 23-24, it's going to be much harder. So I'd say we're cautiously happier in May and June than we certainly were in March and April. But it's a difficult thing at the moment because Eurobonds are no longer cheap. So you've got to make a really tough decision on which sovereigns are going to have the strongest balance sheet in 2021. That's all.
Thank you, Greg. Cedric, I don't know if you're here with us now, but wanted to do a time check. We have a couple of questions from the virtual audience, but I wanted to check if we can still take it.
Yes, we have about 5 minutes, if I'm not wrong. Yes,
Okay.
5-6 minutes.
Sure, thank you very much. And maybe Siyabonga, you had a point or a comment you wanted to make to Greg?
So I just wanted to clear up a slight misconception when it comes to the IMF. So it's not necessarily that the sovereign said, no, thank you, thanks, but no thanks to the IMF. One would understand that there would need to be a letter of development policy that would have to go to the board. So in terms of the discussions and the negotiations, and I think, they say the devil is in the detail. So what South Africa has been doing is trying to, get into the final details. So we have been in contact with the World Bank, that is, up in the public, the AFDB, the NDB, and obviously the IMF. But we have not said thanks, but no thanks to the IMF. It's just a matter of also aligning in all the expectations and the required processes for the facility.
Okay, thanks for that clarification. Greg, the other question to you was that you mentioned the need for more investors to buy government debt with longer terms. What can governments do to make longer tenor debt more attractive, in your view? I mean, the obvious thing is pay more yield, but I'm wondering if that was the crux of the question.
Yeah, there's so many things. It becomes a very long checklist of what you need to get right. And some of those things are macro and political, and some of those things are under the control of the Debt Management Office. But when I look to Egypt, who this crisis, when they did have massive outflows, they allowed people to exit there. So people will have sort of learned from that and maybe will return in numbers. And this idea of getting the passive money by being in these global bond indices, by being euro clearable and making things simple for investors, very important. But just some confidence that you can exit if things get harder, particularly, and that you're not going to get stuck with a backlog of FX demand is very important. And so it's not easy is the answer, but that's something that needs to be worked on really hard across the continent over the next 5-10 years to shift some of the burden away from external debt to domestic debt. Although South Africa and Nigeria are some of the best performers in that, compared to many other countries on the continent that have borrowed mainly in external, in foreign currency, which creates risks.
Okay, thank you very much. I think that's it in terms of questions from the audience. And I've exhausted mine as well. I'd just like to thank you all for your participation on this panel and your insightful comments. And then we look forward to probably doing this again, hopefully when we can all get together again in person. But thank you very much, and I wish you a productive day and rest of your week. Cedric, over to you. Thank you.
Thank you very much, Kobe. Thank you very much, everyone. Gregory, Siyabonga, Patience. So thank you very much for your excellent discussion. For those of you who are watching and who would like to follow up with any questions with the speakers, please contact them directly. You can go to the People tab on your main menu and search for them. I'm sure they'll be pleased to answer any follow-up questions you might have and to meet you on the video conferences. So we will take a few minutes break. I think we are back in 6 minutes, 8 minutes. So we'll be back in 8 minutes, and I'm looking forward to seeing you then. Bye-bye. Hi again. I would like now to invite the moderator for our next panel, Samta Lalan, Head of Distribution at Nedbank. Samta, hope you're well.
Hi, Cedric. It's
good seeing
great
you.
to be here. Yeah.
So I will let you introduce the next panel.
Sure. Thanks, Cedric.
Okay. Thank you
hello,
very much.
everyone.
The floor is yours.
Yeah.
Bye.
Perfect. Thanks, Cedric. Hello and welcome to this panel discussion on how African corporates are weathering the storm from a funding and balance sheet perspective. My name is Samta Lalan, and I run the rest of Africa loan syndication and distribution business for Nedbank. We know that foreign investors have pulled money out of emerging markets, downgrades have happened, cost of funding has been affected, and the volatility hasn't helped either. Is hard currency funding still available? Or have corporates moved to local markets and local currency for funding? Are corporates looking at syndicated loans or debt capital markets? How important is relationship funding? What about contingency funding for COVID? We attempt to answer this and more for you on this panel. It's my great pleasure to introduce this fantastic panel. First up, Timothy Ononiwu. Timothy is CFO at Axela Limited. Axela is the first private natural gas shipper on the West African gas pipeline. Timothy is an accomplished finance executive with extensive experience spanning project financing, financial advisory, business development, and project management across energy and infrastructure. Prior to joining Axela, Tim held senior management positions in various financial and non-financial institutions such as BBVA, Fitch Ratings, and Dexia. He has an MBA from Columbia Business School, and he is currently joining us from the US. Tim, are you with us? I think he is frozen. Are you there, Tim?
No, thank you, Samta. It's a pleasure to be here.
Thanks, Tim. Next, I would like to introduce Ngana Ginu. Ngana Ginu is CEO of TransCentury, a Kenya-headquartered investment company with an infrastructure focus and a track record for delivering unique investment opportunities. The group has 8 businesses across 2 countries in East, Central, and Southern Africa. Ginu has held various key roles in the group, including corporate finance, portfolio management, as well as originating and developing businesses in the infrastructure space. Recently, he has led the group through a significant debt restructure process. Ginu is a CFA charter holder and also holds an MBA from University of Dallas and has worked in the US before returning to Africa to contribute to the African growth story. Welcome, Ginu.
Thank you, Samta, and I'm delighted to be here today.
Thanks. Next, I would like to introduce Martin Shivala. Martin is the Group Treasurer for East African Breweries Limited, which is East Africa's leading branded alcohol beverage business and is part of the Diageo family. Martin has been with Diageo for 9 years, with experience covering manufacturing, accounting, planning, cost accounting, business performance management, supply finance. His most recent role was financial controller for EABL's Tanzania business. He has experience working with various African and Eastern European markets in his former role as a business performance analyst based in London. Martin has an educational background in actuarial science. Welcome, Martin.
Thank you. Happy to be here.
Thanks, Martin. And last but not least, closer home to South Africa, which is where Nedbank is, Deepen. Deepen China is General Manager for Capital, Investment and Funding at MTN, based in Johannesburg. MTN is a pure play emerging markets mobile telecommunications operator at the forefront of technological and digital change. MTN is active in over 20 countries and listed on the Johannesburg Stock Exchange. Deepen has been with MTN for 12 years across general management and finance roles. Prior to MTN, he worked with institutions such as ABSA and EY. He's a chartered accountant by profession. Welcome, Deepen.
Thanks, Samta.
That's great. Thanks.
Looking forward to an engaging discussion.
Thanks, Dipen. I think the audio is a bit slow at your end, but we'll get to that. Let's jump straight into it, given the tight time that we have. Tim, if I could start with you, how has the slump in commodity prices and COVID-19 impacted corporates' business and funding requirements?
Thank you. I think it's obvious we're all experiencing a perfect storm. The slump in commodity prices, as well as the impact of COVID. Let me start with the impact of COVID. Axela, playing in the midstream business, we have developed natural gas grids in our areas of franchise, our franchise areas, where we develop, through which we supply natural gas to light manufacturers. In fact, the biggest manufacturers, especially in Nigeria, that are in our franchise area, are our customers. So now you have the pandemic, the ongoing pandemic, whereby the government mandated a lockdown. It's not just in Nigeria, I think it's a global phenomenon that we're facing. So when you have a lockdown, it impacts your operations of your business. If you're fortunate that your operations are not impacted directly, it certainly will impact your customers, your customer base. And that is such the case with Axela. We are fortunate our pipeline grid was developed in such a way that it can withstand the harshest of circumstances. And that has proven its case in this pandemic time. But our customers are affected. When you have a lockdown, they cannot move their products. And when they can't move their products, obviously they shut down their production or scale down their production. And that in itself will affect your financial performance. We've seen the case. Fortunately, in Axela's case, we are deemed an essentials business because about 80% or so of our customer base, it's in the essentials business, the category that the government designated as essentials. And that is the food and beverages sector, the power sector. So that has cushioned the impact on Axela's performance. But I'm not sure other corporates in the country will say the same thing, especially those customers that are affected directly. So you can see how that affects just the performance of corporates across the board, with maybe a few exceptions. Even ourselves, we saw a dip, a little bit of dip in our performance. But as I said, because of the majority of our customers are deemed essential businesses, we're weathering the storm quite well. Now on the commodity side, clearly Nigeria depends a lot on oil sales. So the slump in oil prices obviously affects the foreign reserves of the country. And that has put pressure on the currency, the Naira. We've seen quite a significant level of devaluation in the currency, both in the various markets. In the case of Nigeria, we have what we call the official rates. You have what you call the import and export window, and you also have the parallel markets. Each of these markets, has experienced quite a bit of devaluation. For example, the power market has experienced up to 20% in the last recently. The official rate's about 18% decline in the recently. So what that does is affects any capex that is dependent on importation of equipment. You see our prices go up quite a bit. So it affects your budget, and it in turn it affects your whole funding plan and the mix. So with this impact, because of the devaluation, you are very much exposed if you go ahead and make the necessary capex expenditure that you require. to either maintain your operations or future expansions. So one, you need additional funding to make up the shortfall that is caused by these increases in devaluation of your currency. But at the same time, you are wary about taking on additional foreign loans because you're exposed to FX risk. In Axela, for example, we've been successful in raising local funding through the capital markets. Recently we concluded about a month ago a $10 billion Naira raise in the local capital markets. It was oversubscribed by about 24%, and the rates are quite reasonable because of some of the policies that the government has put forth during the crisis, and that has had a very positive impact on the rates. I'm talking about the Nigerian capital markets now. But despite the crisis, the pandemic, we have been able to raise substantial amounts in the local markets. And as I said, Axela is an example of that. And it's a long-term financing, which is a very key element to it. I'm not talking about short-term financing here. Long-term, the market is quite ripe for the long-term funding. And that's what Axela has done. A 7-year, 10 billion Naira, which was oversubscribed. So we ended up taking the extra 15% that we allowed under the rules. So we took 11.5 billion Naira. So in a nutshell, in summary, the COVID impact is real. We've experienced it, fortunately for my company. We are sort of shielded because we're in the essentials business. The Forex, obviously the commodity prices has put a lot of pressure on the currency, which has experienced devaluation as much as 20% recently. But overall, I think the business activity is still strong, and we expect the same level of performance going forward. Though I must caution that the full impact of the COVID is yet to be felt. I think you will see it in the third quarter and perhaps in the fourth quarter. So I think the jury is still out, but we've seen some resilience on the part of some corporates in the country.
Thank you, Tim. That's very helpful to start with. If I could move to you, Ginu, on the same question, how have you been affected from a business point of view by COVID, especially from a supply chain point of view as well? Thank you.
Yeah, thank you, Samta. So for us, we are a group that's in manufacturing and also construction. So inevitably, we saw the first dip in demand, especially when the first cases of COVID-19 were announced. We attributed this to the wait and see stance of our clients and channel partners. You can imagine nobody wanted to hold inventory at that point. Everybody wanted to hold cash as they figure out how this was going to unfold. So the orders dipped, but what that created is a substantial pent-up demand that we hope we shall be fulfilling soon. We also saw a disruption in supply chain, especially when China shut down, and subsequent to that, India shut down. You think it's easy, but it's not easy to change your sources of inputs, particularly because of long-term relationships that are there when it comes to supplier credits, to quality control processes. So it takes a little bit of time, and as you know, when you change your suppliers, you take out your credit lines, then you actually have additional need for funding, and you have to find it. But eventually, that is something that we were able to resolve. And what came out is that there are actually other sources that ended up being cheaper than where we have bought before. So we now have options going forward. So that's a good thing that came out of it. We also had to do quite a bit of operational adjustments, especially when it comes to complying to health guidelines and social distancing guidelines, where we're doing shifts, different shifts in different days, as opposed to having shifts, 2 shifts in a day. And this will be to help us to be able to isolate entire shifts in the event, or in the unfortunate event that there is an infection. So that adds a little bit of costs, but at the same time, at the end of it all, you learn how to manage. Some of the other things, some of the other disruptions were things like inbound logistics and access to markets. And this is primarily because of restriction of movements as the governments in our region were trying to deal with the spread of COVID-19. So that is something we sorted, but created some before how we operate within the guidelines was very clear. That was a bit of a disruptive moment. On commodity pricing for us, fortunately, it's a good thing when commodities prices drop, because it gives us flexibility on our pricing. We have commodities are our input, especially copper and aluminum. So it gives us flexibility on the pricing. Sometimes it triggers some demand in some sensitive markets, and that is what happened. It also reduces our need for working capital financing or funding because the cost of our input has gone down, and we're looking forward to taking advantage of that, especially in this period. We also saw in our region a bit of longer working capital cycles, and that's because, as I mentioned, everybody wanted to hold on to cash, probably slowing down payments and forcing us to hold a bit of inventory. So that's another issue that created additional need for funding. All in all, we took the approach earlier to have conversations with our stakeholders, specifically banks and our financiers, and get ready to deal with COVID, or to ride the wave together with them and sort of synchronize. So where we needed to get additional headroom to cater for the increased working capital cycles, we did that. Where we needed to get some moratoriums to reduce our cash burn as we worked on riding the wave during this period, we did that. So I mean, generally that's how that's the impact to our business. It's a mixed bag. There's some good things, reduced commodity pricing, additional sources of inputs, and also to some extent a bit more focus in terms of the conversations with our stakeholders. We're looking forward to sorting out the demand, the pent-up demand. As you know, most of our clients are looking forward to getting back to business, and some of them are contracted projects, so they actually really have to go back, and a lot of pressure to actually start producing or to start construction. So that's the impact from my end.
Thank you, Chinu. I hope you can hear me. If I could move to Martin now for the next question. What are CFOs and treasurers' strategies for managing their balance sheets during and after the COVID-19 pandemic? How has pricing changed since the onset of the pandemic? It would be great to get your views on this, Martin.
Okay, I think I'll start with the pricing. First of all, it depends on the diverse. Sorry, I was on mute. Hello?
You're fine, Martin. Please continue.
Okay, I was saying it depends on the diversity of your funding structure. Where you have sort of like FX denominated loans, you find that due to the current volatility, what happened immediately, there was the first case announced in the East African markets. What we saw was investors in the equity markets divesting, and by that there was a liquidity squeeze, and the FX rate went up slightly. Yeah. So if you have an FX loan, at the end of the day, you end up paying more. You end up incurring a revaluation risk. But when you look at the liabilities that you have maybe in the debt capital markets that are local currency denominated or with the banking partners, you'll find what the government did, particularly in Kenya, they reduced the benchmark rate, which the central bank rate, from about 9%. Currently, it's at 7%. So you find in terms of your interest payment, you have sort of like a 2%, I wouldn't call it a benefit, sort of like a cushion to be able to cushion you this through this period, yeah. But the thinking is it's a chance to test the capital structures of businesses. One for sure is to be able to maintain enough headroom to run the business through sort of like a 6 months, 1 year period because of the uncertainty that has been created in the market. So from a pricing benefit where you don't have a fixed rate and a variable rate, the cushion is coming through the government initiatives. But when you're on a fixed rate, you still end up incurring the same cost in terms of borrowing compared to the rest of your portfolios. Yeah. The other experience that we've had is FX liquidity constraint, because there was suddenly a demand of dollars by investors divesting. So it's all a matter of planning your FX and spacing your trades until you're able to get your full material requirement. The situation has become a bit better. You can be able to access slightly more in the market. So the outlook is the market might be a bit more liquid as we go to the next fiscal year.
Thank you, Martin. Dipen, you have accessed the bond market in Nigeria. There was also a Bloomberg article last week talking about how Nigeria bond sales are heading for a blockbuster year. It does mention the MTN Nigeria financing that was raised in the local market. It would be great to hear your thoughts on how you are seeing the COVID impact your business, especially on the funding side, and also comments on pricing.
Thank you, Samta. Look, the one thing that COVID has taught us is that you can never be too prepared and you can never plan for every scenario. The one thing that we've seen is that COVID has created a great deal of uncertainty for issuers, banks, and everyone participating in the capital markets. I think, you know, the Nigeria story is a very positive story. It's got good, you know, it was very well received in that market, very good press. It was our debut issuance in that market. We did 100 billion naira under our CP program, split across 180 and 270 day CP. You know, the pricing was fantastic. It allowed us to reduce our overall cost of funding and gave us as well access to new sources of liquidity. So the strategy in Nigeria was more to sort of diversify our sources of funding as well as reduce the cost of funding. If we look more closer to home, you know, and I'll come back to Nigeria, but if we look more closer to home here in South Africa, before COVID, you know, at the beginning of the year, we had a plan to do refinancing at a group level of 15 billion rands over the next 12 months. We were at a fairly advanced stage before COVID hit us, you know, in late February, in securing offers for bank funding of 12.5 billion rand. Effectively, once the pandemic hit, we had to go back to the drawing board. So what we found that a lot of the local banks, as well as international banks, were uncertain as to their cost of funding, and they were uncertain as to how the pandemic would impact corporates in the various sectors. Now, us being in the telecommunications sector, we have been shielded to an extent from the COVID impact, but still, I think there was still a lot of uncertainty given the markets that we're operating. People still wanted to see a few data points of positive performance before they were willing to commit. To cut a long story short, I mean, it took, you know, at least 2 months worth of negotiations with the local banks back and forth on pricing, back and forth on appetite. We were quite successful in that we managed to close 10 billion rands worth of funding in May of this year. That was across two facilities. One was a club facility for 6.5 billion rand. The other was a 3.5 billion rand bilateral facility. What became apparent was that relationships with banks became critical in us securing that funding. We were fortunate in that these relationships have spanned many years, over a decade with these local banks. And we were able to leverage that. From a pricing point of view, before, what we've seen is that the facilities priced in the region of 50 to 70 basis points wider than where it would have priced pre-COVID. So before COVID hit us, we were negotiating, and we were leveraging the relationship quite strongly. Post that, even with leveraging the relationship, the pricing had still widened. And a lot of it was due to the fact that, banks had indicated that their cost of funding had went up. And due to the uncertainty, they needed this additional premium. I will also mention that during this period, MTN was downgraded twice by S&P and once by Moody's. That is particularly because we are very closely linked to the SA and Nigeria sovereigns, and both of these sovereigns were downgraded during the same period. It was still a good outcome. Given that the base rates had come in the region of about 275 basis points in South Africa, the fact that we closed about between 50 and 70 basis points wider is, it still means our all-in cost of funding is lower than where we would have issued pre-COVID. So that's on the bank funding side. And if you look at the local debt capital markets, as part of that 15 billion rand I mentioned earlier, we were looking to do 2.5 billion rand of that in the local debt capital market space. We were planning a roadshow before COVID hit us, and we had to put that on hold because effectively the local debt capital markets in South Africa were closed. Asset managers were sitting on the sidelines waiting to see how things would work out, how things would pan out. I think they were more focused on dealing with existing exposures, credit committees were more reluctant to take on new exposures. Amidst all of this here, we were still fortunate in that, we managed with a few select investors to place a 1 billion rand note for 12 months with a few select investors. That note was 100 basis points wider than where we would have priced it, or 100 basis points wider than our last 12-month issuance. We were still very pleased with the outcome in that the base rates, as I mentioned before, had come in, so all-in costs of funding were lower. But what it did was it gave a very strong signal to the market. We placed this note before we closed the bank funding. It sent a very strong signal to the banks to say that, the credit fundamentals, despite what has been happening, the credit fundamentals of MTN have not changed. In fact, they may be bolstered by the pandemic. And the reason why we also placed the note was we needed to stimulate the market. So we're one of the larger issuances in the local space, and we needed to stimulate the market. It indicated that some select investors were looking to come back to the market, and we think this has been positive for the market overall, where we've seen more issuers now doing private placements since that placement that we did. So that was a great outcome, in the local DCM space. And we're looking to do more in the local DCM space, in the coming months. If we look across the other markets in Africa, in addition to Nigeria, in Ghana as well, we were looking for funding of 450 million cedi. We were fortunate to have closed that facility in the last month, 5-year facility with local banks. If we compare the local debt capital markets in Ghana versus Nigeria, the Ghanaian market is not as robust from a liquidity point of view, and that is why you tend to see corporates and issuers tend to access the funding from local banks rather than the local capital markets. This is very similar, to the Kenyan market that where Martin operates and what he has spoken about. So we saw that in Ghana. I think if we compare the South African local debt capital markets versus the Nigerian capital markets, it's two sides of the same coin, so to speak. But what we see in Nigeria is that the credit fundamentals, that information about a deterioration in credit fundamentals hasn't filtered that quickly into the market. We still may see that coming, but there's a great deal of liquidity available in that market that's available at fairly competitive pricing. In the SA space, we think that effectively, the negative contagion from the local equity markets have spilled over into the local debt capital markets, and that's why investors have been, a bit more conservative and holding back in actually taking up new issuances. That is why we've also seen the widening in pricing. So it's another different or very important point to note that in Nigeria, there's a lot of high net worth individuals that participate in these issuances. Whereas in South Africa, it's mainly the large asset managers, and I think that's the reason why we're seeing, that key difference. And I think if things continue in this vein, in Nigeria, I think it'll be great for that local debt capital markets. We certainly are looking and watching this space very closely, because we do have fairly large needs in Nigeria, and we would in future look to do a bond as well in that market. If we look at some of the other markets, there's a continuing pressure for us, to access funding in the local debt capital markets. And, if markets like Nigeria, continue in this vein, it'll most certainly, be well for the other countries in Africa as well.
That was very helpful and a great comparison, Dipen, of the various markets. If I could continue on that line of thought and ask you two quick follow-up questions. So I note that you've compared a couple of the different markets, but do you think that even in markets like Nigeria, where it seems like there are pools of local liquidity, do you think that there is enough local liquidity for you to continue using funding from the local sources? That's the first question. And then the second one is, how do you think the financing strategy from an MTN point of view could change in the mid to long term as a result of this pandemic?
Thanks, Samta. Look, I mean, in Nigeria, I mean, our needs are very, very, very large in that market. I mean, with the foremost telecom provider in that market, and we've had a long track record of accessing bank funding. In the past, we've had to supplement our funding from in local currency from local banks with offshore facilities, but that brings additional risk to the balance sheet, in that in the event that hard currency is not available, it just introduces volatility and uncertainty for the company. And that's why we've tried to focus on local currency financing. Certainly, we think that there is sufficient liquidity to meet our needs in the local market from banks and the local capital markets. From a diversification point of view, it allows us to reduce the cost of funding, and certainly we wouldn't look to only be doing issuances in the local debt capital markets. We would always use relationship bank funding as well, because in times of uncertainty, you can always still lean on relationship banks because they see the ancillary business on the other end of the spectrum, and they're able to tide you out in times of difficulty. But most definitely, we think that there is sufficient liquidity, particularly in the Nigerian market, and to the extent there's a step change in the business, and we need any additionality. We would look to access international capital markets. We have in the past, and there is certainly a great deal of appetite for MTN Nigeria risk from the international community. From a overall funding strategy, certainly we will be more prudent in the way we approach funding. We've already started looking at counter-cyclical measures and indicators for the business. We look to maintain certain amount of headroom, and that has been very positive for us during this crisis. But what it's also taught us is that you never know where the bottom of the cycle is, and we will obviously be looking to refinance facilities earlier than we did in the past, like we did in SA. We would look to increase the level of headroom that we normally maintain, in the opcos, as well as at a head office level. And most of it is more just to be able to deal with the uncertainty, because generally what we've seen is that the uncertainty is more, is more from a time point of view, and you need sufficient resources to be able to get you through that uncertain period, from a timing point of view.
Thank you, Dipen. Tim, if I could request you to also comment on the questions that I mentioned before, which is how will the financing strategies change in the mid to long term? What are you seeing in terms of local liquidity? And also if there are any comments you would like to share on FX hedging and how the exchange rate to the hard currencies such as dollars and euros influences your decision on the currency of funding.
Sure. I think with respect to funding plans and requirements, it really depends on the business you're in, how you see your capex shaping up in the short to medium term, as well as long term. In our case, we have to take into cognizance the market we're in. As I mentioned earlier, Forex, it's an issue today in Nigeria. So you have to take that into consideration in the kind of financing that you raise. And also overlay that on your business plans. Given the currently, some of our debt mix includes shareholder loan. So we've been able to get into a hedge product for that, so that it doesn't distort our performance on a year-on-year basis. So we got into a non-deliverable forward contract with a bank. We hedged it out a year out. Fortunately, in the Nigerian space, you can hedge out up to 5 years with this product, but it can be quite expensive if you go beyond 1 year. So we opted for a year and then roll over. We've rolled over once. So what it does, it smooths, it presents the true picture of your financial performance over time. So you don't get involved in this accounting impact, at the end of the year, especially when you have an exposure to Forex, loan instrument. But given the situation in the country today, that's why we opted to go for local funding, so that we minimize any Forex exposure we will have. Going forward, I think we'll apply the same principle to the extent that the cost of borrowing locally, it's not out of work with what you get foreign borrowing. So you always have to weigh the two. One gives you perhaps a lower cost of borrowing, but you're exposed to Forex risk, which can wipe it out if things take the wrong turn. On the other hand, if you get local financing, especially if you get a fixed rate instrument, which is what we got with the debt, capital markets that we raised. As I said, it's a long-term financing and it's a fixed rate financing. So that fits our operations quite well, because any project in the gas distribution space, these are long-lived assets, that you need long-life financing or long-term financing to be able to. That makes sense for this kind of assets. But we are very careful so that our financing mix is diversified. I think that's a good point that Deepan mentioned. You need to build that into your financing plan or strategy. We have a mixture of bank financings, and that bank financing includes both overdraft facilities. It includes mid-term facilities and some long-term. You might be surprised. There are some bank facilities that go out 10 years. We got that in the Nigerian Infrastructure Development Fund. But one of the reasons why we went out to the capital markets, apart from diversifying, our funding mix, was also to lower our cost of borrowing. So that's also a factor in our decision to go that route. And we were successful in that. If you time the market right, you benefit from this aspect of the funding. So these are the considerations or the factors we take into consideration in plotting out our financing strategy. And so far, we've been able to execute them appropriately. I don't know if there's another area you would like me to touch.
No, thank you, Tim. We have some questions coming in. And Gino, if I could request you to comment on the medium to long-term impact on financing, as well as if you have any comments on a question that has popped up. Have investors' appetite for corporate debt changed since the outbreak? I think it's quite related. Is this justified, or is it more of a general risk-on approach to emerging markets?
Yeah, thank you, Samta. I mean, for us, where I see it, I think the question of the impact of this pandemic on financing going forward is a key question. Where I have to ask myself, and it's a concern for me as well, is how do businesses continue getting funded, given the impact that is going to be there? Because across all economies, you can easily conclude that there is going to be breaches in covenant. You can easily conclude that there's going to be a downgrading of rating of some corporates. And looking at that, you have to ask yourself, and also if you look at the banks regionally, at least some of the moves they are making, they showing perhaps lower risk appetite, and also investors are showing a bit less lower risk appetite. So you have to ask yourself, what is the impact going to be? For us, what we are focusing on is more of more diversified funding, and particularly funding short-term working capital, even going to the extent of getting some of our clients funded so that we don't have to take the credit risk ourselves, and the banks can do that. So they lighten the burden of having to raise a long-term funding under these uncertain circumstances.
Thanks, Chilu. Martin, there is one more question that has popped up, which I would like to pose to you. It says other regions are...
Sorry, I think we've just run out of time, unfortunately. I apologize for that. We have to keep the time very tight to make sure that those who are logging in for specific panels can have access to them straight away. For anyone who does want to, we have received a number of questions for this panel, and any of you, of the viewers that would like to ask questions to panelists, don't hesitate to get in touch with them directly via the platform. I'm sure they'd be pleased to answer any follow-up questions that you might have, and to organize video conferences with you. I would like now to invite our next panel to join us on screen. So the next panel will be moderated by Matthew Dagan, Head of Syndication at ABSA. Matthew, hello.
Hi, Cedric.
Hi, how are you?
Good, thanks. You?
Yes, very good, thank you. So you will be moderating the next panel, which comprises Simon Howie, so co-head of South Africa and Africa Fixed Income at 91. Hi, Simon.
Hello.
Joe Delvaux, Chief Investment Officer, Global Fixed Income at Emerging Markets Investment Management. Hi, Joe. David Rajak, Capital Markets and Investor Relations Executive at Bayport International. Brooke Hobak, Executive Director at ALCB Funds. So Matthew, I'll let you moderate the next panel. Hi everyone, thank you for being here. The floor is now yours.
Thanks very much, Cedric, for the introduction. Good afternoon, ladies and gentlemen. It's my great pleasure to host what I hope will be interesting and insightful panel on the topic of understanding price discovery in African credit. I'm joined by an esteemed panel of experts who are uniquely qualified to offer both an investor and issuer perspective on this issue. I'm very keen for this to be an interactive session, so please do feel free to submit your questions, and I'll certainly allow time at the end to address these. Simon, perhaps I can start with you. The Emerging Africa Infrastructure Fund, which is managed and advised by 91, played an anchor role in the recent Helios Towers bond, which was a huge success and constitutes the first African high-yield corporate to reopen the dollar bond market post-COVID-19. I guess a couple of questions, if I may. How do you think about pricing a Pan-Africa credit like that? And were you surprised by the final outcome in terms of pricing and level of oversubscription?
Yes, I guess some context first, because I think we find ourselves in quite an interesting situation in some of these issues, in that, within the sort of business and within the fixed income business, we are managing both, the Emerging Africa Fund, which is very much a developmental type fund and actually gets seen as a DFI. And we also have commercial funds alongside that. And on the commercial side, it's an interesting one in that we have both the Africa funds, which are closed funds, which focus on the listed and unlisted market that participate. But we also have our colleagues who operate mainly out of London, looking at the emerging market listed credit world. So we kind of see things from both perspectives. And I guess, an interesting one, seeing this bond issue coming out and seeing the issuer reaching out to effectively the DFI community, of which Emerging Africa is one, and wanting, some assistance. And for us, we were watching this market saying, wow, this market's pretty hot. This issue is probably going to be pretty successful. But you can see, the nervousness, I guess, from an issuer. They're sitting there not knowing what next week will bring and not quite sure, exactly, is this going to be a hot issue? Because it's really difficult to tell. It's been very volatile. So in terms of, were we surprised? Well, I think we're pretty shocked, but not by that issue as much as the market in general. That issue is just part of just what we've seen as just the most incredible rally, as we've seen this enormous liquidity come into the market. And this bond issue, is very much targeted by the big global sort of emerging market investors. And again, we know that because of our colleagues who sit within it, also funds like ours who sit in Africa, the commercial funds. So we have that kind of perspective. So yes, surprise, but surprise more generally at the market, and the pricing, in line really with what we've seen elsewhere. I think the Emerging Africa Fund plays a nice part in, it gives a sense of governance, that extra work's being done. It gives a little bit of comfort, at least a part of that bond issue is done. And I guess helps to some extent on the pricing, at least you've got sort of an anchor there who's not that pricing sensitive.
Yeah, thanks, Simon. I think it's a good point on the sort of DFI angle, which I'll certainly come back to in terms of sort of the halo effect. But Your point's well made. I mean, that transaction started as a sort of partial refi with anchor support from DFIs, and ended up being, an order book, I think, in excess of $3 billion, and actually the base deal being significantly upsized. Do you think it sets a helpful precedent for other African issuers contemplating accessing the market?
I think it's actually quite binary. If you are an issuer that catches the eye of the big global investors and you fall within those sort of benchmarks and thresholds of liquidity and size, and I guess sort of credit standing, then it is the precedent. And in these kind of markets, we're seeing multiple issues every day. So yes, it is a precedent. If you don't, it's a very different story. Then you're looking to liquidity that's far more constrained. It's a much more difficult story. So quite binary.
Thanks, Simon. Joe, notwithstanding the success of Helios Towers, and I think Simon's just made the point around it being potentially quite a binary market, from a corporate standpoint, but there's obviously been quite extensive press coverage of the ongoing discussions between the representatives of the Paris Club creditor countries and African sovereigns regarding debt moratoriums, and Zambia has recently appointed Lazard to assist in restructuring its debt obligations. How do you, as an international investor, view these developments? And will there be an impact, do you think, on these sovereigns' ability to access the capital markets going forward?
Thank you for the question, Matthew. I think it is very important to put this, as Simon also said, into the right context. We heard the first discussions about debt moratoriums, and potentially even debt restructuring for some of the sovereigns coming out in the middle of March. One of the push has been obviously coming from President Macron at the G20 saying, well, there should be a debt moratorium being put in place from the G20, but on the commercial side, we should also see some action being taken there. Now, the element here that has been, I think, more of a shock coming to the system was that we knew that there were countries that were in a weaker stance coming into this already. Talking of Angola, talking of Zambia. But then to have countries where we were less expecting it, say Senegal, becoming quite vocal, or Ivory Coast to some extent also becoming vocal at the later stage, that has been quite a surprise because to some extent these countries have been actually faring quite well, and were countries where even if we saw growth coming under pressure, the IMF's forecast for growth would be still positive around the 2-3%. So it has been a bit of a question mark. Well, is this a capacity issue of not being able to repay, or is this becoming a question of willingness suddenly that becomes an issue? And I think a large part of then also what plays a role is the element that this come in the middle and huge market meltdown. We haven't seen crisis in terms of rapidity of how fast bond assets have been trading down. And so you start off questioning a lot of things. And this obviously then has as a consequence that people were starting also to try then to sell and protect their investors in their funds by trying to shed some assets, making sure that there's cash available for redemptions that are coming up. And this obviously then creates even more pressure on the system. When these markets have no strong local bid in the sense of these aren't markets like, say, for instance, South Africa or Turkey or even Brazil. When we talk of Sub-Saharan Africa, when we take South Africa out, a lot of these markets do not have a firm local bid where local asset managers or pension funds or even banks can jump in and actually take up the slack that comes up from the international community. So you see this all coming under a huge amount of pressure. And that is why then suddenly you have bonds, let's say like, for example, Nigeria 2021 sovereign bond, that was trading at 115 at the beginning of March, trading down to 63.9 in cash price at the low. Or Angola that went from 107 down to, the extreme case down to 37 after Bloomberg. And I'm pretty sure there were actually trades taking place at lower prices than 37. With people that probably are very upset about having traded that right now, seeing the rally that these bonds have been coming under. But I think you see, now as time has been going along and more conversations were had, and also the working group having had conversations where we saw a lot of other participants being involved, there starts now being a bit more serenity coming. And also some of the issuers actually saying, well, yes, we were talking about using the DSSI, but also we want to understand exactly what the impact of this is. How do rating agencies look at this? And I think so far we have had 8 countries actually that have Eurobonds outstanding. So 8 saying yes, applying for DSSI, 5 saying no, we're not going to do it. Now, of course, this is country by country. You have to look at it. You know, like say, for instance, a country like Benin has an annual coupon to pay, and they just paid it a couple of months back. So of course, it's a complete ball game for a country like this than another country that might have several coupon payments that are due right now. And also, again, how much borrowing is there actually taking place, and how much benefit would they actually get out of this? Now, the rating agencies have been highlighting to some extent that some countries that put them on negative watch, highlighting exactly saying, well, look, we don't know exactly what the consequence of this DSSI application is going to be. We're not going to downgrade you now on the basis of you using it, but we're just remaining cautious, and that is why we use a negative outlook. And I think Senegal and Africa might have been one of the recent ones where there was mention of this. But it doesn't mean that the countries have been downgraded on that basis. And now, of course, we also had now, I think yesterday, the good news going out from China and Angola, where they were saying, look, we found an agreement on a 3-year moratorium on some of our debt. And that this hasn't yet been finalized, but it definitely will take some of the early pressures out. And I think the more as we go along, the better understanding we have, the more communication we have. And that is, I think, the core issue here is about communication. It's about political element being put forward of saying, yes, we want to participate in this DSSI, and yes, the commercial side should chip in. But then now we come back down to, okay, what is the impact? How will this impact our accessibility to the markets? And I think as we stand at the moment, there's only really Angola, Republic of Congo, and Zambia, Seychelles maybe as well, depending on where they actually trade at the moment, that actually I would say trade at spreads that are over 1,000 basis points, and where you could actually say, look, the markets are properly shut at the moment. However, the majority of other countries are now trading at bond yields of back around 7, 8, 9%, which makes it more acceptable for someone actually going back to the market. It would be kind of summarizing slightly the elements.
No, thanks, Joe. I appreciate it. It's a complex topic, so thank you very, very much for your input. Brock, I guess I was keen just to come back to one of Simon's comments. You know, I think it's a very valid observation that we're seeing DFIs, developmental lenders, playing an increasingly important role in anchoring transactions, particularly for debut issuers and more esoteric credits. Just keen to get your perspective. You know, do you think this is a helpful development? And then I guess just a follow-up question, you know, if I may. You know, we're seeing active sponsorship of local currency market, which is something the African Local Currency Bond Fund, which you manage, has pioneered. You know, how important is it for issuers to take advantage of that domestic liquidity, you know, as opposed to defaulting to the international markets? So apologies, 2 questions there.
And as you sort of rightfully point out, I think just before I answer your question, the ALCB fund, we generally predominantly invest in local currency and through the local capital markets. Of course, the lens I apply is based on that. Regarding your first point around the role of DFIs in pushing forward new and innovative or esoteric credits, as you put it, is that I think they absolutely do have a role to play, and this is really ultimately the premise of the ALCB fund and why it was set up, which is to support new and innovative transactions and really push the markets, whether that's by not necessarily be something as familiar to the local market or also the sector for which they're on. And I think broadly this deals that are available to local investors, allowing for diversification, and it's also helping the local issuers in terms of tapping into local capital markets and finding a new pool of potential investors to come into their funding mix. Of course, for the issuers as well, it's quite helpful in the sense that it helps them to reduce FX risk, which is, I think, something that's quite relevant in the current context, and I'll get to a bit more later. With regards to sort of the role of the DFIs within this, I think what we really bring to the table is a understanding of what are the international best practices, and can provide comfort and confidence to the local investor community that, you know, when we sort of look at aggregate transaction, the documentation is in a relatively sound form, and that there's been an appropriate level of credit analysis. And you know, I think that's quite important when trying to push for slightly. Is my audio and video not working? I'll turn off my video. Which I think is
no, Brock, you fine.
Okay, I just got a message from Nathan. And I think these are things that are quite important when you're looking at slightly less vanilla transactions or at sectors where local investors may not be as familiar. And really, you know, sitting on this panel is actually a perfect example of what we actually want to accomplish through the ALCB fund, and what I think a lot of other DFIs and developmental lenders are also trying to accomplish. So, you know, the example I can give is Bayport and our experience with them in Botswana. And, you know, when you look at them, our first investment in 2013, they were new to the market. Local investors weren't familiar with them. They weren't necessarily familiar with the business model. And we came in and anchored that first transaction. And since then, it's been something that's, you know, they've been able to come into the market on multiple occasions. And I don't think it would necessarily be viewed as an esoteric credit at this point in time in Botswana. You know, they would arguably be one of the larger issuers in the country, in the local capital markets. Regarding your views or your question around domestic liquidity and the need for companies to tap local investment, I think this is absolutely crucial. And this is something that's that becomes more evident in the current macro environment that we're operating within. I think it's fairly evident to say that, you know, businesses with a greater number of taps for liquidity or sources of funding will generally be more resilient in this current environment. And local investors should, of course, be a key component of the mix of any of these types of businesses. And really, this is quite important for several reasons. The first is that local investors and local currency funding reduces your FX risk, and many companies in this current environment are likely to have experienced sizable FX losses due to the current FX volatility. The other thing too is local investors tend to be more sticky, whereas you may see international investors at this point in time fleeing from emerging market or frontier investments. You know, at the end of the day, Kenyan investors will continue to look at Kenyan assets, or at least will be more likely to do so than an external party. And I guess also another point is one could argue that you know, some local investors, particularly if they're familiar with the credit, are more likely to be able to react more quickly and actually support the business if they're comfortable with it, relative to, say, DFIs, which can, you know, arguably move a bit slower. And I guess maybe just with my points, you know, this is what we are observing within the local capital markets across Africa. You know, there are still, particularly in markets where there's relatively deep pools of liquidity among local investors. And so, for example, in the UEMOA region in Nigeria and Mozambique, you are still seeing some transactions, granted with slightly higher quality credits, but ultimately that's just because of who's come to the market at this point in time. And these issuances have been largely successful.
Yeah. Thank you, Brock. I think that's a perfect opportunity to bring David into the conversation. David, as Brock alluded to, you know, Bayport, very active, experienced issuer in both local and hard currency markets. Keen to get your perspective. How are you viewing current developments on both fronts, locally and I guess internationally? And what guides your thought process from an issuance perspective?
So thanks, Matt. And I can echo what Brock said with regards to, you know, the support, having a strong anchor like the ALCB coming into transactions. It really does help, as Brock said, starting a debut issue, getting your name out there and showing the stamp of approval in terms of international best practices. So just to echo what he said there. As an issuer, you know, in the hard currency markets and in the local currency markets, two very different experiences. We are a slightly smaller issuer in the dollar markets. Our largest issue has been last year's $260 million social bond. And price discovery during this period has been absolutely confusing for us. We're hearing every single day, distressed sellers are offering at ridiculous levels. You've got buyers who are trying to buy at lower levels, but trying to protect portfolio levels. liquidity has been very, very thin. Now, I'm not talking about the same type of volumes that Simon was referring to in terms of his portfolio, in terms of his transactions, but in the sub-Eurobond space, it's been very confusing for us to actually find out where the real marks of our portfolio of our bonds are and where people are willing to buy and sell. But as things tend to normalize and as things tend to quieten down, we're seeing trends starting to come back, and you're starting to identify where pricing is, correctly or incorrectly. But there is a reluctance of sellers to sell at the moment because people obviously don't want to book losses. And there are a lot of buyers out there who are trying to buy, but prices aren't moving. So, I think it's just a function of the market dislocation that we're in now in terms of the dollar market. Local currency is a very different story. And again, as Brock said, there's always a demand for local currency assets. During March, when the whole world was shutting down due to COVID, we issued another bond in Mozambique that was 1.5 times oversubscribed. We've seen that as well in other periods of macro dislocation of macro issues in Mozambique. Again, when they were defaulting, we placed our largest ever bond in the country, the largest ever corporate bond being placed. And it goes to the testament that local investors still need to place their money. They still need to do something with it. We still plan to be issuing this year more in Mozambique, more in Ghana. If things stabilize in Zambia, who knows, maybe a bond in Zambia. Local currency assets will continue to go because the local investors need to place their money.
Thanks, David. I just want to pick up on that point, Simon, if I may, that David made quite well. And it's something, I guess, from an ABSA perspective, we're equally passionate about in terms of continuing to develop local market capacity. As David and Brock both mentioned, we've seen incredible local market capacity in countries like Nigeria, Mozambique, even during the onset of the COVID-19 pandemic. We, from an asset perspective, were bookrunner on the inaugural 5-year fixed rate bond for Dangote Cement, which raised 100 billion naira, the largest ever corporate issuance in Nigeria, achieved during the midst of what was a very stringent lockdown in April. I think David made an interesting point, which I know is an issue for our market here in South Africa from a Rand perspective around the ongoing challenge of price discovery and where to kind of mark assets. I just wondered if you had a perspective on, at least as far as the public market, why SA has effectively come to a little bit of a standstill. We're seeing this hiatus at the moment. And what can be done, if anything, to help stimulate, more public primary DCM activity?
Yeah, it's fascinating to kind of hear the extent of the liquidity that you are seeing in some of the other countries in Africa. What we see in South Africa is that it is a deep and large credit market in South Africa, but it's an extremely risk-averse one. So the majority of money is managed, credit money is managed in conservative portfolios, conservative mandates. We're one of the few asset managers that have got mandates that extend, and strategies that also cover the, kind of the high yield, the unlisted, and can actually look at, credits that are deteriorating a little bit. What we find in South Africa is that any deteriorating credit suddenly has no liquidity. And then in periods of stress, investors are just focusing on the liquidity that they need to offer in their funds because they're holding this credit often in funds that offer daily liquidity. They're worried about where things are going. They're sitting back and just seeing kind of the risks that are emerging. And it's highly correlated in terms of the investor behavior. You've got insurance companies out there, a lot of asset managers, but it's a lot of buy and hold, very conservative, highly correlated. That said, what we do know from previous crises, and we're seeing it happen now, is that liquidity starts building up and slowly it starts turning, and there's asset managers, we see that in our conservative portfolios, the cash is building and you need to start putting it to work. And we are ourselves starting to see a little bit of opening up. We're putting money to work. We're seeing others do that. And we think it will come, not quickly, but it will start opening up from here. But I think it's just the nature of our local market with exchange control. It's very kind of self-contained and strange in some ways.
Yeah, thanks, Simon. David, sorry, I wanted to come back to you if I may. Certainly something that's becoming increasingly topical, particularly in the international markets. But last year, Bayport became the first ever Africa corporate to issue a dollar-denominated social bond. And we're now seeing a massive uptick in social bond issuance, which I think is going to start to eclipse the green bond activity that we've seen recently. Is this something issuers should be aware of? And from your perspective as a kind of a pioneer in this field, for African issuers, could it potentially help attract support from a more diverse investor base, which I know is something that is often mentioned in this context?
So thanks, Matt. I was listening to a couple of the earlier panels on this in this conference, and there's obviously a big drive towards social bonds, social mandates, and things like that. Some anecdotal experience from our side, and again, please understand this wasn't a big Eurobond issue appealing to all and sundry. We issued a $260 million senior social bond last year, and then we also did a subordinated social bond, which is the first subordinated social bond done globally to our knowledge. And we issued out of the Nordic markets for historic reasons, but still a dollar bond. So we estimated last year when we came to the market literally a year ago, in June last year, that about 20% of the investors were able to buy because we had the social bond moniker. So we had been through the process, we had the rating, Sustainalytics had opined on it and said, you are a social bond, you qualified for ESG mandates under the social bond guidelines. You'll be shocked how many of the major institutions, and I'd say more so in the US space, or the US time zone than in the European time zone, where the first few questions in the meeting is, what is a social bond? Everyone knows about the green bonds, and the green bonds are out there. But social bond last year was something very new. It's becoming a lot more common now, and again, going back to what we saw. But it's not difficult to issue a social bond, and I guess it depends on who the issuer is. We've been funding, as Brock said, from the likes of Brock for years. The other big DFIs and impact investors, we've been funding from them for years. So our reporting that we see as everyday business was very simple for us to do, to apply to the social bond principles and how we align ourselves and get the rating. Things that we take for granted, such as Smart Campaign, which every financial services company globally should ascribe to, because that's around responsible lending. We were the first company in Africa to get Smart Campaign accreditation. For us, the first thing when we spoke to Sustainalytics, they said, "Are you aware of Smart Campaign?" Well, actually, we've got it. EDGE certification around gender equality. These are type of things that for us is ordinary course of business. And so for us, it was really easy to fall into the social bond sphere. For companies that are looking at this for the first time and haven't funded from the development community or the impact community, it can be quite challenging at first, but once you understand the processes, and as long as you stick to what you're supposed to do, it really shouldn't be a problem.
It's very interesting insight, Dave. So I guess just to follow up on that then, from your perspective, then it's not an overly onerous or expensive option, effectively. David, I don't know if you can hear me. Okay, I think David might have been just frozen there for a second. Joe and Brock, very keen to come back to you, if I may. This is a question that I get confronted with on a very regular basis. So I think again, you've got sort of quite interesting perspectives from both a hard currency and a local currency perspective. What I was keen to ask you, maybe start with Joe first and then turn to Brock, but how do you as investors view the arbitrage between local credit and pricing for the same credits in hard currency? The question really being that when issuers access the international markets, does it attract completely new investors, or is there an element of cannibalization from existing domestic investors? This is something that, like I said, is a very hot topic of discussion with debut issuers contemplating accessing the hard currency market. So maybe Joe, if I could start with you and then offer the same question to Brock.
I think from our side, over the past 15 years to 16 years that we have been active in the Sub-Saharan African market and frontier markets as a whole, what we notice is that, frankly, there isn't really cannibalization going on, because the tendency is still and remains that you have a division between investors. You have your investors that focus on the local currency element, and mostly one funds that are focusing at that moment on local currency, and then you have investors that focus on the hard currency side. Now, the blended funds tend to being usually less sizable, or there seem to be less in the markets generally doing that. So now the other element is also in the frontier space. I mean, we conducted research, and we have actually an academic paper that myself I published with some professors in Cass Business School. We went over history over the past from 2001 up to 2018 and 16. Analyzing how macro data actually impacts local currency markets. And we did this on Africa as a testing case, but essentially you can really roll it out to the majority of frontier markets, which is that yield curves are very flat. They are very, the only movement that you really see tends to be coming from monetary policy rate. Or for countries that are more export dependent, let's say Nigeria or Angola, it would be your balance of payment that would indicate to you which way yield curves are going, which is a very easy transitory element where you know that, well, the oil companies are getting money in. This filters through into the pension funds. The pension funds, as has been discussed by the panel already, the pension funds buy local paper. In the majority of cases, the capital accounts of these countries are closed. So for foreign investors, we can come in and go out, but local investors cannot really leave these markets. It is actually, even for a country like Nigeria, where we could say, well, it has rather, compared to other Sub-Saharan African countries, has maybe a bit more sophisticated financial industry. Even there, large Nigerian institutions are not allowed to actually buy whichever assets they would like in port. It is not like like Nigerian pension funds can say, well, we want to hedge our Naira exposure, we're going to go and buy US treasuries, or we buy some German bonds. No, to my understanding, they can only actually buy Nigerian assets, so they might be able to buy Nigerian Eurobonds. But that element means that it is really, if your local investor base represents 70 to 85%, or even more, of your investors, well, at that moment, there isn't really cannibalization going forward, because your local investors are not going to be the ones buying your Eurobonds. These are international investors or international institutions that come in and buy this. So it is not, that element doesn't filter through. And I think from our side, that is also what we notice generally in how we invest in these markets as well.
Yeah, no, exactly. And I pretty much completely agree with what Joe says. It's funny though, because with the ALCB fund, we sort of look at it in the inverse way, which is, generally speaking, we're investing in tier 2 institutions who, and historically predominantly financial institutions, where the narrative is more along the lines of we have historically relied on bilateral funding lines in hard currency from MIVs, DFIs, those types of international investors. And now we're looking to source funding in local currency and through more institutional investors within our local market. And that's really our sweet spot. And as you can imagine, based on that, the cannibalization is relatively limited.
Thank you both for that. I'm conscious we've probably got about 10 minutes left, so very keen to encourage any questions from the audience. I know that one has come through, which I think is a very interesting question, particularly from a South Africa perspective, given how much focus there was on the Moody's downgrade. I think this might be sort of more directed at you, Simon, if I may, but the question is, how much has the recent downgrade from Moody's impacted pricing in the market? Has it been lost in the noise amongst other COVID-related disruption? I know from my perspective, and it's difficult to kind of disentangle the downgrade, the Whitby exit, and the onset of the COVID pandemic, but very keen to hear your thoughts on that.
Yeah, I mean, I think you've answered it there, Matt. It's you know, it almost felt like a non-issue because, you know, as it came through, you couldn't work out, you know, what was, you know, from that bit of noise versus the greater noise elsewhere. So, you know, for us, I think this was telegraphed so far in advance. You know, I think most, you know, global funds had moved already and positioned. You know, you always feel like there's still going to be some actual movement on the day because, you know, things are 80%, 90%. You know, kind of priced it, but never 100%. But it almost felt like it was 100% when it actually happened. So really for us, a non-issue. You know, again, we've got a very domestic focused market when it comes to certainly the credit markets, and you know, exchange control keeps it that way, and also the fact that we have very small issues generally. You know, each issuer, as you know, Matt, will have, you know, tens of issues out there, all quite small off programs. So no real impact, no.
Got you. Interesting. Thank you. Brock, question coming in to you, if I may. Of the African local currency markets that you focus on and cover, where have you seen the sharpest liquidity squeeze across those geographies? Is that something that you monitor, obviously, and concerns you?
Sure, absolutely. So, you know, it's funny because what we're seeing is sort of a continuation of what we were sort of beginning to observe even in advance of this crisis, right? So, for example, capital markets in Kenya have been stubborn for a while now, and likely the current situation hasn't helped that. Where we're seeing quite active participation, as we mentioned before, is really Mozambique, Nigeria, the UEMOA region, and you know, I guess there you have a much deeper local capital market that's been in place for a number of years, or capital controls, or a variety of other reasons that are sort of driving that at this point in time.
Thank you for that, Brock. David, question to you, if I may, as an issuer, and it's a good question coming through. I think that will resonate with a lot of participants, you know, in the conference. There's still a lot of nervousness and reticence, if you will, from issuers looking to access the market now publicly at spreads that optically look significantly higher than, you know, what they were, you know, prior to the onset of the crisis, etc. You know, some issuers, I think Deepan mentioned it from MTN in a previous panel. You know, like to kind of maintain a frequent profile, you know, in the market, and see value in terms of managing, if you like, or resetting, you know, market expectations on pricing. I'd just be keen to hear from you from an issuer perspective, recognizing some of the things we've talked about, some of the challenges on price discovery. You know, how do you think about sort of maintaining that regular profile in the market, even if, you know, spreads aren't as attractive as they were sort of 3 months ago?
So thanks, Matt. First of all, as an issuer, liquidity is king. There's no question about that, especially going into this environment where the global macro is very uncertain. We as an organization took a decision when we saw what was happening globally to draw down on all available liquidity that we could at the time, because liquidity in your hand is worth a hell of a lot more than a promise of liquidity from someone at another stage. So we were actually quite proactive around liquidity, and I do not ever recall this organization being as liquid as we are at the moment. The other thing about liquidity is you always have to pay the market price. We're never going to pick the tops and the bottoms. We issued right in the face of it, as I said, in Mozambique. Was actually happened to be our best pricing, where we were expecting pricing to push out. There was such a search for non-government assets and alternative assets from not only the institutional market, but the retail market going into this crisis, that we achieved our best pricing on that transaction. And we're going to continue to issue because as a business, we need to be issuing. And as I mentioned earlier, we'll be issuing later this year in Ghana, we'll be issuing later this year in Mozambique, hopefully in 1 or 2 other countries. We've just concluded significant facilities in Latin America for Colombia and Mexico, $200 million at least for the 2 of them combined. You know, and there you're paying the market price. But who says that the market price today isn't better than the market price is going to be tomorrow? Our job is to raise the liquidity and to use it as best as we can. We know what the pricing is in the market now, and we can work with that pricing in terms of our modeling and understanding what we need to do about it. But none of us can speculate what's going to happen after the European summer. Is there going to be another price dislocation, or are things going to strengthen? Now, I'll tell you that in 3 months' time. But at the moment, we can only work with what we've got. And so as we see liquidity becoming available, we're taking it. And would rather have the liquidity and pay more for it than not have it and need it.
No, thanks, David. I think that's a very well-made point, in terms of being very pragmatic and prioritizing, liquidity that's immediately available. I know that dilemma is something that's front of mind for a lot of issuers right now, as they contemplate issuing now versus waiting for, for later in the year. Simon, I wondered if I just come back to you. I mean, the Helios Towers transaction, from a kind of book runner perspective on that trade, is quite interesting in that there was two kind of schools of thought, if you like, from a buy-side pricing perspective. What we saw was a lot less price sensitive demand coming from emerging market mandates within the sort of parent umbrella of the institutional investors, if you like, and where there was a little bit more pricing pressure, if you will, was kind of coming more from high yield mandates. And I think, what was driving that is clearly, there is a new crop of, I guess what they call fallen angels now kind of in the high yield market, particularly, in the US, that are, offering quite attractive spreads, and that were, until recently, investment grade credits. I just wondered, from your perspective, did you see a similar debate between the various mandates at 91?
Very much so. I think at the end of the day, it's always driven by, what is your strategy, what's your parameters, what are your alternatives? So you're kind of seeing, with global funds that can put an allocation, into emerging markets, into Africa, seeing more value elsewhere. You've got your emerging market credit funds focused on the listed side, where big inflows into that market cannot put that money to work quickly enough, can't buy in the secondary, and really looking for assets. We've got the Africa funds, where we've tended to say, right, this is run a little bit too hard. We can go both private and listed on our credit opportunity strategy. So tending to, get a little bit involved. It's a nice running yield, but aware that this is quite expensive. So very much dependent on strategy. What are the flows being into that asset class? How hard are those, kind of investors working to put money to work? What are their alternatives? So very specific, I would agree.
That's interesting. Thanks, Simon. Joe, one question for you, if I may, and just picking up on one of the questions we had from the audience, but we saw some fairly eye-watering moves across the sovereign Eurobond market in Africa. To what extent do you think that activity was exacerbated by illiquidity?
Well, actually, I think I would say that it's a lot. I mean, that's obviously very difficult to define, but I would actually say that probably a very, very large part of this is due to illiquidity, because there's just no, you see, with the news like this coming out, when the questions are around about debt levels, can these countries repay, would they like to repay, how do we stand, are we looking at the haircuts across the board, are we looking at big restructures? There's obviously then a big drive for people to lighten up on these credits, particularly the focused or the specialist funds are very small, very few of us in the market. And then the drive comes from the big global EM funds, where, 15 years ago, Africa wouldn't really have mattered as a whole, with the exception of South Africa. But these days, nevertheless, in certain indices, sub-Saharan African Eurobonds account for about 6-7%. So these big global funds hold these debts as well. And when they start off wanting to shift bonds around, that is usually not in $5 or $10 million notionals that do this. And of course, where they're going to go is that, as we said before, there isn't really a local market or a local bid that can accumulate this. So, of course, this drives down the bonds quite substantially. And I think that is one of the reasons why we have seen this big shock wave coming through of bonds just dropping down 5, 6, 7 points on a given day. So it's very difficult to discern exactly how much volume has traded through at these moments. Probably actually very little, but it's very difficult to find the data on that. And actually, it's I mean, that is where my equity guys have a much easier life in terms of accumulating the trade data than we have on the bond side. But I would say, no, liquidity is definitely one of the key features that has been part of the price action.
Got you. Thank you very much for that, Joe.
Thank you very much. Sorry, we've run out of time, unfortunately.
No problem.
Thank you very much for thank you everyone for this excellent discussion. So for those of you who are watching, and would like to follow up with the speakers, don't hesitate to contact them directly by going to the People tab on the left-hand side of your main screen and searching for them. I'm sure they will be pleased to answer any question, any follow-up questions at all. So thank you everyone for your discussion. I will now invite our next panel, which will be moderated by Matthew Pearney, who is the head of ratings at JCR Ratings. Matt, how are you? So Matthew is coming online anytime now. Matthew, can you hear me? Hi, Matt. Seems to be having some issues with the sound. Hi, I can see you now. Okay, you're muted.
Yeah, sorry about that.
No worries.
I got kicked out the moment that we started the thing. So sorry. I didn't
That's
see
the beauty of technology.
See a child will run through as well.
Yeah. So Matt, I'll let you introduce the panel for the next discussion. Thanks again, everyone, for being here. The floor is now yours.
So good afternoon, everyone. I'm delighted to introduce this panel where we'll discuss how to navigate African loan and capital markets now and post-COVID from a funders and a credit rating agency perspective. Please do remember to write down your questions in the chat panel. A good panel is an interactive panel, so let's try and make it such. I'm pleased to introduce my fellow panelists, Joe Maharaj, the Head of Syndications and Distributions from Rand Merchant Bank in South Africa, Michael Fisher, Director of Financial Institutions Africa from KfW, and Konstantin von Moltke from Afreximbank as Head of Syndicated Loans. So I think today we've already heard about pricing concerns, liquidity needing a home, but also corporates and institutions valuing liquidity more. At the same time, we've seen and heard from issuers and funders about deals that have been done. But we thought it might be interesting to start this conversation with a little look back at the start of the year. So African capital markets seem to be doing quite well, even with the pandemic starting to bubble in the background. It'd be interesting to hear from our panelists, what were the expectations before global events overtook us? And why don't we start with you, Joe, on that? I think you're on mute, Joe.
Sure. So I think, looking back, starting, let's say, in January, from my institution side, we were actually quite busy in the syndicated loan market. I think we started the year on a very good note. But that said, I don't think we should detract from what was happening more broadly in the syndicated loan market. So I think Q1 2020 holistically was actually still quite a slow year. According to DealLogic, first quarter was down roughly 60% across CEMEA. And it's quite an important dynamic to note because it's really painting that picture of what we were experiencing in the market, which was a lot of liquidity chasing this very sort of scarce loan origination environment. And that led to the trends and the themes that I think we've spoken about many times leading up to where we find ourselves now, which is those dynamics around pricing tightening, tenor extension, really strong oversubscription and transactions kind of upsizing. So for me, you know, prior to sitting, we could go back to sort of January, February, my outlook for the year was much the same. I believe that those trends were going to continue to support the momentum we had seen in the syndicated loan market for Africa. Of course, dramatically different now, but yeah, I'll leave it there and maybe hand over to my panelists to also add their views.
Constantine, what's your view on this?
Yes, hello, I hope you can hear me. Good afternoon, everyone. So, Joe, I would say my outlook was I think more bullish. If I look back into my Q1, that it was a bumper Q1 that was heading into a bumper Q2. You know, the loan dynamics, as you quite rightly mentioned, were incredibly competitive. The main loan markets in Africa, which are essentially Egypt, South Africa, Nigeria, were all set to provide, you know, high levels of loan volumes. There were a number of jumbo deals that were lining up to be done, and a few did get done in that first quarter. There was the Bank of Industry deal, which was 1 billion euros, Standard Gauge Railway in Tanzania, 1.6 billion, Sonangol, 1.1 billion corporate deal in Angola. And, you know, those all got closed, and they got closed, and you know, they showcased the wide liquidity and investor base supporting these strong names on the continent. There were also a number of big oil and gas transactions, you know, NNPC, Nigeria LNG, you know, the Amazon TNOG acquisition, the Mozambique Anadarko project, Kenya pipeline. There were, you know, there was a very, very strong and a lot of activity across these sectors. And I think that you know, we had a very, very high and diverse investor base chasing these transactions, as you quite rightly said. The market dynamics were very borrower friendly, you know, downward pressure on pricing, outward pressure on terms and things like that. And that really, and we had a very active secondary loan market. So, you know, and the other thing that I think was very popular and looking to develop for the year was the sovereign market. And this wasn't just the 2-3 names that everyone was used to lending to. I think we'd seen an opening of that market, new sovereigns coming to market, and the, you know, investor base being receptive and actively looking to support some of these new sovereigns. I also think we had a very strong sort of symbiosis and, you know, a development in sort of innovation of, you know, blending normal commercial bank liquidity with development finance institutions, guarantee products, insurance wraps, and that was really working hand in hand very well. So yeah, I mean, those were my memories of Q1, and I remember it being the outlook. My outlook for the year was very bullish at the time. Thank you.
Thank you. Michael, were your Q1 as happy a memory as Constantine's?
No, I can't say that. I mean, we did at the beginning of the year had a good pipeline of deals, but I mean, as you know, my business is looking after the financial institutions, so looking at their kind of credit or refinancing appetite, which was quite given on the back of loan book growth we saw, and that stretched from Tunisia to Nigeria to Mauritius, partly Kenya after the lifting of the interest rate cap. Their new, life was braced into the market. So we saw quite a lot of appetite on the back of that, but in a much tighter market environment. And yeah, the picture since then has, I think, changed quite a bit. Although we have also closed some transactions on the continent, we did a bigger syndication which we led in Ghana. We also participated in a bigger syndication for one of the African trading companies, as well as a couple of smaller deals. But overall, yeah, there has been quite a shift in credit appetite, moving probably more from that to general liquidity requests or needs. And I think a bit, what also the previous panel, I think the colleague from Bayport was saying, there's a flight to liquidity from a number of institutions, and there's a great demand there. So we can't be unhappy in a way, except that obviously a couple of transactions we have been working on have also been, put on hold or postponed because a lot of institutions with coming March and lockdowns and scenarios being introduced had, to get their house in order, so to speak, or trying to get the house in order, and different objectives coming through.
Okay, lovely. I think that brings us on to our next question. The first case of COVID-19 hit the continent on the 14th of February. So happy Valentine's Day, everyone. And that was in Egypt. And since that time, we've had two major market events, an oil price war, and just pretty much negative news all round. However, despite a fairly inactive market, a few deals did manage to get done. And on the screen, hopefully you can see a slide that Joe was kind enough to put together for us. So it would be interesting, I think, from the panelists' point of view, to discuss what were the major considerations from your perspective for these successful deals. I mean, how did they get across the line? What can we learn from these deals that kind of went through during a time of severe stress? So Constantine, why don't we start with you, if that's okay? Or Joe, we'll start with you then.
Okay, sure. So, I mean, this graph is, this slide is by no means, completely definitive. It's the really sort of broadly syndicated deals we saw. And I guess what we're now talking about is kind of that orange block where we're talking about the crisis unfolding in the market. And as you said, it was a two-pronged kind of effect where, 9th of March is where we all woke up to an oil price crash on Monday morning. And then from there onwards, we saw kind of the impact of COVID-19 unfolding in our relevant markets. So when we talk about the deals that are done in that kind of orange block in amidst the crisis in the market, I really think there's two types of syndicated transactions that closed there. The first being transactions that had been launched prior to crisis, but were closed, while the crisis was unfolding. And then the second is the transactions that were actually launched and closed in the crisis, where we are sitting right now. And I'd like to start with that former group. So the former group were the deals that were live in the market before we saw the impact of COVID and the oil price. And the reality is those deals were sort of live, they were quite baked. And I think what really got those transactions done is that the banks actually really stepped up and honored their relationships and the commitments made. Perhaps it wasn't fully legal commitments, but reputationally and morally, I think the banks that were in these live transactions certainly didn't want to, as soon as the market started to quiver, walk away from their relationships and their borrowers. And they really stepped up and actually took these transactions to financial close, largely without renegotiation at all. And that loyalty of the banking market shows, because at that very same time, we were seeing the capital markets for, the debt capital markets for sub-Saharan Africa close while these transactions did forge ahead. And then in terms of the second set of deals, which is those that were launched within the crisis and have come to a close, I think there's some very clear features and a very specific process that's led to a formula for successful syndication. The Afrexim Bank transaction, 900 million raising, I think that's an excellent example of, the flexibility of the loan product and understanding that the landscape had changed, and yet there was still an opportunity to structure inside that landscape for a very successful and quickly executed deal. So if I look at some of those common features, and you can see it in that block where there's those 3 green bars, I think the first thing that jumps out at you is all of these transactions are short tenor. So reduction in tenor during that point when we were working through all of the uncertainty in the market, I think it really gives cognizance to the liquidity pressures that banks as funders were actually facing. I think another feature that we've seen is extension options with proper, pricing step-up mechanisms. So these extensions are, of course, at the election of the borrower, so we've created certainty for liquidity. But it is allowing for good upfront pricing and then ratchets thereafter, and borrower together with funder bank can watch how the market kind of unfolds, and we can assess as time passes how to term out. I mean, I've touched on it briefly, but I think pricing, initially, as we went into this crisis, the banks were facing pressure both from a liquidity and a pricing perspective, and those pressures needed to be recognized and did translate into loan margins. And the last thing I'll touch on maybe very quickly is process. I think, a feature which has become quite popular and is very useful is an accordion. So it makes sense for borrowers to sign in that initial liquidity very quickly and secure a transaction, and they can seek to upsize through the accordion. I can't stress enough how we've seen, a number of these transactions RMB was involved in, and really compressing timelines between launch to financial close is absolutely critical for managing execution risk when we're facing uncertain markets. I'll leave it there, but yeah, high level, I think those are the tried and tested kind of features that have allowed for successful deals to go through, even in a very uncertain and tough environment.
Okay, that was fascinating. So the products, the tenor, the additional liquidity considerations, getting stuff done across the line fairly quickly. Constantine, do you agree, or would you have anything to add or take away from that?
Yes, no, I would largely agree with that. But there's one point I think we can raise here. Joe made it sound like a very rational and easy response. I think there were a few dark weeks, and I'm saying that because as a leading arranger of syndicated loans, which Afrexim Bank is, and RMB are as well. I mean, when we engage with our clients and offer them loans on a syndicated basis, then of course, you have to have an idea of at what pricing you are going to raise what amount of liquidity. And you've got to know about your own deliverability. And I think there were definitely a couple of days, if not weeks, where that information wasn't there. Banks weren't sure about their own deliverability. They were all reassessing their portfolios, reassessing their revised appetite for risk, reassessing their ability to provide liquidity, and reassessing what their new level of pricing was that they could offer their clients. And of course, the result is that you have, those banks still open for business, looking to engage with clients, but not really able to help clients to say, I can raise you this amount at this price. And I think after about a couple of weeks, that process stabilized. And I think, and that's where we are today as well. I think that those leading banks in the market do have a very good idea of the sort of liquidity and capacity for lending in the market, which borrowers they think they can arrange loans for, and what those market clearing prices are. And that is, I think, that's what's helped enable some of the big loans close in since the impact of the crisis. And you know, all the mechanics of how those loans closed, I think, is really the beauty of the loan product, the beauty of you know, very well established loan documentation that has all the flexibilities built in to you know, to adapt to changing circumstance. And I think now we're seeing a number of new transactions, both in the market or still in preparation and arranging phases, where I think there's a bit of new confidence and new ability to advise clients and on terms and conditions for loans going forward. Thank you.
Thank you. Michael, would you like to add anything on this one?
Sorry, yeah, thanks, Matthew. I think I would like to, you know, maybe shift the view on that question a little bit away from the existing, if you want to call it like that, very big deals on the continent with, you know, either extreme large commodity-based corporates, or, you know, or yeah, or states on the issuing side, to, let's call it like that, the bread and butter business. And that's, to me, a bit more, you know, where it's supposed to filter through on the medium side corporate deals, and also what is the impact on, you know, the smaller deals. And that's what we, you know, on indirect base, looking at through our fundings to the financial sector on the continent. And I'm gonna have to say, you see quite a big impact in that field. I think how deals are still get done in those areas at the moment are you know, based basically on 4 points. On relationship, existing relationships. You will see very few players touching new unknown players or new market entries, etc. Then certainly the market position of the borrower. A lot of sectors are impacted and will be impacted, you know, going forward. And the number 2, 3, 4, or 10 in a market is going to have a much tougher time to get funding. And then I think the 2 points Konstantin already said, you know, the relation pricing relative to, you know, risk and ratings, you know, available. Most all banks work on rating systems, and certainly, you know, a lot of institutions, and we know that from our partners, had to go through, you know, large exercises of at least looking at re-rating entire portfolios, and that not necessarily increases availability for this category of funders. So I think that market is quite affected, and we saw that as well. I mean, look at places like Mauritius as a tourist destination. There's not, you know, there's certainly appetite lending to that industry across the continent has, well, at least I wouldn't say disappeared, but has reduced constantly on some of the manufacturing sites as well. So yeah, it's not all rosy. I think big deals one thing, but overall there is certainly an impact, and we're probably only going to see more filtering through in the months to come.
Okay, thank you. Michael, staying with you, when we were, when you kind of went through into this initial stage, was there anything that has surprised you in terms of the reaction by the markets or the lenders within this crisis? Are there kind of lessons to learn from how the market or the lenders have reacted?
I think firstly, what was quite impressive in a number, well, actually not only in a number, but almost across the continent, was the fast reactivity of governments, and not only in regard to lockdown, but also looking in putting things into place, and regulators respectively. I think they've been quite proactive, and that way certainly act better than some of the markets more in the West, who had more the feeling of denying any kind of problems for long. So I think that was very well done. On the lender side, well, what we have seen, at least in the syndication we have led and the ones we're leading at the moment, is that limits overall have become tighter for a number of players, and in the classical critical markets, limits are indeed very tight, and you're going to have to scrape around in our long-term lending business to find partners who want to go along with you, and alternative sources of lenders in the loan market. Very few and far. I think lenders we had seen in very bullish times, they indeed, at least in our spectrum on the longer term lending side, have disappeared.
Thank you, Michael. I think sorry, my Wi-Fi dropped for a second. Jo, have you got anything to add on that?
Yeah, I think what Michael just said also triggered something that I'm reflecting on. So just in terms of lenders' reactions, was I surprised or not? So I guess there were a couple surprises along the way. So it's a yes and a no. So, and I'll tell you what the yes is. I guess quite simply, it's been difficult to forecast what was yet to come. So there was an element of learning as we go. But two big surprises that kind of stand out for me is on the long-term lending side, to see some of the project finance transactions with very long tenors go ahead, was something that I think is, quite notable, and certainly something that I know it was a challenge. I know there's many banks that have these transactions, and Mozambique LNG, which hasn't closed yet, but is a 16-year transaction, is still going ahead. So for me, I think in an amidst this crisis, to see some of those long tenor transactions still go ahead, and I definitely don't think that we must use that as the template that it's always achievable. But there are certain instances where I've been quite impressed. So like I say, Nigeria LNG, Mozambique LNG are transactions that I note. I think the other thing that did surprise me also was around the secondary market trading. So although there was a lot of uncertainty and a lot of credit risk and credit migration, didn't necessarily translate into sort of massive fire sale behavior. So that was something that I was watching, and what maybe the way that the secondary markets played out wasn't quite how I had anticipated it. And then the reason I say this, my answer to the question, were you surprised by lenders' reactions, is also a no, is because when we look at the African credit market, I do think that the backbone of the African syndicated loan market has always been the relationship banks. I think in good times we've seen more investors enter, but we do know them to be, not in a dismissive way, but that we do know them to be more, yield based, or slightly more opportunistic with how they come into this market. And I think we also can all appreciate that as soon as funders come under pressure, we all kind of retract into the first place we retract away from is our non-core markets. So yes, we've seen that behavior. Is it surprising? Not necessarily. And then, yeah, as I say, the features of the facilities that we've seen, how the loan market has responded in terms of structures that it can support. Well, although this crisis is unlike anything we've seen, I do think that the way the loan market has responded from a structuring perspective is similar to how we had seen the loan market respond in previous crises, the global financial crisis. These features were tried and tested then as well.
Okay, thank you. Constantine, have you got anything to add?
Yeah, I mean, what can I say? I've been in the syndicated loan market for over 20 years, so I've seen a number of shocks in my life that have affected the market. What absolutely surprised me in this one is the speed at which capital retracted out of the African continent, the bond market shut down, and the loan market, close to shut down. It was very, very quick. And then there were some very positive surprises. I would say one is the reaction of the MDBs. I mean, we had 50 billion announced from the IMF, 12 billion from the World Bank, 6 billion from African Development Bank and my own institution, Afreximbank. We also had stimulus packages announced in the 3 largest economies on the continent, Egypt, South Africa, and Nigeria. So some of these things were definitely helping to smooth the impact, albeit that the loan markets and the bond markets were very quickly and severely impacted. What also surprised me very much was the reaction of my own institution. I've only been with Afreximbank 4 years, and they said, this is the exact reason why we as a multilateral development bank focused on trade were created back in the 90s. There was a big trade finance crisis in South America that had caused a retraction of capital from Africa, a complete breakdown of trade lines, retraction of correspondent banks. And it was very quick. I was surprised to see how quickly my institution, stepped up its gear and moved and defined its mandate as trying to fill the gap of capital that was retracting from the continent. We very quickly defined and got EXCO approval for a pandemic trade mitigation impact facility sized at $3 billion that we are now rolling out to clients, sovereigns. So the clients are sovereigns, state-owned enterprises, financial institutions, and corporates on the continent. That is our response to the pandemic and to the financial crisis. And well, I think the good news is that the loan product has so much knowledge in it, right? There are so many people in this market, be it law firms, borrowers, contractors, bankers, that have been doing this for such a long time that the way we then all adapt and sort of change position is some of us have done this before. And the loan documents provided, the templates provided by the Loan Market Association are not over 100 pages for nothing. They have every button in there that you need to react to these different circumstances. And that is, I think that is a credit, to the loan market institution that captures all of that knowledge, and to those in the market who are then know how to re-engage in a changed environment to access loans and liquidity and work with your relationship banks or core relationship or key borrowers, put it that way. Thank you.
Yeah, thank you very much. I also, from my perspective, I've been on the continent for kind of over a decade now, and I think the maturity of response by African MDBs and African financial institutions has been very good to this crisis. South African banks are famously supportive of corporates anyway. They kind of repackage and push out a lot, but the MDBs through and Afrexim not least, have been quite a mature response to that. We have a quick question to talk about the consolidation for tier 2 and 3 banks. So we've only got a few minutes left. I thought I'd just tackle that one if that's okay with the panel. I think we will likely see banking consolidation over the next year or two. To be honest, it's been my general opinion that in sub-Saharan African markets, the road of maturity would lend to more consolidation. I think this will accelerate that through capital strain and liquidity strain. So I do think that is the case. And I think we had another question as well. Glad to see the swift reaction. If not a pandemic, would the regional financial, would these institutions react the same way? I think we've covered that point. I think we've only got a few minutes left. So why don't we just, is there any kind of final remarks you want to make on where we are today and kind of the lessons that perhaps you've learned through this? Why don't we start with Joe, if that's okay? Joe, are you on mute?
So sorry about that. Yes, a few final remarks from my side. I think, you know, the lending community has had an opportunity to regroup and work through some of the initial liquidity pressures. The reality is that the credit pressures are still going to come through the system. So although that knee-jerk reaction where we saw almost, you know, $230 billion of standby facilities being drawn in the early weeks, which in and of itself kind of precipitates a lot of liquidity pressures and a potential crisis, I think that has dissipated. But we do need to be realistic around the type of credit pressures that are going to come through the system and what that means for FIs in general, their portfolios and their books. I think, you know, the reality is that for the market to remain sensible, it means that both banks and borrowers need to remain sensible, because that's what a market really is. It's the aggregate of all of the participants' behavior. So I do think that we are in a more stable environment than we were you know, a month or so ago, a bit more of a muted environment. And I guess it's going to require a slightly more stable hand from all players, because there's still ground to tread here. I think just the last point is that additional stability will hopefully come from the sheer knowledge that liquidity is available. Yes, pricing has rebased. And yes, for certain credits that can't support gearing, access to funds will become a real challenge. But it's important to know from a borrower perspective, if I can leave a message, which is that the entities of standing are going to be able to access liquidity. And in fact, for many of these entities of standing, it might be an opportunity where banks see themselves as using this crisis to further entrench themselves. So yeah, I guess that's my short outlook on where to from here.
Thanks, Joe. Michael, couple of words, few words.
You know, I think there are two things, Matthew. I would agree with what you said in regard to tier 3 banks. I think we will see, and in some markets we probably have to see some consolidation, and the COVID crisis is probably accelerating that in the one or the other market. We, from our perspective, and I think that is a role also of the DFIs, are not simply there for emergency liquidity, but we continue, obviously, what we are supposed to do, and also try to keep long-term refinancing available in these times. We don't want to create, you know, a flight to short-term money, and thus adding maybe additional stress to institution balance sheets in times to come, specifically then paired with certainly and worsening asset quality across the books, and we're probably gonna see that across all jurisdictions, and I think that space needs to be monitored, and it will probably filter through also a little bit later. It's unfortunately in the financial sector that there is a lag on effect, and a better assessment is probably towards Q3, Q4 in a more overall view possible than it is today.
Okay, thank you. We've got 1 minute, Constantine, before we
just a few words, Constantine, if you can.
Perfect. So very quickly, look, I'm not going to repeat what my fellow panelists have said, because that was on my list as well. What I can say, though, is, and it's difficult, none of us have a crystal ball, but I think Africa has definitely shown a certain degree of resilience. But that resilience has also, of course, caused some of the issues it has at the moment, because it's a lot more integrated into the global economy than it was 5 years ago, 10 years ago. And I think that gives me confidence that when the global economy and the main trading partners, Asia, US, Europe, recover, that Africa will recover quite quickly as well, because it is more closely integrated. And I think, the maturity of response we've seen from the lending market will also further develop as the economic improvements come. And I'm sure that the loan market, or the leaders of the loan market, will be there to support all borrowers on this continent in a improved global market with improved terms, improved conditions, and improved liquidity. Thank you.
Thank you very much, everyone. We have now run out of time. So thanks again for your excellent discussion. For those of you who are watching and would like to discuss or to follow up with any of the speakers, you can contact them directly by going into on the People tab on the main platform and searching for them. So I'm sure they will be pleased to respond or to answer any of your questions and connect via video conferencing. So I am now going to introduce you to the next panel. So the panel will be moderated by Abraham Bianima, Treasurer at TDB. Abraham, how are you? Hi, Abraham. You're muted. Okay, you are muted.
Hi, Cedric.
Hi, Abraham.
Yeah.
So you will be moderating the next panel, which will include Deepak Dave, Chief Risk Officer at ATI. Hi, Deepak.
Hello. Hello.
Hi, Benji Faintola, Senior Director, Treasurer at AFC. Hi, Benji. Vivian Ramathulba, Senior Professional Project Finance at NDB. Hi, Vivian.
Hi, good afternoon.
Hi, good afternoon. And Ayman Sejini, who's the CEO of ICD. Is Ayman online?
I don't see him at the moment. Maybe he's about to join.
Yeah, I can't see him either. Okay. Do you want to start?
Yes, sure.
Oh, he is about to connect. Okay. Okay, let's start the panel now. So Abraham, I'll let you moderate the next this panel. So the floor is yours. Thank you very much. I think Iman will join very quickly.
Thank you, Cedric. Most welcome, gentlemen and lady. Probably I'll start off by introducing my fellow panelists. Banji is the Senior Director at AFC in charge of Treasury and also Head of FIs. Well done, multilateral development bank covering Africa. And Deepak is the Chief Risk Officer at African Trade Insurance Agency. Welcome, Deepak. And Vivian most welcome from the New Development Bank, and she's a professional in the project finance space. So I could easily say that this is creme de la creme for the DFI space in Africa. And the question that is ahead of us is the role of the DFIs. Has strategy changed, or is it business as usual? And below that, there are segments of questions which we'll have to tackle. So again, most welcome. So let me start probably by going for the first part of the question, which alludes to the response of DFIs to the G20 debt relief initiative. And Deepak, you've been in the thick of this. ATI has done a lot in the credit insurance. Give us your take.
Certainly. Thank you, Abraham, and thank you to all my fellow panelists for joining me today. It's been an interesting time for us the last 3 months. I think the first month or so, I would say, was a bit of a phony war, because as capital initially rescinded from the African markets, we started to see more and more questions about whether or not our policies would get called on, what the rules would be around claims, what the situation might be if transactions started defaulting in a wave. I think I must have done about 4 to 6 calls every couple of days in early April with everybody from reinsurers, ratings agencies, policyholders. But as time has gone by, 2 things have very rapidly come to the fore in that space, which is that for one thing, multilateral and bilateral support, particularly multilateral support through the IMF, the World Bank, the African Development Bank, Afri-Exim, has come forward to provide liquidity cover, particularly where trade and tourism fees and receipts and diaspora remittances were going to affect Forex availability more than anything. And that has bought time, if you will, for what are now much more methodical analyses to take place and for governments to reprioritize what they're looking to do in terms of the COVID pandemic and its effects on their ability to service their debts, and for their commercial sectors to be able to service their debts. So we're now seeing less questions about claims and more questions about what reprofilings or restructurings might look like. And we're seeing a very cooperative attitude. Certainly governments have stepped forward in the region with much more reasonable plans, with announcements about what they will and will not be looking to restructure or refinance, and with much clearer messaging, which has been very helpful, of course, to us, all of us, I'm sure, in the DFI space. In terms of the private sector, where you come to the debt markets, unquestionably, there's still some strain. There is still concern about whether or not there will be some sort of sneak move later on to try and use the gateway of bilateral or multilateral credit restructuring and to somehow turn that into a soft private sector restructuring without quite making it that way. And I think in those terms, the letter from the Institute of International Finance to the IMF, one particularly that most African ministries that we talk to have taken note of and said that they're in a sense on board with, is the concept of net, the sort of net present values being zero in case of any restructures or reprofiles. And even then, so far, we haven't seen any major asks of the private sector, private commercial debt markets.
Deepak,
yeah.
Just to pause a little bit, if we broaden this response of DFIs and African sovereigns, I would like to ask Banji. Banji, yours is a Pan-African multilateral bank, but I know it has significant focus on West Africa in terms of portfolio. What has been response to the big economies, Nigeria, Ivory Coast, Ghana? What is your take on that?
All right, thank you, Abraham, and thank you to the organizers for having me here. I think Deepak has, set the tone with respect to what is happening across the continent. And if I specifically look at West Africa, Nigeria being an example, and maybe Cote d'Ivoire, Ghana, as other countries around in the sub-region, there's been a lot of response. Nigeria, for example, was hit not just by COVID, but also had the twin issue of oil price collapse at a certain point in time. For most economies, even Ghana to some extent, there's some dependence on oil which was also suffering in addition to the COVID pandemic. So as you would expect, I mean, that had a big impact on their budgets, big impact on the Nigerian budget, on Ghana, Cote d'Ivoire. I don't think there's any exception in terms of any country that was exempted from that. We've seen different responses, as you would know. Several governments to different degrees have tried to put in some kind of stimulus, be it fiscal, be it monetary. And as much as possible, I think what we are seeing is that a lot of governments in the region and maybe Africa in general, as long as they have the option, they would avoid having a default or avoid going into a situation whereby their credibility and future access to capital markets shall be called to question.
Absolutely. That's an important point, Banji, the signaling effect of this debt reprofiling for some economies that still have headspace to borrow and invest in the economies. It's going to be a very dicey question. Do we take this debt relief lightly and embrace it, or do we moderate our debt relief efforts? Back to Vivian. Vivian, are you there? I think we've lost Vivian. Ayman, you're most welcome.
Oh, thank you very much. How you doing?
Yeah, we just started and we haven't covered much. We are still talking about the G20 initiative. And
Excellent.
Ayman, if people on watching don't know Ayman is the CEO of the ICD, an affiliate, I think, of Islamic Development Bank. You're most welcome.
Thank you very much. Appreciate it.
So
Looking
let me
forward to a good conversation here.
Let me give you the question that we are tackling now. We have seen G20 giving guidance on how debt relief should go, and some African economies have decided to embark on debt relief efforts. Some have hired expertise for liability management. Your institution and region has been committed to the African continent greatly. Your exposure is also significant. What is your role in this effort as an institution?
Well, we are the Islamic Cooperation Development of the private sector, and we have more than 42 financial institutions in Africa that provides SME financing there. So that's one way for us to provide support. The second way for us to provide the support is through issuance of sukuk for projects. So we provide the developmental SDG related sukuk issuance. They were fairly small in the west side of Africa, but now we are going into the larger size, which is in the $500 million to $1 billion issuance.
That's very good.
Yes. The third way that we are also helping in all of those directions is that we have some direct equity investments in some factories. We did go into some investments that supported some manufacturing that basically is a value chain concept from having a farm down to the factory, down to packaging and then putting it on the shelf as a product.
Definitely anything that helps the SME sector will help in this pandemic environment, because we know our economies are really dependent on SMEs. Vivian, yes. Welcome back. Vivian, you belong to the BRICS Bank as we used to know it. And in the BRICS, there is China. China is a big lender to the African continent. China is expected to play a part in this debt relief. So is your bank, maybe. You are still new, but we want to get your insight. With your shareholders being China, what would be your contribution to this?
I think most of the MDBs, multilateral development banks, have already offered relief to the countries. If I take the New Development Bank, we have committed up to $10 billion US to all our member countries, of which 1 billion goes to health initiatives and social initiatives. And the second part is where we start looking at the economic stimulus, where we'll come in and try to understand what are those industries that are required in the short term that can kickstart and offer some form of capital stimulus for the market. So if you look not just the New Development Bank, if you look at the World Bank, the AFDB, just in South Africa, when the National Treasury put out the request to engage with all the MDBs, they've all participated and show that they are willing to come in and assist during the capital during this time. And if you look at the MDB's role, it's not only just providing capital. By MDB comes in and providing the 1 billion which we have just approved for South Africa. It now opens the market for all other capital markets. So we are now crowding in private sector because now everybody understands that there's a funder, international funder who's coming in, and there's some form of inherent credit risk that has been mitigated by MDB playing in the space. So not only are we just providing funding, I think we are also cushioning the private sector and attracting private sector funds to come in and participate in this economy.
I guess this question also goes to Banji. I don't know, in terms of your balance sheet, do you have any exposure to African sovereigns? And if you do, have you had any requests for reprofiling of debt? And how are you going to respond if you do?
That's a very good question. I mean, we have exposures to sovereign to the extent that we also do buy Eurobonds issued by African sovereigns from time to time. On the loan market, we're also investors in some of the syndicated loan facilities that you probably are aware of, you know, Kenya, Tanzania, some of the big ones that were done last year. So to that extent, yes, we have exposures to sovereigns. For us, we haven't been active in bilateral lending to sovereigns, so that really wasn't our business strategy. It's always been part of a syndication of the bond. If we do receive the requests, I mean, we always say we will look at it on a case-by-case basis. We've had some engagements with some sovereigns, and the advice had always been, you know, whatever you do, just make sure you remember that, you know, you will be tapping the capital markets in future. So don't jeopardize your access to the market. Make sure you make decisions that are sound. And I think that's the path in terms of advice that we're giving to sovereigns.
And Deepak, are the insurance markets holding up well in terms of African appetite?
I think people are reading their documents a lot more carefully, and certainly they're pushing a little bit more harder on the pricing than they would have even 6 months ago, particularly as Banji pointed out with oil-dependent economies. And oil dependence in our part of the world goes both ways. Either your exports are dependent on it, or your import bill is going to be affected by it. One thing I would also point out is that we have been very pleasantly surprised to find that there is still a very strong market when it comes to the two things that we would have expected and hoped would bounce back the fastest: agribusiness exports and resource exports, certainly metals and all. And we are finding that transactions for those, there has been no drop in structural demand. There's been no drop in the demand quantum. What had happened is it seems it went on pause, and now it's coming back quite strongly. So where transactions are backed by that sort of thing, or with off-takers who have been in the market for several years, and let's not forget a lot of Middle Eastern and Asian conglomerates have been buying from Africa for well over 40 years. Those transactions are back in the market. They're well understood, well documented. We're also seeing governments focus their infrastructure projects, and therefore the reinsurance market is seeing more transactions that involve social infrastructure. I think 2 or 3 or 4 years ago, a lot of the infrastructure was grandiose: airports, sports, railways, roads, that kind of thing. Where this time around, we're actually seeing more applications for social housing projects. We're seeing more applications for hospitals and healthcare facilities. And those are not difficult transactions to explain to the market, that there'll always be a demand and that they will always be well funded. And there's a strong element of concessional financing in the deal, whether through guarantees or actual funding. So I wouldn't say the insurance market is where it was a few months ago, but it certainly hasn't, if you will, put in quotes, run away from the market. It's there. There's still a transaction to be done at the right price. It can be placed into the market. We just expect that there's going to be a greater degree of scrutiny. Financial models will be tested a bit more harshly, not harshly, a bit more rigorously. And that's just par for the course. We're also surprised to find a lot of banks and institutions being very clear that we've been in this region a long time. We're used to seeing these things. They come and go. Sometimes they hit 2 countries, 3 countries at a time. This time they're hitting 15 or 20. Well, that's how things are. So we've been pleasantly surprised, I would say.
Very good. I think with an eye on the timing, let's switch gears to the issue of ESG issuances. In particular, we focus on the trailblazing of the African Development Bank social bond. And my question to Banji, is this the opening of business and issuance of African ESG paper, or is it just a fad?
Well, thank you, Abraham. I honestly don't think it's a fad. And yes, when the AFDB did their issuance in March, they placed $3 billion. And I think that's probably the largest social bond in the capital market right now. Around that same time, the IFC also did a transaction. And interestingly, the whole idea of sustainability, ESG, is been building up momentum, particularly in Africa, for a long time. So when I look at AFC, I mean, I always spend a lot of time with my team saying to my team that the future is ESG. I mean, we just have to, because at some point in time, it will be demanded by a rating agency, demanded by investors, demanded by your board. It's almost a fiduciary duty that we have towards the United Nations SDGs, particularly 3 angles: the poverty alleviation angle, the income inequality, as well as the climate change. So I think it's come to stay. For every multilateral, I think if you're thinking about your funding plan, sustainability has to be a cornerstone of that plan. I'm happy that AFDB did that transaction. And the reality is there's a lot of demand for social bonds, ESG-linked bonds. Is the supply angle that has been lacking. And I think the challenge that we are taking as an institution, and I hope other multilaterals on the continent also take that challenge, is to provide that supply to the market and crowd in a lot of funding that is available for sustainable development of the continent.
I like that last point. I think it takes 2 to tango. The African DFIs also need to position bankable ESG pipeline to attract this kind of money, because ESG investors are very sensitive on the project pipeline. It needs to be high quality ESG. Speaking on behalf of TDB, we have actually started building that capacity. We are already engaged on a bilateral loan basis, but if you look at the documentation, it's really ESG loan. We are looking at climate facilities. We are looking at social facilities. So this is, for us, a stepping stone into the bond market. Vivian, South Africa has been, which is one of your key markets, has been an area or a geography where ESG investors have really put money on the table in terms of wind power and other infrastructure spend. So what is your perspective on ESG tapping? After all, your investment grade, you should be well positioned to raise this kind of money.
Definitely. And if you look in South Africa, for the past few years, commercial banks have managed to register green bonds, and I think it's in line with what's happening with the market. recently, the NDB as well just raised about 1.5 billion. Was our first bond outside China, and it was listed in Dublin, and it's part of the social bond because the proceeds will go towards COVID emergency relief. So I think we are also looking at along those lines, and we just spoke now to our CFO, just also highlighted the need to raise green bond in South Africa in the coming next few months or so, although we are already registering our 10 billion, but I think it's quite aligned with what's happening in the market to align to the sustainable infrastructure. So I think what you just highlighted is exactly what we are also thinking about within the NDB. And of course, the challenges will be to match with the projects. And I think that's where the MDB comes in and offer that assistance of project preparation to ensure that as those projects are readily available for the bondholders or those holding the ensuring that those impact and development can be accounted by the investors.
Thank you, Vivian. Mr. Ayman, I just want to give a little bit of history on ESG matters. Actually, ESG started a long time ago when people started demanding social accountability for public companies. We remember during apartheid, people were demanding social justice. That is the S in the ESG. And Islamic investors were always shunning seen stocks. They would never invest in casinos and stuff like that. So it has evolved into what we have now. So what would a platform, an Islamic institution, Islamic finance institution, help us in terms of tapping the ESG market? I guess, Ayman, we'll pause there. When you come back, we'll pose that question. Deepak, from TDB's perspective, we've been engaged with ESG players. One, multilateral banks to help us tap into the ESG market. One of the mechanisms has been either one large, well-rated multilateral to anchor our bond as an investor, or to give us a kind of wrap. So again, to the credit insurance, what would the credit insurance offer in terms of African issuers to unlock this investment segment?
We have also been seeing an uptick in the demand from our reinsurers and from foreign multilateral or bilateral DFI partners who are asking about us improving the credit enhancement product that we offer. For a standard type of bond and all, of course, we understand what we are doing. We understand that we would be covering things like payment defaults, perhaps political risks attached to a transaction and all of that. The question then being, if there is a bond that came to the market now with a, as Banji would put it, bankable proposition and a measurable ESG that could be rated, monitored, evaluated, and on an ongoing basis, just as with a typical bond, you monitor the covenants and the warranties and the representations. If we were able to actually find a transaction like that, that we could credit enhance, we have a little bit of work to do unquestionably in understanding where do our typical claims processes start, where do we come in, what kind of influence would we have on the transaction. As a non-funding partner, we would of course have somewhat less capability, less, I would say, control over the transaction, and therefore we'd be more dependent on our DFI partners to do it. Were such a transaction to come through, I think the reinsurance market is definitely ripe for testing to see where we could go with that. And that might not even have been true 18 months ago, because we would have seen ourselves as being passive backers of transactions, not actively involved. But now I think it's time for us to innovate as well and go forward. And for example, we work with institutions such as yours quite closely. We work with institutions like AFC. I confess we haven't seen the new development bank much. But perhaps Mr. Ayman, who I think has just rejoined, could also elucidate a little bit more about a typical funder?
I had a particular angle, just briefly, because we are running
Of
out
course.
of. Mr. Ayman, we know Islamic finance is very socially responsible. You really focus on the S in the ESG. You don't want to invest in socially irresponsible ventures. So what is your role in, as far as Africa is concerned, your participation in the ESG investments?
Well, our socially responsible investments, as I said earlier, we are actually focused more on providing real-time financing through our financial institutions. That's our foremost target. And usually we look for transactions that have a value chain in them. What we mean with that is taking it throughout, let's say, farming. We'll go from the seed to the watering, irrigation, to actually harvesting, and then packaging, and then the shelf. And that's the overall strategy that the group has. And that's where we see ourselves. We are actually very much keen in issuing green sukuks, which again, we feel like it's social and that's and we're ensuring that it will enhance the environment and the people that's around.
Thank you. We shall switch gears a little bit. Vivian, we want you to help us discuss or take the lead on the question of how do we package infrastructure deals in Africa to access a large pool of investors and liquidity. We know Africa has the issue of perceived risk. Some of it may not be real, but how do we tap into long-term liquidity, capital markets, and other institutional investors?
I think from the Africa perspective, there is a low pipeline of infrastructure projects. And I think it starts at the beginning of planning within the government and the regulators. From the policy perspective, usually it takes time. And by the time the sponsors involved, the developers, there's quite a number of times. So I think if we shorten that time where the policymakers make a decision in terms of planning to do an infrastructure project, it can really assist, especially in the Africa. And I think involving your specialist upfront, either be on the technical side or on the finance side, if you are going to tap finance in the market, be ensured that your project is bankable, and bankable not only on the technical side, it's also bankable on the financial side, ensuring that it can be repay the loans, it's sufficient. So involving a number of specialists upfront, either technical, either financial, as well as environmental. And I think there's quite a number of deep pockets of project preparation facilities that have been put forward by the multilateral development or the DFI. And if you engage them upfront, they are also can assist any sponsors who's developing a project, ensuring that all the various steps are covered upfront. Because yes, you can have a project that you are developing, but if it doesn't have, if it's not bankable for the private sector, no one will put money.
So Vivian,
and no one can.
To that point, I would like to throw this back to Ayman, the role of ECA. And initially our topic was, has the DFI strategy changed, or it's business as usual? Have the ECA modeling of pricing and risk-taking changed given all that's taking place, the pandemic, and even prior to that? What has changed in terms of ECA and accessing liquidity for capital investments?
If you could elaborate please further on your question, because I'm not getting it exactly, if you don't mind.
We are looking at ECA as another channel of obtaining capital investments in Africa.
Yes.
Have you seen any trends in the pricing of ECA funding to the African continent? And what are those trends?
Got you. All right. Well, basically, the way how I'm seeing the interest is there. There's understanding of what is required. What is important I have seen is proper packaging for understanding of the market. And as you see, we have mentioned the perceived risk, but we have seen that the interest when you specifically go for green projects, or if you go for green issuance of paper, or if you go for ethical investments, there is a huge amount of funds that are willing to come in and actually give lower cost or accept lower profit for themselves in order for that funding to be given. So, and that's a trend that I've been seeing. With COVID-19, I think the projection of everybody is more or less the same, that it's not right now quantifiable or really understood what are the consequences completely going to look like. It's going to be still, some time till understanding of no. But nevertheless, I think the need is no funding is there and interest is there. It requires it to be presented correctly.
Ayman, your line is breaking. Probably there is a question that's just come in, and this goes directly to Banji. What were some of the challenges involved in issuing a social bond? Of course, none of us has issued a social bond, but we have been understanding the moves by FDB. Could you comment on that, Banji? What would you anticipate as the challenges?
So I think, like I said, and maybe people who are listening are also aware, about 2 weeks ago, AFC issued another bond. It was $700 million 5-year.
We have 5 minutes, Banji. Yep. So take 2 minutes at least only.
Yeah. So when we were preparing for that bond, I mean, we looked at it. Should we do a social bond? Should we do all that stuff? And obviously, one of the considerations for us to do a regular bond was timing, because again, markets have been volatile, so we wanted to get to market on time. Apparently, you probably need to update your program to accommodate some of the framework that is required. So those are some of the challenges that issuers have. The use of proceeds, people really want to be sure they are using the proceeds for the right thing. And then there's also the reporting, the monitoring, etc. So I think those additional things are some of the challenges that people face when they're looking at social bonds.
Okay, just to, we are almost running out of time. And one last question was that what kind of infrastructure projects are able to most easily access liquidity? I could speak on from our perspective in our region, Eastern Southern Africa. The projects that we see easily sellable and easily bankable are those projects that have strong private sector participation and strong developmental impact, because most of the use of proceeds clauses we have in our funding arrangements are really aligned to those two things. Yes, governments are a priority, but we see a lot of appetite for private sector infrastructure build and spend, and we've raised a lot of money in that space. And there's more to come from that kind of universe, which is targeted at private sector. I think we are left with 3 minutes. Each one could give a final comment. I start with Deepak, just a half a minute, please.
Thank you, Abraham. It's been an honor to be here with everybody today. And I think the theme from all of the things we've all said here seems to be, since all our institutions work together closely, is that good projects there's still appetite for good projects out there. Getting them together is going to take slightly longer and a bit more effort than perhaps it would have taken a couple of years ago. But there's no question that we're in a good position.
Parting, Ayman?
Yes, basically, I would like to say that capital market and debt capital market is the future that can close the gap of what is needed. And I think the more we go for the direction of presenting projects that are bankable, the success is, in my opinion, still definitely there despite all the challenges and COVID-19. And stay
Thank
safe.
you. Vivian, your last remarks.
On our side, infrastructure finance can be a catalyst for economic growth, as well as assisting during this COVID pandemic for bringing back the economy. So I think as NDB, we're committed to do that.
Thank you, panelists. Banji, anything to say?
Well, just to say, Africa has always had this huge infrastructure deficit. COVID has made it potentially even worse. And for all of us as DFIs, it can't be business as usual. We need to think of innovative ways to help the continent solve a lot of the challenges that we face. It's been a pleasure being on the panel. So thank you so much.
All.
Thank you, Abraham.
Thank you so much for your contribution.
Thank you very much.
Thank you very much, everyone. It's been a very interesting panel. We have unfortunately run out of time. So thanks for the excellent discussion. For those of you watching who would like to follow up with any of the speakers, please contact them directly by going on the People tab on the main platform and searching for them. I am sure they'd be pleased to follow up, answer any questions that you might have, and organize video conferences with you. So I would now like to invite our next panel to join the screen. The two speakers are Christopher Edgerton Warburton, also known as Edge, who is the co-CEO of Lionshead Global Partners, and Cyrus Ardalan, who is the chairman of International Finance Facility for Immunization, part of the Gavin, the Vaccine Alliance. Edge, Cyrus, hello.
Yes, good afternoon.
Good afternoon, how are you?
Very well indeed, and yourself?
Yes, I'm very good, thank you. Edge, are you online?
Yes, I'm here. I'm just trying to get my video to work.
Okay, well, we can, I mean, you can start talking anyway.
Let's start and
yes. Yeah. And then here we go. So the floor is now yours. Thank you very much. I'll see you in about half an hour or so.
Fantastic. Thank you, Cedric.
Bye.
Great. Shall I kick off, Edge?
Yes, please.
Yeah, I want just to, first, delighted to be here, say a few words about IFIM, the International Finance Facility for Immunization. It is a very unique institution that was created in 2006. And in many ways, it's precisely the type of institution you need to deal with the crisis that we're currently facing with COVID. Its structure is actually relatively simple. It involves, in the case of IFIM, a number of governments committing funds, pledging funds on a legally binding basis to IFIM over many years. Some of the pledges went out for 23 years. And this enables IFIM to front load these commitments, issue bonds in the capital markets in the form of what we call vaccine bonds, and utilize the funds to address a key social issue, such as vaccinating children in developing countries. So in effect, you're able to mobilize large amounts of money, but have the costs of this spread over time, but have the flexibility to use the funds upfront. The IFIM structure enables you to either front load the whole amount or parts of it, so it gives you flexibility in when you draw down on this. And also by the fact that it is a facility that has long-term pledges to it, it's a facility that's in place and can be utilized over many years, and you don't have to refresh it every other year, etc. 10 countries provided $6.5 billion to IFIM, And that has enabled IFM to dramatically accelerate the amount of vaccinations done by Gavi in the poorest countries. It is also, I think what is interesting about IFM is that it's a very efficient structure. It is a structure which has no staffing. We utilize the World Bank as our treasury, and they do all our treasury functions, and all the funds that we raise go to the Global Alliance for Vaccination, which in turn utilizes the money to vaccinate children in the poorest countries. And this type of facility is obviously ideally suited to deal with COVID as it stands. And I think we'll come to discussing precisely how we are engaging in that right now in a second.
Thank you, Cyrus. So let me sort of try and spend a couple of minutes bringing us into context of what's going on the vaccine front, specifically with regards to COVID. I just want to emphasize that there are many parties working on this initiative. I have been fortunate enough to be involved in a number of those conversations, but not all of them. And so as it moves with such pace, please bear in mind that I may not have absolutely the most up-to-date information, but I will do my best. So with that disclaimer, let me dive in. So several years ago, we were lucky in a way to have the Ebola crisis sort of exposed to the world just how vulnerable we would be to a pandemic, and that led to action for the first time really around the R&D space, with the formation of a group now based out of Oslo, Norway, called CEPI, whose mandate it was to commence research into all vaccine preventable diseases for which we didn't have a vaccine, but where it was clear that you could make these things vaccine preventable, and where there was a risk of a pandemic. And due to the SARS and MERS outbreaks, the coronavirus was on the list, fortunately. So the good news is that by the time that the COVID crisis hit us, work had commenced, quite a lot of work had commenced on trying to create some vaccines that were very, very similar to what we're trying to work with today. And that work had been funded and was being supported by CEPI. So CEPI equally, though, had been supporting a whole range of different vaccines, and interestingly had been supported by one of its donors, being Norway, had wanted to provide it with a multi-year grant that it had wanted to front load. And so we worked with Cyrus and the team at IFM last year to front load a Norwegian krona pledge and execute an IFM bond, which was executed to provide funding for CEPI. Now, at that point, that was for CEPI's general program. And Cyrus may want to comment, but it was quite a process to link these two initiatives together. But once we had got them linked together, then they're linked. And so that also was a second sort of fortuitous connection, which has meant that now CEPI has the capacity to work with IFM in the current crisis. Cyrus, I don't know whether you want to comment on that or whether you want me to just keep going.
No, I can just say that I think that the strength that IFM has through its structure and through its rating, which was initially AAA and now to AA in line with a downgrading of some of its bigger contributor, is its excellent access to the international capital markets. We've issued over $6.5 billion worth of bonds in 35 different transactions, 8 different currencies. And in the case of CEPI, it was a very specific need. Norwegian government had provided funds over time, but they needed to have the money available immediately. So the structure that IFM provided enabled CEPI to front load essentially an amortizing Norwegian krona cash flow into a bond at very cost-effective terms and make sure the funds were available immediately to be utilized for developing vaccines. So I think it's a very it's an excellent example of that.
Perfect. And so with that sort of backdrop in place, we then come to January this year or late, very, very late December of last year, and the outbreak of the COVID crisis. And really with the release, and I think it was mid-January, of the genetic sequence of the coronavirus, that was like a starting gun in laboratories all around the world. And you know, there are plenty of people who say there's 100 different vaccine candidates on the way. The reality is there's probably something in the order of 10 or 15 or 10 really that are what I would call front runners to play an active role in this pandemic's in the sort of treatment of this pandemic. The reason that you've got so many coming through is that a lot of people who want to trial new scientific approaches will try and do something in the eye of a pandemic or of a crisis, and that in a sense helps you to tackle the next crisis. And so one of the leading candidates in the current race is based on an adenovirus vector. That adenovirus vector, how we know that it works, we know that it's safe, is that was one of the candidates used for the Ebola vaccine. So it's a perfect example. It didn't end up being the vaccine that was being used most of the time by Merck, but it was the technology, as it were, got field tested, and we proved that it worked in the Ebola crisis. So we're sort of in the same situation. Now I'm going to go out on a little bit of a limb here and say that I am 100% convinced that we will get a vaccine. The reason being that vaccines, we know that we can make antibodies against the coronavirus. We know that people with antibodies do have a protective response. Now, will it be fully protective, or will it be good enough to make sure that people don't end up in intensive care? It's a big ask to say, is it going to be fully protective? And again, if I was a betting person, I would say it's quite possible that it won't be fully protective. But I do believe it's totally possible that we can create a vaccine that would prevent an enormous proportion of the fatal cases of coronavirus, which, if you speak to policymakers, would be sufficient. But there's a few big buts there. One is that we have an unprecedented challenge in terms of volumes that are required. To put it in context, the biggest vaccine manufacturers in the world make somewhere between 1 billion to 1.5 billion doses a year, the biggest. Okay, and there's sort of 5 of those. So if you want to suddenly create between 4 to 8 billion doses of a vaccine, I mean, are we going to be waiting for 4 or 5 years for this to come through? And the reality is we cannot wait that long. So the whole industry has had to consider a fundamental scaling up of its activities. And that's one of the reasons why we've needed to have a lot of different shots on goal, a lot of different horses that are in the running, most of whom will probably get to the finishing line, most of whom will probably play some part in the overall treatment of the pandemic. But probably you'll only end up with 1 or 2 long-term that will be the COVID vaccine. And it may even be that the long-term vaccine is not one of the ones that gets to the finishing line first or second or third. You may have something which is, so for example, if somebody came up with a 1-dose vaccine, that would clearly be better than a 2 or a 3-dose vaccine. But if you had no vaccine, the 2 or the 3-dose vaccine would be absolutely fine. And so it may be that a 1-dose comes along further down the line. But what we're having to do then is to finance a large scale up of manufacturing, and then have that vaccine large amounts of it actually get made before the vaccines get finalize their clinical trials, because it takes time to make these. And so what you don't really want to, what you would do normally in a pharmaceutical process is you would complete all of your clinical trials and then you would start large scale manufacturing. But that would push the whole thing back by at least 6 months. So what we have at the moment is a process in place whereby we're trying to make as much prototype vaccine as possible, on the basis that the minute that the trials get finished for that vaccine, it would be immediately available in hundreds of millions of doses. Again, something that's never been done before. And once those that vaccine has been produced, we need it to be able to, we then need to be able to scale out and have billions of doses of it. And all of this comes to sort of good news and not so good news. The good news is that I genuinely do think that there are going to be vaccines, there will be vaccine product. It will be coming through the pipe actually surprisingly quickly in reasonably, I mean, very significant volumes, so that by the end of this year, I think it will be very clear which way we're going. In fact, by the autumn of this year, it'll be very clear, you know, do we have vaccines? When are they going to be available and how effective are they going to be? But the bad news is that's going to require some very substantial financing requirements. And that brings us back to IFM again. And how can we essentially make sure that, once again, it's not that the availability of cash is not the rate limiting step in terms of making sure that we can get as much vaccine as the world needs as quickly as we can and into the shots, not only of the wealthy countries, but also of the poorest, and most importantly, actually, because they're the ones who often fall through the cracks, the middle income countries that are neither sort of G20 wealthy or fall into the poorest of the poor at the other end. So making sure that the middle gets covered as well is critically important. So Cyrus, why don't I, that's where you come back into the movie.
Yeah, as Edge said, I mean, financing is obviously going to be a key issue here. And it's going to be initially part of the financing is, and that's over the next 12 months, is to develop the vaccine. And as Edge has mentioned, IFM has been working closely with CEPI and will continue to do that and ensure that any incremental funding necessary to develop a vaccine as fast as possible is available. But looking beyond that, I think the key is going to be the financing of the vaccines themselves, which is going to be a huge initiative. And that has, one, a global dimension, is to make sure that there's equitable distribution of vaccines across the globe, and an initiative has been launched to try and provide that. So there's collective global procurement of vaccines. And within that, Gavi itself, which is focused on the poorest countries, has an initiative which is a COVAX, what's called COVAX AMC, which is to try and utilize its resources to procure, to provide guarantees and procurement to key pharmaceutical companies to incent them to produce the vaccines and produce them in the volumes that are being required. And it's in that context that, again, IFM can play a very significant role. As I mentioned to you, we have, in the past, we've had the $6.5 billion worth of long-term commitments made to us. We recently went through a new replenishment process. We were provided an additional close to $1 billion worth of funding over the next 10 or so years, which is available to be utilized for Gavi, for the Gavi. And Gavi will obviously be a key player in the provision, ensuring that there is the provision of these COVID vaccines to the poorest countries. And there's another dimension which I think is quite key, is that the fact that IFM has significant resources that it can mobilize very quickly can enable Gavi not only to meet the future requirements placed by COVID, but also to try and make sure that the existing programs that we have to vaccinate children in the poorest countries, which are now being challenged because of resource limitations, logistical limitations, et cetera, do not fall behind. Because that's where actually you will see the greatest loss of life will be in the case where we lose focus on continuing to provide vaccines to the poorest countries, traditional vaccines for diseases to the children under 5 years old. So it's really in both contexts that IFM can continue to play a role. And therefore we expect to be in the capital markets. We've already announced a transaction which we're doing in the context of CEPI, but we will be, I am sure, quite active in the capital markets over the next couple of years as we take advantage of the funds that have been committed to us in helping accelerate the work of Gavi.
So I see that we've got some questions. The first question that's come through is approximately how much money would IFM need to raise to ensure the vaccine is distributed? I mean, to put it in context, the initial priority is to get between 1 and 2 billion doses out to people. Now, again, whether that's a 1 dose course or a 2-dose course does make obviously a very big difference. And so when we talk about doses, think about it as 1 to 2 billion of courses. So that's potentially 2 to 4 billion of vaccine. Now, the cost estimates are varying, and they do depend on whether the technologies, which technologies succeed. So the cheapest technology would be at a little over $1 a dose, possibly maybe $1.50 as a floor, but that sort of range. And the most expensive is probably at about $20 a dose. And so you can see that means you can have some very big error bars of what potentially is going to be the cost. But fortunately, the sort of odds are looking as if they will be towards the lower end of that range. And so, but even with that, you would be looking at somewhere in the significant single-digit billions required. And that's just to sort of get the most vulnerable, the healthcare workers, et cetera, vaccinated. The reality is in practice, the entire planet is going to want this vaccine. And so, you can do the maths. That sort of gives you the range of what's required. And then in order to pre-make vaccine that will ultimately be paid for, you have a funding need that's, again, in the range of somewhere between $2 to $5 billion of sort of pre-financing that you would want to get executed to make sure that we have the stockpiles that we need. That's short-term financing, sort of more like a working capital facility that ultimately will get repaid as the buyers of the vaccine can't come forward. So that just gives you a bit of a concept of the scales. And then, Cyrus, there's a question for you about the tenors on vaccine bonds.
Yeah, those have typically been between 3 to 5 years, but there's no, it really depends on our cash flow position and our specific requirements that we have at any point in time. For example, the Norwegian pledge was 10 years, so it was an amortizing 10-year Norwegian krone placement. It really depends in part on our, as I said, on our needs, and also the cash flows that are being, the pledges that are coming into IFM, the legally binding pledges that are coming into us from governments.
And Cyrus, perhaps you can comment, I mean, how does the whole focus on socially responsible investing and this sort of area, is this changing people's interests in IFM? Are they, how does selling vaccine bonds today differ from when IFM first started?
I would say that over the last several years, and I think and particularly I would say today, but certainly even starting a few years ago, there has been a notable change in increased interest and differentiation, I would say, by investors for vaccine bonds. Because if you think about the vaccine bonds, these are the purest of all socially responsible securities that you can buy. The funds that are raised through the vaccine bonds are provided 100% to Gavi, which in turn utilizes these to vaccinate children in the very poorest countries with per capita incomes of less than $1,500. Just to give you a sense, Gavi's vaccinated 760 million children and saved 13 million lives. So it's difficult to conceive of an investment which is more socially responsible and directly linked, unambiguously, to a social cause. So yes, there has been a notable shift in that, and that I think with COVID now, that is even more so, and very much more so. So I think that this bodes well for our ability to access the markets, not only in size, but also on extremely attractive terms.
So I see that we're coming to the end of our time. I mean, I just want to thank you very much for allowing us to participate in your conference, to wish the rest of the conference a great success. As we said, the sort of the bringing together of IFFIm, of CEPI, of Gavi is incredibly sort of timely, and would that we did not have to bring all these things together. We'd much prefer that we hadn't got this COVID crisis, but at least we do have these tools. And as Sarah said, I think that we will be coming to a destination, a bond market near you very soon as we respond to this crisis. So from my side, thank you very much for letting us participate.
And the same from me. Thank you very much.
Well, Cyrus, Edge, thank you very much indeed for being part of this panel. Very, very interesting indeed. Unfortunately, we have now run out of time. For those of you who are watching and would like to follow up with any of the speakers, please contact them directly by going on the People's tab on the main platform and searching for them. I'm sure they'll be pleased to to answer any follow-up question you might have. And to meet with you using video conferences. So I would like now to invite our next panel to join on screen. The next panel will be moderated by Thomas Christiansen, who is Managing Director, Head of Emerging Markets Sovereign Debt at Union Bancaire Privée. Thomas, thank you for being here. I will let you introduce the rest of the panel. You are muted now. Okay.
Thank you.
Hi.
Thanks, Cedric.
So the floor is now yours. I will let you introduce the panel. Okay.
Thank you, Cedric.
Thanks, Thomas.
Joined by Trang Nguyen from SMBC Nikko, director in the DCM team there. Samir Gado from Stan Charter, who's Africa economist, and Lucy Villa from Moody's. And thank you for joining me to the rest of the panel, and thanks and welcome to all those out there watching and listening to this panel, which will be on debt relief. We're going to try to keep the remarks, I guess, somewhat more brief than some of the other sessions I've watched. I think all the panelists are keen to make this interactive and get as many viewers' questions into the mix as we possibly can. So please do post your questions on the side as and when they come up, and we'll try our best to get to them. In order to sort of set the scene, debt relief as a title could potentially have broad implications, but we're obviously going to focus on the more recent initiative, which I guess most of the viewers are familiar with. Just to be clear, the most recent DSSI initiative by the IMF, World Bank, and G20 to suspend debt payments from the world's poorest countries, defined as IDA. And I guess interestingly, given some of the things we've seen the last couple of days, also including Angola. The initiative runs until the end of the year and requires countries to apply to be eligible. It was announced back in April, and at the time it included, quite crucially for markets, a call for private creditors to participate, working through the IIF. I think many sort of dedicated EM investors and researchers, I guess, were a bit skeptical of the prospects of how this would sort of work. But the market clearly took note. I think in the broader risk rally we saw in April, high yield sovereign EM debt was clearly left behind, sort of lagging its historical beta by some margin. And it seems that for the time being, the noise around this has sort of died down. In May, we saw the establishment of the African Private Creditor Working Group, which also called for a case-by-case approach, rejecting the notion that there would be some sort of blanket approach used. We've seen a number of frontier countries seek official debt relief. In the initial stages, I guess the countries that did were somewhat punished by markets, but most recently that hasn't been the case. And indeed, we've seen the last few countries who seek relief explicitly stating that they're not looking for private creditor relief, that this is just looking for bilateral relief. And from the G20 and the multilaterals, I guess, to the extent it's possible. Senegal and Cote d'Ivoire most recently. So from the big picture, I guess that's sort of where we stand today. Bonds have recovered significantly from the lows, but remain wide to sort of developed market counterparts. If you look at sort of US high yield versus EM sovereign high yield. But we have seen a number of high yield countries able to come to market and issue. Paraguay and Guatemala first, some time ago now, but also Honduras and Belarus more recently have accessed markets. We haven't seen a number of the other countries issue markets, specifically also the ones asking for debt relief. And on that point, in terms of market access, of course, I'm happy we have Trang on the call, who's a director, and as I mentioned already in SMBC Nikko's DCM team. So Trang, what have you seen on your side in terms of sort of spread performance, liquidity, demand for new issues, ability to come to market? And do you have any thoughts maybe around the expectations going forward for primary markets? And have you guys considered the potential for any of the countries participating in this DSSI to issue bonds? I think the language around that was a bit vague in terms of sort of any pre-agreed issuance, I think is still technically allowed. Have you guys considered any of that? And sort of what are your thoughts here?
There you go. Hi, thank you very much. Thanks, Thomas, for the introduction. Very quickly from my side, obviously, you guys can all have seen from the spread performance, especially since they're historically tight in February, equities all-time high, and suddenly the crisis hit, and March really experienced one of the worst times in terms of the reaction to the pandemic crisis. And for that, I mean, we would have expected the whole primary markets to be shut. However, I think the central banks quickly stepped in, as you mentioned, globally, very much concerted reaction there, and that has really provided some comfort and confidence into the market. But obviously, it all started with very, very high quality credit first, to be able to trickle down all the way to sub-investment grade and emerging market credit. It has taken a bit of time, until probably April, to actually see the investor demand to be there. What I wanted to say in terms of, I guess, more importantly, where do we go from here? Have we been really out of the woods, as a lot of people might have optimistically hoped? Our views are quite optimistic, I would say, given the fact that we're here in June and a lot of the lockdown has been eased in many countries, even though there was a threat of second wave just emerged again recently over the weekend. But overall, I would say that given the EM debt being still very much one of the asset classes that offers yields, and in terms of relative value versus, say, developed market high yield, they offer broader support from the government versus what investors would fear in terms of the default cycle. We still think that the default rates will probably peak end of this year, so it hasn't peaked yet. So Q2, maybe investors have looked past Q2 and looking forward for more data to come after. But in terms of the high yield, that's what investors concerned about. Whereas with EM credit, I think given the fact that you can still get yields, as well as the support from central banks, the liquidity that's filtering through, the view from investors is that it's one of the few asset classes that they can maybe still get the yields with the risk within the acceptable area. So where do we go from here? I think it's we did a very interesting survey with some of our, well, actually quite a high number of investors. And yeah, I think it's encouragingly, a lot of the investors have expressed that they maybe the worst seems to have been over. Interestingly, Asian investors are more optimistic than US investors, and then followed by European investors. I wonder because of the movement of the virus that has been traveling through the globe, but that's how we feel the sentiment of the investors. And you know, the interest rates are here to stay low for at least a year or 2 years. So for that, I mean, the absolute funding costs for these you know, emerging market borrowers are still very, very low. So I think the markets will continue to function well. We think that, you know, maybe the tight levels, the spreads are gonna trade range by at this tight level, not going to go much tighter than here. But the markets will remain open, especially with technicals that are supporting, you know, the fund flows, the ETFs that are still quite healthy for the primary issuance.
Thanks, Trang. I guess moving from that sort of bigger picture more into the weeds of things, Samir, you know, we discussed this back in April and May. We were in touch. I think shared many of the same views. We've seen this relatively broad-based recovery following a relatively broad-based sell-off. So I guess if we sort of get down a little bit beyond that, I guess to begin with, was the sort of proverbial baby thrown out with the bathwater? Was the sell-off too broad-based? And likewise, on the way up here, any countries that stand out as having maybe recovered more than they should have in this sort of broad-based rally? So I guess sort of a two-part question for you. Any countries that suffered more than they should have in the sell-off, or any countries that maybe have benefited a little bit too much from this broad-based rally as you see it?
Okay. Yeah, I mean, look, in late March, early April, you know, we had an unprecedented sell-off. As you remember, some issuers such as Angola, for example, traded in the high 30s cash price. So basically, there was a flight to safety, and investors were just de-risking their portfolios and selling whatever they could. I mean, I must say at that time, the oil names and countries with weaker fundamentals suffered the most. So can you really say that, you know, it was overdone when oil prices, for example, went to $20-something per barrel at the low? In fact, at some point even lower than that. Maybe not, but I think there was some sort of overreaction because the investors, you know, were facing redemptions and just didn't want to take any risks. Now, actually, by the way, the DSSI or the debt moratorium noise also didn't help, because I remember very well that, you know, in April, even in late April, early May, when things kind of started to turn around, the number of investors were still worried that some African sovereigns, for example, would come up with coupon payment waiver requests. Now, it turned out that the DSSI, Debt Service Relief Initiative, only calls for voluntary participation by private sector creditors, and that most countries that applied for the DSSI actually will not request, for example, Eurobond holders to participate in this initiative. But nevertheless, there was a moment where, you know, the market was quite worried about this prospect. In fact, the noise from a number of African sovereigns didn't help. I mean, if you remember, you know, there were op-eds written almost every day by African finance ministers, presidents, and so on. Now, it is true that, you know, there's been a very, very significant turnaround of the last few weeks. In fact, ironically, it's again the oil names, the high yield names within, you know, the frontier market space, and names with weaker fundamentals that have performed. And I think it's probably because they were much cheaper, and so investors just saw value in those. And it's a fair question, whether they are adequately priced now. I mean, just a very simple example. If you look at, for example, Angola, they take Angola 48 versus Senegal 48. I think the spread now is 487 basis points. It was as wide as 1,770 basis points or something like that in the worst phase of the sell-off. But nevertheless, I mean, you could still argue that it's a wide pickup. Now, on the other hand, when you look at the cash price, Angola 25 is trading at 87 today, and true, all prices are, have recovered quite significantly. But nevertheless, it's not as if the risk of restructuring, say, within a year is zero, which the market is kind of starting to, imply, because clearly here you're below the minimum haircut potentially, even though the government has said that it's not going to ask for private sector contribution to the DSSI debt service relief. I mean, a last point I was going to add is that in March, April, a number of African curves, and I think actually EM frontier market curves, flattened significantly. But in the most distressed names, some of these curves actually inverted, meaning that the market was certainly worried about short-dated bonds, especially because those were due over the next few years. As risk improved, these curves have started to steepen, in fact, both steepen, but nevertheless, they're still flatter than they were, in March, April, which suggests that there's still some degree of concern about the ability, willingness of these countries to service their debt. Now, finally, the key risk is, what happens if the DSSI debt relief scheme is actually extended beyond 2020. Are we going to get to a point where suddenly, voluntary private sector contribution becomes mandatory? I think that's the risk that perhaps is not significant, but cannot be ruled out.
Thanks, Samir. And I guess that does give a little bit of a segue, but before I go to Lucy, maybe just very briefly, in your view, how do you see fundamentally the participation in this scheme? Is it clearly a positive because it gives some liquidity relief and allows them to save some dollars? Is it a negative because of the potential implications for what it means in terms of their ability to service debt? Or is it sort of neither or? And I mean, again, bearing in mind it's only 6 months, but at least for now, the initiative, as you mentioned, we don't know about the future. But how, in your assessment, when you're reviewing the credits, for you, is this a positive, a negative, or neither? Samir, sorry, that was for you.
I thought it was for, okay.
Yeah, no, just briefly before I go to Lucy, if in your assessment of these countries and their credit metrics and their credit, do you see on a complete all else equal participating in the DSSI? Is it positive, negative, or sort of neither?
No, I mean, I think it's obviously country specific. If you look at the amount of DSSI debt service relief, that countries have secured, actually 48% goes to Angola and Pakistan. So, for example, I think it's 3.4 billion for Angola, 2.4 billion for Pakistan. So for those, clearly it's significant. Now, you take a country like Angola, I think external debt service for the year was supposed to be 8.2 billion. So it makes a massive difference in terms of liquidity, solvency, and so on. Now, if you take smaller countries or countries that have secured, smaller DSSI debt service relief, I think it becomes a little bit more questionable. You take a country like Ivory Coast, I think they're going to get around 200 million-ish maximum based on the World Bank database. It's a country that's been actually quite silent on all this debt moratorium noise. Yes, it helps at the margin, but in the big scheme of things, was it really worth it? Given that it's a credit that's very well regarded by the investor community, that has rebuilt a market track record and so on. I mean, obviously, they made it clear that they're not going to ask for private sector contribution to the debt relief scheme. But nevertheless, I'm not sure really whether, you know, the benefits outweigh the potential perception risk with the DSSI. And actually, perhaps a broader point, I mean, some countries so far have not even said that, you know, they will go for the DSSI. For example, Nigeria has not clarified it. But what's interesting is that, you know, when, let's say, in April, you had all this noise about the debt moratorium, possibly including commercial debt, I think what was interesting is that some countries, I think, were clearly taking into account the future risks in terms of market access, because clearly some countries have been, you know, very actively involved in the primary market in recent years. They've issued almost every year and will continue to issue for financing needs, but for finance the debt and so on. So for them, having market access was very, very important. And lastly, for some countries, actually, the restrictions attached to the DSSI are probably a bit of a problem, because obviously, unless you pre-agreed your external borrowing plans with the IMF and so on, it's a bit tricky to issue new Eurobonds if you go for the DSSI debt relief scheme. And I think that probably has been a bit of a negative factor from at least the government's perspective.
Right. Thanks, Samir. And that now does give me a very good segue to Lucy. I mean, Samir notes some clear differentiating factors country to country in this in terms of this debt sustainability relief. And I guess you guys have taken a little bit more of a blanket approach in terms of more or less putting all the countries that apply for this on negative watch. A few questions, I guess, related to this. And I actually participated, or I listened in. I watched the panel in this event earlier. One of your colleagues, Colin, was on, and I'm paraphrasing slightly, but he basically says that your ratings are always an assessment of the chances that you get your money back on time and in full. And so, I guess from my perspective, the initial reaction to do this, when there was very significant uncertainty about the private sector involvement and what that would look like, I guess, to me, I see making, I guess, quite a lot of sense. But in the cases of Senegal and Ivory Coast, for example, who explicitly said that private sector involvement was not even sort of under consideration, how do you, I guess, explain that they would still get this automatic review downgrade when, as far as I understand it, the main concern was that there would be private sector involvement, and if they're explicitly saying that there won't be, what is this downgrade sort of the review? Sorry, the negative review. What does that signify? How will you determine the outcomes? And if you hear nothing more in the next 3 to 6 months, what kind of a potential action from your side are we looking at? And maybe related to that, how do you think about the benefits of the liquidity relief that Samir mentioned, which again is greater for some countries than others, versus the longer term risks?
Yeah, that's a lot to cover. So I will try.
Yeah, many questions. Sorry.
So I mean, the first thing first that I need to say is first, our ratings speak to the risk of default and attached losses for private creditors only, not official creditors. So for bilateral and multilateral, they do have a role. As you say, you can even argue when they offer moratorium, debt or debt relief, this can even be viewed as a positive thing from a private sector creditors perspective, to the extent that the private sector creditors is not involved. And of course, the extent of the support or the positive impact from again creditworthiness perspective, it would just depend on the size basically. And here I think Samir already alluded to it, but the size of the reliefs across the board is relatively small in the scheme of things, and in particular, if you compare the gross borrowing requirements, the amount of money the government needs to borrow for this year to refinance its debt and finance the large fiscal deficits, the amount of relief is fine. So that's really the third thing to say. In terms of our approach, sorry if the feeling is that we had a blanket approach, but we have had different approach depending on countries. And I think we are guided by three things. One is there, in the first place, private sector creditors, external ones. I mean, that's the first question. If there aren't, then, before the cutoff date, which is 21st of March for the DSSI, then the question is much less relevant. The second one is, what's the rating currently? What's the current rating? The lower it is, we commenting on the Republic of Congo, for instance, so the Congo-Brazzaville, we have a rating at CAA2. The risks are already embedded in that low rating. The third one is whether indeed there is official, official participation or not. And as you refer to, Thomas, the question of whether the government said it will seek or not private sector creditors' participation is not in the three, key elements that I mentioned. So, that's a fair point. And I think that if you look at the countries that we put under review, you mentioned Ivory Coast, Senegal, Ethiopia before that on the continent, but also, not just in Africa, you would see that the official position on the part of the government may have varied from one country to another. Then, of course, that brings me to the question of why. And I think the question, the key starting point for us, again, here is threefold. One is the communication at the starting, at the start of this initiative. I think the communication puts private sector creditors' participation as a possibility. Not a necessity, but a possibility. The second thing I think is the sense of history. I think we have to admit that when we look at the history of, the sovereign defaults that we look at, and we have quite a long history, participation for the private sector creditors has played a role. And it's very difficult to play with the statistics. All statistics are, public information. Everybody can go download the data. It's always difficult because you need to look at what's the composition of the debt to really have a proper view. And if there is no private sector debt in the first place, then you want to exclude that from your sample. But in essence, when you look at it, very often when there is debt owed to external private sector creditors, they would participate in a debt or liquidity relief one way or another. And then, as we discussed, I think before, I think we need to take also into account the motivation from the international community and also their own interests. And here, to assume that the international community will say, we will provide relief, but under no circumstances will private sector creditors participate one way or another. You see, it's, again, it's not really what we're seeing when we look more from a, I would say, political dynamic point of view, this situation. So that's really, the rationale. Then in terms of, the risk, if we go beyond the short-term risk, which, on one hand, you get relief, on the second, there is risk for private sector creditors, and that's really what we're trying to capture in terms of risk. Then you have more the long-term issue, or the long-term debt issue. And here, in case of the countries that we're speaking of, I think that we're back to the usual, high debt, difficult dynamic challenges that we know about. So the first one, of course, is that many of these countries are exposed to foreign exchange risk in their liability. And in addition, the crisis is putting a lot of pressure on your balance of payments. So that's the first thing. And the second, of course, is that you're going to be left with lower growth, wider fiscal deficit, we're back to the usual, themes that we know about. And you may argue these themes, low growth, high fiscal deficit, used to be more the kind of topics we discuss in context of more developed economies. But I think they're coming more to the forefront now for these more, emerging frontier market countries. So yeah, that's in the nutshell what I would summarize, but feel free to follow up.
Thanks, Lucy. And I see we have some questions coming in, and that's great because we did want this to be as interactive as possible. So the first question, I'll give a brief comment and then maybe pass it to maybe Samir first. The question is around any alternatives to debt relief that could help countries hit by the impact of COVID. And I think for me, the obvious one, which we've already seen, of course, is multilateral support. So, the IMF already pledged $1 trillion of available funds. And just to put that in context, that, in the financial crisis in 2008-09, the IMF lent $125 billion in total at the peak. And so the money that's been sort of made available is 8 times as large as what it was during the financial crisis. Of course, the economies today are around twice as big, and the debt outstanding is around 4 times as big. But regardless, proportionately, it's still a much more significant amount, frankly, that they even offered in the global financial crisis. 100 billion of that is in rapid financing, and we've seen a number of the countries that are also participating in this DSSI, and frankly, many more all apply for financing from the IMF, and most of them getting it dispersed very, very quickly. So from my perspective, I think the IMF obviously has played a massive role so far. And I think could continue to, frankly, and this becomes, I think this is a sort of an interesting discussion. If countries were to seek private creditor involvement in some sort of debt relief, as a private creditor myself, owning bonds in many of these countries, I would certainly like to see the IMF involved in some way, shape, or form, right? What we don't want to do is create a moral hazard whereby countries are getting debt relief without, frankly, running prudent macro fiscal policies, right? And so for me, honestly, a natural step before potentially involving private creditors in any sort of debt relief discussion is potentially an official IMF program, which comes with more funding and comes with structural reforms that, frankly, also might even render private creditor relief unnecessary in some places. So for me, I would really highlight the IMF and the other multilaterals here as a significant part to play in terms of helping the countries. Samir, I go to you first, but anyone else, if you have thoughts.
Yeah, I mean, I would agree. And in fact, every country that requested it, well, not every, but most countries that requested it got almost 100% of quota in terms of RCF or RFI support from the IMF. And there's more coming from the World Bank, other multilateral institutions, and so on. I mean, one idea that's been floated by, for example, the United Nations Economic Commission for Africa is to have a swap of existing debt for longer, low-yielding maturities with a structure that would be underwritten by AAA institutions. I'm not really sure to what extent that is possible, and actually it would raise it will create another problem, which is basically that you would suddenly have a new sort of sub-asset class at much lower yields that would not reflect, obviously the country risk, but also that mainstream EM fund managers would probably not want to hold in their books because their performance will be affected. But I was going to add something on the local market side, which I think is interesting, because obviously, there's a lot of financing coming from multilaterals. But if you look at some of these frontier markets, basically they have been able to raise a lot of domestic financing recently. I mean, an example that comes to my mind is Nigeria, where the recent bond issuances onshore have been significantly oversubscribed and actually over-allocated in some cases. So most countries obviously have been cutting rates, they've injected liquidity onshore, and that's making it easier actually to push rates, market rates lower and to raise more financing domestically.
Yeah, that's a very good point. I mean, certainly the countries with more liquid and vibrant, if you will, local markets certainly have a benefit in that sense in terms of funding themselves. You bring up the sort of Brady bond, I want to call it, sort of thought of approach of turning, my Nigeria 25 risk into a IDB or World Bank or AFDB, whatever you want to call it, 35 with a 3% coupon that's going to trade well above par. I guess one risk in that, and Lucy, I know this is now getting into the very hypothetical, but obviously you would have to look at, I guess, the ratings of some of these multinationals to the extent that they start all of a sudden underwriting significant debt from these frontier markets. How would you sort of think about that? I guess you'd have to look at it on a case by case. Do you have any sort of thoughts in that respect?
I mean, certainly, the role of multilateral development banks or any multilateral development institution, be a bank or not, the mandate makes, their participation very likely one way or another. But we use that, and in a certain way, you may argue, the ratings already take that into account, and they have development mandate. Then the question is, how will they develop their balance sheet, and in particular, what we like to call development assets? Will they provide more loans? Will they guarantee more, debt issuance? Whatever assets they use to perform their development mandate. And then, what would happen on the liability side of the balance sheet, of course, and how much support to expect from shareholders. And we're getting back to the same, to the same economic agents, if I may say, which is, the large countries of this world. So, how much shareholder support can we expect? That's, just to summarize in a very, in principle kind of, approach, that's how we would look at things. And to be honest, that's something that we do, anyway, because the mandate of these institutions is already, we know, tied to development. So that's, that would be. If I may add on the size of support being provided, I find it very difficult to compare, historically speaking, just because of the nature of that crisis. I mean, if you think about it, that's a crisis that impacts all exporters, all importers, because you're all importers, usually there is a tourism dependent, agricultural dependent, they rely on businesses. I mean, here, I think the specificity of that crisis and the reason why we're seeing, debt to GDP spiking, like we probably didn't in 2009, is the fact that everybody is impacted. There is not one single country that you can say, So to compare in historical standard what the support from the IMF and the international community is a bit difficult for me, just because the size of the needs are unprecedented.
Fair.
Actually, I wanted to just piggyback on that point, compared
before you go, I've got one more question for you now. So maybe you can answer them both at the same time. And I see we got around 4 minutes left. So we've got 2 more questions to get to. So this one, I'll let you answer while you also comment on that, Trang, specifically around potential impacts on cost of funding in capital markets of countries that apply for debt relief. Have you any thoughts on that while you also answer the other one?
Sure. Well, actually, we don't have much time left, but I just wanted to make a point, especially to compare to the GCC in 2008, 2009. I mean, the banks are very well capitalized now, but the ones that are mostly impacted, and I'm talking on the capital market side, are the actually non-financial corporates. And we want to avoid, the fallen angels, especially the 2021 credit metrics, whereby that will impact their cost of funding, especially when, if the central banks, if the government facilities do not go down the credit curve to high yields, to the likes of fallen angel type. In fact, I think countries have noticed and acted on that. So the cost of funding very, very basically will be impacted by how investors are seeing if these relief, if these all the liquidity is actually benefiting the issuers in the market. If it's here to stay, I think the cost of funding will not be elevated as feared, mainly because there's a lot of the fundamentals and the technicals that are supporting it. But obviously, I think investors have cash to invest, and equity markets are a bit volatile at the moment. Dividends are mostly suspended, so debt seems to be benefiting from the dynamics that we've seen in the markets. I'm very conscious of time, so I'm
Thanks, Trang. Maybe if okay, I'll take 20 seconds to answer the final one, because it also goes in with what Trang's saying. It depends to a large extent, all of this, on what investors see. The final question is around concerns that countries assessing debt relief which do not need it. And this is what I asked Samir earlier in terms of the countries that are relatively strong that might not get that much relief. We've discussed this also before, Samir, a couple of weeks ago. I mean, my analogy is that if my bank called me up and said, would you like to not pay your mortgage for the next 6 months? I would say, sure. If it's not going to impact my credit score and not going to impact my ability to borrow, why not? So I guess my personal conclusion as an investor, when I see the Ivory Coast, Cote d'Ivoire, and Senegal go for debt relief, for me as an end investor and as a bondholder, I don't feel that concerned, because I look at their credit metrics and I look at their economies, and I don't think they're impacted in a negative way, certainly by saving a couple $100 million for the rest of the year. I think that maybe we'll close with that. Cedric, I think we're about out of time.
Yes, we are, unfortunately. So yeah, thank you very much for this discussion. Very, very interesting indeed and insightful. So as usual, for those of you in the audience would like to follow up with any of the speakers, don't hesitate to get in touch with them by going to the People's tab on the main menu and the main platform online. I'm sure they will be quite pleased to answer any follow-up questions you might have and organize video conferences. So next, I would like to introduce Leo David Purr, who is should be coming online anytime now. So Leo is the head of government debt management unit at the Ministry of Finance of Israel.
Yes, hello.
Coming anytime now. Oh, hi, how are you?
Yes, I'm here. Hi, I'm fine, how are you?
I'm very good, thank you. So thanks for being here. I will let you, the floor is now yours, and I will get back to you at the end of your speech. Thank you. Bye.
Thank you very much. So I will share on the screen for the presentation. Okay. Second. Okay. So I guess now you can see the presentation.
Yes, we can see it.
Okay, you can see it, great. So thank you very much for the opportunity to participate in this unique event. And actually, I was very delighted to hear all the presentation, most of the prior presentation. I think it was a good opportunity to hear both investors and other borrowers. And in this presentation, actually, I have 3 parts. And the key message of my presentation is to share my view about 5 simple principles for managing the debt, and maybe you can say to have a better and effective debt management. But I will start with a background about the impact of COVID-19, about the situation of the macro situation, the fiscal, the debt. And I think that at the end, maybe we will speak a little bit about negative interest rates. And I will try to leave time for questions. Hopefully it will not be too difficult questions, so I can answer them. So the COVID-19 actually caught us, like everyone else, unprepared, in terms that it was a major shock, which we could not forecast and take under consideration. And actually the impact of this pandemic actually was significant in all aspects. Its impact on the macro situation, on the fiscal situation, and also on the debt situation. And just to give a quick overview, and I will not go, of course, about all the details in the specific area, but I will address how it caught Israel in terms of our growth, the unemployment, deficit, and the debt-to-GDP ratio, and our financial needs and financial risks. But in general, I can say that actually we were quite in a good situation. So we performed very, very good in recent years in those aspects, and actually it give us the flexibility to handle this crisis in a good shape, in a good manner. And on a relative basis, I think that we succeed to deal with this challenge. When we're speaking about the macro situation, so just to illustrate some figures, here you can see the quarterly growth rate. And I think that what is nice to see in this chart is actually the counter-cyclical nature of the Israeli economy, and the ability of the economy to actually absorb different varieties of different shocks. And so, for example, in 2008, you can see a negative quarter of growth due to the global financial crisis. And you can also see the impact in 2000 and 2001 of the bubble, the dot-com bubble, and the geopolitical concern in Israel in 2001. And actually, the economy, due to its flexibility, which we will talk about later, actually was able to bounce back from these shocks. Obviously, we can see that the impact on the first quarter of 2020 is significant, but the numbers for the second quarter should be released, and actually, we believe that we are going to see better results. In this slide here, we can see the picture of the unemployment, and actually, we were consistent. You can see the trend. Consistently increase the unemployment rate to record low of less than 4%. In addition, our participation rate, which is currently 64%, is above the 60% of the OECD average. So in that sense, it caught us also in a good shape. Obviously, in the first quarter, we see a hike in this way, but again, now people coming back to work. And the number should be again decreased. In terms of the fiscal, so I think that the fiscal situation in Israel is, if I should define it in one word, so actually there is a good discipline, and it's come because of our history, and it's something that is built in the older parties, in the left-wing parties, and the right-wing parties. So it's something that is built in the economy, and you can see that actually the target, we were able in most of the years to meet our target. We even performed better than the target in recent years. In 2019, there was a slight increase because of a lack of revenues, and also because it was the second dual annual budget, which was much more difficult to forecast the revenue side. and we of course were impacted from the slowdown, from the global slowdown. But all in all, you can see that actually we were able to meet the target. Now the deficit is a target because, as I said, it's very difficult to forecast the revenue side. We used to have many one-offs on the revenue side due to exit, etc. Something that did not happen in 2019. But in the expenditure side, actually, we have a binding rule for how much you can expend. And actually, there is a formula that we can expend the average population growth of the last 3 years plus 50% divided by the current debt to GDP ratio. And this is this element actually is targeting to reduce the debt to GDP ratio, and it's actually been done and performed, as you can see in the right hand chart, a very consistent and stable decrease of debt to GDP ratio up down to the level of 60% of the Maastricht. And this performance is even very reinforcing because actually the trend in other countries were exactly the opposite. So, for example, between 2010 to 2019, we saw other countries actually suffering from the global financial crisis, and actually we saw a huge increase in the debt to GDP ratio. So, for example, the EM countries, the average increase was 16%, peer group roughly 9%, and we were between several countries that were able to actually reduce the debt to GDP ratio. And I have to say that although we have the 50% in the formula of the expenses, it is not that the government decided that we would like to be at the 50%. This is not a magic number for us. And actually, the way we see it is actually to be able to increase growth, and then the result will be continuously decreasing in the debt to GDP ratio. And actually, there are room for improvement in 2 areas for us. First is the infrastructure. Actually, we suffer from a gap in the infrastructure. Our stock of infrastructure is only 50% from the GDP, compared to 70% of the OECD. And also the quality of the infrastructure is something that is not in a very good shape. And the County General actually promoted the plan of 2030 for investing in infrastructure, the selection facilities, light train and the metro, something that we are going to invest. And hopefully, by investing on infrastructure, we will see the benefit of the average growth, which is currently roughly less than 3%. We enjoy levels higher than 3%. And when we will see that the growth will increase, then the trend of the debt to GDP ratio will continue to decrease. But currently, the level is roughly 60%. In terms of the debt, so the debt portfolio is roughly $240 billion, equivalent of roughly 800 billion shekels, 60% of the GDP. The burden of the debt, so the interest expenditure, is roughly 2.7% of GDP, which is relatively high compared to other countries. For example, the average of the OECD is 2%. And the reason for that is because we are issuing designated bond only for the pension funds in Israel, and we give them a coupon which basically subsidizes the pension fund. We pay a coupon of 5.5% and 4.86% CPI link, which is a subsidy of roughly between 4 to 5% over market yield. And this is due to our as a sovereign that would like to support the pension system. So this is the element that actually increases it. The subsidy is roughly about 8 billion shekels per year. So if we will deduct it, we will see that our leverage is also 2%, similar to the average OECD. The average time to maturity is relatively high. It puts us in a very conservative place, 8 years. And actually, it has been increased by not just by issuing a long-dated bond, because this number is average. So if we are issuing bond for 100 years, we increase this level, but actually we do not reduce the risk. It's also been done by issuing in the local market for a marginal maturity of 10 years. So we issue in bonds for 10 years in shekels, and also CPI link, FRNs. And actually, we enjoy very deep domestic market, liquid market. We issue benchmark, nominal benchmark, but also inflation bonds. We have a full curve, 3, 5, 10, 30 years. And this is something that helps us to increase the average maturity. And as I said, we also look on other indicators. Also, here we can see the rollover ratio, which is basically the short maturity debt up to 1 year divided by the total debt. And as you can see, 8% from the total debt is actually put us again in a very conservative place. We also manage the rollover ratio for 3 years, and we are trying to smooth our redemption schedule profile in order to manage very carefully the refinancing risk. Last year, we actually issued roughly 140 billion shekels, roughly $40 billion. And as I said, most of the issuance come from the domestic market. You can see a breakdown of the debt. So the domestic market is actually roughly 90% of the debt are domestic, and roughly 90% of our issuance is domestic. We separated between the tradable bonds, which is roughly 60%, to the non-tradable bonds, which is roughly 30%. And the foreign currency is only 13%. If we will go back to 2006, for example, and the level of the foreign currency was 25%. So actually, since then, we did a shift from our foreign exposure, and we reduced it from 25% to roughly 13%, and this number is roughly steady state in recent years. And we increased the nominal debt from roughly in 1995 we issue only CPI linked bonds, and currently from the 56% tradable bonds, 30% are nominal bonds. So basically, we increased it significantly through the years. Now, speaking of the global market, so just wanted to give a little bit color about our debt strategy in that sense. So we actually trying to issue once a year benchmark deals, and we are trying to rotate between dollars and euros. So just actually to improve the voice. Hopefully now it's better. And actually, we are trying to